morning. Oh, you guys are chatty. We're gonna be streaming today. 9:15. It's March 8th. Streaming stocks, options, futures. And let me get set up here. Sorry, you guys, if you've commented on my video in the last week. YouTube wasn't updating me on any of the comments. I just found where they all are. Usually I can just reply on my phone, but yeah. So I just went back and replied to ones like a week ago. If you're confused. This doesn't make any sense. So we got Pal again. Should be good times. There's our Yaz. Turn that on. And share this on Twitter. Thank you guys for sharing this on Twitter. It's awesome. The support you guys show. Alright. Put a link for the Discord. You guys can join if you haven't yet. I'll pin that in chat. Thank you guys for your likes already. We're at 7. Appreciate it. Those early likes are very helpful. Morning, Jason. Morning, Tree. You just dropped. Excuse me. But there was some data this morning. I guess it didn't really affect SPY at 8:30. Wriggle. Morning, Ace. BBY had a filing come out. Another half hour. Good morning, Christopher. Good morning, Jim. Wednesday? Good news for Elvis? Just because it's a Wednesday? Whoa! What is the news? Debt litigation firm? Oh, meets NASDAQ requirement. Huh. They're not over $1, but they met some other requirement. That is neat. Morning, Jan. Good morning, Joe. I guess it's not the share price, it's some other requirement they had to meet. It's funny, it causes it to rally. I think it's good news on BBY. I'm gonna look at it. Yeah, Turco definitely some heavy profit taking. You have to imagine that though, after the crazy rally it's had. It's gonna have a pullback. It was a pretty aggressive one though, that is true. PAL is at 10, yep. Holding, buying dips, crossing fingers. Yeah, so BBBY, I guess. Couple things. Just read through it on Discord. Yeah, then 8K, it's 217 pages. They sold more preferred shares, so that doesn't cause dilution. And I think they raised up to 360 million doing it. Let me see. Yeah, it receives additional proceeds from previously announced public equity offering. Murdoch says it was 360 million. I'm not sure exact number. Probably in the 8K. Bullion said it's a renegotiation of the credits, loans to all lenders. That seems good. Required funding dates. Oh, that's what this is. The required funding date means the second trade has been. They'll change it from February to March, April. Be 22 trade days thereafter until such time equity commitment has been funded to the company pursuant to the equity commitment documents. Renegotiated funding and credits and loans, it looks like. AK signals to me that they are meeting their marks by the bank and whoever is buying these warrants. Yeah, the additional funds raised, I'm not sure what exactly it's for. If it's we haven't heard. I don't think we know yet if it's to pay off interest payments or what. Yeah, still no mention of preferred shares to common shares conversion, which is when dilution comes. And Bullion said they reversed the default from JP Morgan, which I thought was already the case, because JP Morgan ended up giving them more money after they said they defaulted or whatever, which might have all just been news FUD. The lenders party here too hereby agree and consent on a one-time basis only to effective immediately and automatically as of the Third Amendment effective date, waive the existing events of defaults and the existing defaults, including, for the avoidance of doubt, the failure to deliver notice to the administrative agent upon the occurrence of such existing defaults and existing events of defaults, and the making of any false or misleading representation, warranty, statement, or information resulting from such existing defaults or existing events of defaults prior to the Third Amendment effective date. But I thought that was kind of already known. I'd be wrong on that. Let's see. I personally haven't read anything before today of a potential reversal of the default with JP Morgan. Like they had a meeting and were able to reduce the debt with JP Morgan by approximately $100 million. Didn't JP Morgan give them more money though? I don't know. That was something I read at some point, which was another reason why it doesn't seem like they're going bankrupt. If a company that just basically was trying to call in their loan margin column, basically, then went around to give them more money, like they let them in on their plan, but that could have been just opium and not legitimate. Yeah, it's a long AK. Price per share preferred shares go for. I'm not sure. I don't know if it's in the 8K or not. But stock didn't have much move on the AK. Like I think we had this. I think this volume was maybe from it. 175,000 a little pump. So we'll see if we get some upside during the trading day. Yeah, upside in BBY would be awesome. I think I got a margin call on my Fidelity last night, so I might have to close some of my shares. Trying to do more covered calls to alleviate some of the margin requirements. They maybe went away, honestly, overnight. Chinese military researchers are studying Russia's struggles in Ukraine and planning for possible conflict with US-led forces in Asia. Doesn't sound good. Mortgage loan applications have fallen to their lowest level in nearly 30 years. Stocks are still too expensive even after falling from 2023 highs as inflation proves stickier than expected, Barclays says. Major market dislocation and a sharp slowdown in economic activity could both be realistic possibilities in the event of a U.S. debt default. We've defaulted on our debt twice, I think, in this country. In like 2018, 2019, and then the 70s, I believe. And a lot of stuff we're doing right now is kind of repeating the 70s. Thanks for your likes, guys. Got 11 of them. Gonna be opening up here. Market in just a few seconds. All right, market's open. I have one micro ES. I'll probably be looking for more entries to the downside. So bounces to levels like there, maybe. Just slowly scale into them. Thinking maybe just doing the MES is a better idea. Just keeping the micros, and then just I can kind of have a better average. Oh, tops went up 12%. I didn't wait long enough. I think I closed my tops. I guess it's just kind of back to where it was. HKD is up 5%. Bed Bath popping up a little bit here. See if we get to that 138 level from yesterday. That 135 right now. Tesla's down 1%. Morning, Justin. WD-40's up 10%. If he doesn't rock it today on news, I'm done. Yeah, Helbiz is up 15%. SPY is rallying here. Sunny and 77. Nice. There's 136 on the high there on BBBY. Osmo's down a little bit pre-market. I still like it. I think it's holding up good. ENS is down a little bit. Might see if I can get a short up here. Okay. BBY is at 0, back to break even. He's coming down a bit. That gas is down 1.5%. Help. Oh, HKD. Uh-oh. Oh, it had a pump pre-market. Oh boy. Oh boy. It really actually started to trend up here. Look at that. SPY is wicking there. Ops is up 8%. BBBY 136 is still the high there. Rivian, I'm watching Rivian with that play just opened. Tesla's selling off, down 2% already. There it goes. Now Tesla's starting to flush. I want to be patient, but I do want to enter a short. Maybe if we get a retest up here, but I don't know if that's even going to happen. It's looking pretty weak already. I don't have buying power. I bought too much stuff on the trading account. $139 on BBBY, up 3.5%. RC buying again. Based on everything we have and what he said, no. Of course, it's possible that he's playing games and it's all part of some master plan, but it doesn't seem like it. Short Tesla. I am short Tesla, yeah. Not a parabolic run yet, nope. We still haven't even hit yesterday's open, so 139 though, that is the high today so far. I might be grabbing some more covered calls here this morning. We could get a MACD crossover today. 20 down. And gone. Let's go SI. Are you shorting it now? Isn't that the wrong way for you? Tops up 11. This is basically back to where I was on it though. Nothing crazy yet. LBIZ came down. HKD is kind of interesting though. This does look like it started to find a bottom here, kind of an inverted head and shoulders. You even do TA on HKD. GME is at 1774. Wanted to get puts on it, but I really don't like the option chain on GME. It's crime. Chat lacks emotive ability. HST? Talk about HKD. Oh yeah, host hotels. That's what. Did you send me the picture of this one? Yeah, it has been in a range, so if it stays in that range, then great. I'd look for probably. I mean, maybe we get like a halfway bounce from here up, but I look for a floor somewhere around here, 15 and a half or so. Then look for signs of reversal before you go long. Buy's coming down here. Dang, I need it. Need to sell something. Cosm, I'm green on. I close here. Pop back in. GameStop being. I think GameStop's going to retest that low. $20K. Do some more cover calls. Yesterday, I guess I opened up quite a bit of covered calls. My entries were awful because I never got this little morning spike. So now they're all down, but um, hopefully I get some better entries today. I'm actually doing the 1.5, so kind of aggressive. I want to do the twos, but we're just too far away from the twos now, at least for the weeklies. I guess I could do next week's. But just give myself 1 week, and then if I'm in the money, I can roll it. Yeah, see, SPY's coming down here. Oh, what should I sell? I'd like to get some more shorts on the ES. Heck of a deal. BY survives more from default. What? Sold my BBY and bought SI. All right. Albay's up 13%. Kind of holding up its gap up here. Ops coming down a bit. HKD is holding up well. Give me death crossed. I mean, puts do actually work pretty well in GME for how messed up the option chain is. I've at least had a good experience with long puts. Cosm's back up to my cost basis. I'll hold this one. I like that. I think GNS looks nice. All my capital's actually tied up in on this account, my E-Trade account, and BBBY cash secured puts. I did a bunch of 1.5 puts on here. So I'll need to close that to get capital back. My Tesla short is almost back to break even. It's held up way too well for way too long. It's got some gap filling to do. Finally today it's breaking this supports. Yeah, Hellbiz 15%. Yep, that looks nice. Rivian shorts up 49%. It's down 2%. I need under 13 on Rivian. Be max profit. Pops up 8% still. BBY holding up from this little high from yesterday. UNS starting to fill that gap. HKD still up 5%. Yeah, we saw that news on Hellbiz. It met one of the requirements to stay on the NASDAQ. Value of listed securities requirement. Yeah, they've got a ways to get to $1. But reverse splits have been pretty bullish for stocks lately, so maybe just a reverse split. That gas is coming down. Tesla's pretty weak this morning. Yeah, reverse split. So maybe we'll announce that and we'll get a crazy rip. We've been having a little bounce here. If when it hits just over 20 cents, it soars. Albiz? Yeah, it needs to soar up to $1. Over $1. That's where Turka got shut down. Who was saying that? Oh, Zip Trader. Like literally just about to get into the compliance zone at 99 cents. Blip. But given I think they have to be above $1 for like 30 days or something. It's not like an instant thing. GME's down 2.25. That would hit me hard. Reverse splits and bankruptcy are quite bullish. these days. Yeah, I've seen a lot of reverse split rally, like not necessarily the same day or even leading up to it, but probably at least 3 tickers I've seen were reverse split, and then like 6 to 15 trading days later had a huge rip up, and then some happened like on the same day. I am now green on my Tesla short. Yippee. Good thing I got time. I always want to get time with options, with long ones especially. I don't have much time on it though. I only have 9 days, so I might be closing this thing out today and maybe get some for a later date. I'm pretty bearish on the market after Powell's statement yesterday though, so I think this has a ways to go. There's a shareholder reverse splits. I mean, if it gets the stock price up, I guess it doesn't matter a whole lot. I think I need a little break of this level to get some cover calls filled. Okay, I'm gonna close out these cash card puts for break even if I can. These ones on E-Trade. They're 1.5. I can get a lucky fill now, being that they're in the money. And we did break that inverted head and shoulders, so SPY's bouncing here a little bit. Kind of a little inverted head and shoulders here on the 5-minute. Powell's coming on in 10 minutes. I'll queue it up. I'm assuming the statement's going to be the same. So shouldn't get much volatility from that unless he did change it. Powell again. Yep. HKD 7%. Holding up nice. Hellbiz starting to rally. At least back up to where it opened, I guess. Yeah. Osm came down a little bit. I still like this. I'll hold over this kind of $4 level. I like it. Let's see. It's all jacked up here. Let me. What is it? Weird. Okay. BBBY is not tanking first. Didn't expect that. They had an AK, huge AK filing this morning, which seems good. Seems like good news. They raised some more equity from it and renegotiated some loans. And I think JP Morgan is giving them a pass on their default. Something along those lines. SPY range bound. It's just waiting for Powell, I think. So we had a US ADP non-farm employment change. It was 242,000. Estimates were 200,000. Previous was 106,000. Hellbiz 18% now. General Motors. Hellbiz might be about to break out up here. RBT is up. Rubicon Technologies. Got a nice smooth looking chart. Looks good. Have a little RSI divergence here. Have options. That IV. How low it is. No liquidity there. The chart looks nice though. Tops. BBY is holding up about 2%. Good news, we end up like -5%. I mean, it wasn't like that bullish of news on the filing, but yeah. Yeah, I think today's gonna be pretty red. I think we're gonna start to see some big moves, some more of yesterday's stacking up. What's your price on HKD, Big Hugs? Emotional support. Oh, it's looking all right. We'll see. I mean, it's still kind of a bear flag here on the hourly. I think we might still come lower. But if we close up, if we start to get some close on these 4-hour, let's see, this 4-hour closes at 130. Then this will be an RSI divergence on the 4-hour. We were starting to build it yesterday, and then yesterday closed too low and it went away. So it's a subtle one, but it's there. The daily RSI is so flat. Really, we'd want almost a new low below 127, and then a bounce. That'll give us our divergence on the daily. Not sure if we'll get down there or not. SPY's rallying a bit here. Tesla giving it up, down 3.6. Vivian's a little stronger. Around 8 or 9.4. It's not too bad. I sold out, took a small loss, and then it rallied the next day, bought back in, and then closed out. It broke all-time lows, and I was like, oh, I'm out. And then it literally bounced the next day. So yeah, it looks like it's set up a little kind of inverted head and shoulders here on HKD. So we'll see. Maybe it's at a bottom, an actual bottom. You're getting close to your average on it. GME bounced a bit there with SPY. I hold because YOLO. Yeah. HST went up 2 cents. No, I think it should come down more. right? Because if you're looking at this range, it doesn't necessarily have to be here, but I would look for, somewhere around here to enter, go long. So the trend is still down. You've got basically a bear flag here, consolidation before probably more downs. So if it starts to reverse here, you know to go long. If it doesn't, wait for it here, see if it starts to reverse on these levels. These are daily candles, so it'll take a day or two to at least show signs of reversal. If it doesn't here, then wait for these levels. If it doesn't here, then wait for these levels. If it doesn't here, then you just go short. I don't know, or the trend is broken, the range is broken. SPY's rallying a bit here. Anticipation of Powell. And Weeble is breaking because of it. Get the audio on here. BBBY, almost back to break even. There's break even. I don't think I got any cover calls filled. No. We'll probably just go for next week's. Maybe if their OPEX will be more, maybe some more volume on them. Gas secured puts I still have. That gas flushed. Let's see. I'm not going to start until pre-roll. Nothing. All right, 10 a.m. I think his statement's probably out. SPY's already starting to dump on it. Yeah, SPY just broke that level. I'm trying to get my capital back. I don't. He's speaking?
Only 300,000 hotter, but you.
No, he's late.
They don't shut. Yeah, they don't shut the power off.
SPY's flushing. I didn't get. Canceled my order for my nat gas. Wonder if I can get it MES now. Oh, I can. Okay, cool.
Exactly.
A bit premature. Might get a bounce. No Mopey Pal or Moppy? It loses 121. There's no way to know, but 127 is that last support. If it loses that, you've got 1160, which is IPO high, and then all-time lows is 88 cents. So those are the next two levels I'd look for. But if it does get past there, but we could just get past there with a wick and then a bounce, setting up that RSI divergence intraday.
That's speedy.
Shake everyone out, trigger some stop losses. You know the deal.
I don't know how we feel. It's all right. We got everything together. I mean, yeah, next semester. I mean, he's not. Yeah, he's not.
Okay.
It's not like when we were in waves. He was the second to the last.
Little bounce here. See if I'm getting any cover calls to get filled.
Cap, he would just walk up and leave. Because he was like, I got no shot. And if he doesn't get here, oh. And he will not be to committee on time. Hey, how are you?
Someone's mic'd up here.
I am. Me. Yes.
I got out of my cash group puts on my E-Trade account. I actually took a little loss on them. Normally I would roll them, but that account I'm trying to use more for trading, not theta farming. So the 1.5, the cash group puts on my other accounts I'm holding. Unless we get good enough bounce, I'll just jump out of them. The bounce on SPY, like I said, I was premature. Thanks for your likes, guys. We're at 20 of them. Not bad. We're about to listen to Pal. He's running a little late. They're all running late. I don't know.
Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And I'll note at the outset that this hearing has a hard stop of 1 p.m. This is traditional for the Fed chair, which
he's
we
always so
intend to
steezy.
strictly observe. I now recognize myself for 4 minutes to give an opening statement. Thank you, Chairman Powell, for your testimony. This week, you stated that the Fed will, quote, stay the course until the job is done, and that is to restore price stability. This is positive. But
think clear
you
debt.
know as well as I do,
BBBY
we're
raised some
facing
money.
a very strong headwind from the
NBOS?
political left. Democrats are pressuring the Fed to stray from its narrow mandate. It's a page out of their same old progressive playbook.
It's
When
pulling
they
back.
don't have the votes to achieve something here in Congress, they
For support
turn to
somewhere.
regulators. And now, Chair Powell,
It's a
they're
nice
looking
uptrend
at
though
you
still.
and the Federal Reserve.
Daily.
President Biden's kowtowing to the far left is what got us into this inflationary mess. I urge you to reject the ideologues who put their social agenda ahead of economic prosperity. High prices continue to eat away at workers' wages and retirees' incomes. Since President Biden took office, we've experienced inflation at rates not seen since the late 70s and early 80s. Inflation rapidly accelerated after Democrats passed their so-called American Rescue Plan, which poured nearly $2 trillion of inflationary fuel into the economy. By June of last year, the Consumer Price Index showed inflation skyrocketed from below 2% to nearly 9%. And personal consumption expenditures, the Fed's preferred measure of consumer prices, ballooned to 7%. Instead of being rescued by Democrats, Americans were punished with pain at the grocery store and sticker
BBY's
shock
now
at the
red.
pump. While inflation is now it is now below its mid-2022 peak, it is
You have no
persisting at rates well above the Fed's
filter on
target.
what your
It remains
political sharing,
broad-based and continues to
Don Earl.
hammer Americans' pocketbooks. In fact, a recent Gallup
No
poll
question what you
shows
think.
half of the respondents say they are worse off financially than a year ago. It's clear that there's still a long way to go in the effort to bring down costs.
Plantation owner.
I look forward to hearing you reaffirm your commitment to that work today. Republicans also want to hear from you regarding some concerning developments at the Federal Reserve on the regulatory front. Recently, the Federal Reserve's Vice Chair for Supervision announced a quote-unquote holistic review of bank capital in the Fed's regulatory regime. However, it seems that only a small group within the Fed knows what this means, what it entails, how much review is being vetted by the full board, and the type of quantitative analysis the Fed is performing. The Fed shouldn't operate in the shadows, especially when the regulation in question can have broad and significant economic effects.
That's
It's also
180.
unclear the motivation for the Fed's holistic review, particularly when so many board members have stated that the banking system is very well capitalized, and any review of capital standards should be targeted. It also appears the Federal Reserve Board is laying the groundwork for climate policy to be implemented through the Fed regulation with an opening
GG is up
salvo to
11%.
quote-unquote scenario analysis. Addressing an issue like climate change is important, but a policy that should originate here in Congress by the elected representatives of the people, not the central bank. As you've said, the Fed needs to stick to its knitting. I agree. There is concern from many that the Fed is picking up new needles and knitting partisan sweaters. At such a precarious time for our economy here at home and the global economy, that would be a mistake. Thank you for being here today. I look forward to your testimony and the questions by our members. The chair now recognizes the ranking member of the committee, Ms. Waters, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman. Good morning, Chair Powell. Since your last visit, our country, under the leadership of President Biden, has made major progress to improve economic conditions, including adding a record 12 million jobs, reducing unemployment to its lowest rate in 54 years, while also reducing the deficit by $1.7 trillion. Unfortunately, many families are still struggling to afford basic necessities because of inflation.
Yeah, it is.
What's more, interest rate hikes are making borrowing, especially for mortgages, outrageously expensive. Since I raised this concern for you in a November letter, the rate hikes continue to have an outsized impact on housing costs, which are, as you know, a primary driver of core inflation. But, Mr. Chair, I think that you will agree that Congress also has a role. That's why I'm somewhat disappointed that after 2 months, Republicans have taken no serious action to address inflation. By this time last Congress, House Democrats had passed the American Rescue Plan to provide relief from the ongoing pandemic, which included our committee's efforts to provide $70 billion for homeowners,
Spies rallying
renters,
here.
businesses, and first responders. If Republicans are looking for ideas, committee Democrats have put forth additional bills, like the Build Back
SBF
Better
last
Act,
night.
to bring down costs for Americans, especially housing costs. Even more concerning, we're just months away from an economic catastrophe beyond what we have ever seen, including spiking interest rates, massive job losses, and global instability. I'm talking about the threats by Republican leadership to force a default on our nation's debt if we don't agree to their demands to cut Social Security, Medicare, or other critical programs. You've urged Congress to take immediate action to raise the debt ceiling. But rather than focusing on this very real issue,
We're not in a
the
recession,
first
guys.
bill
But if you're having
that
troubles
committee
with money,
Republicans brought to
consider
the
skipping
floor
breakfast.
instead suggested that Social Security and Medicare are socialist threats to America. Since then, we have considered legislation related to deregulating securities and banking laws and countering threats from China, but Republicans have completely ignored the biggest economic threat to businesses, consumers, and our economy, defaulting on our debt. Last month, I wrote a letter to Chair McHenry urging him to take this matter seriously and hold a hearing, but I'm still waiting for a response. I hope Republicans will listen today to the real consequences that even the mere threat of a default would have for everyone in this country. And finally, I'm so pleased that we're finally making progress on diversity and inclusion for key positions at the Fed, including last year's historic confirmation of Dr. Lisa Cook to serve as the very first Black woman on the Federal Reserve Board, with the board's vice chair and Kansas City Fed president positions vacant. I think President Biden and Kansas City Fed Board should build on this progress by seriously considering diverse candidates for these positions. With that, I yield back the balance of my time.
The ranking member yields back the balance of my time, asking unanimous consent to submit for the record my letter to Secretary of the Treasury Janet Yellen from February 28th, asking for an update on the ex-date for the debt ceiling. I also ask unanimous consent to submit for the record the latest CBO long-term budget outlook on the unsustainability of our debt, most recently released. And without objection, so ordered. I'll now recognize the Chair of the Financial Institutions Subcommittee Chair, Mr. Barr, for 1 minute.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today to discuss the Federal Reserve's monetary policy actions in a time of economic uncertainty, mixed economic data, historic inflation that continues to plague families and businesses around the country. It is paramount that the Federal Reserve remain vigilant on reducing inflation, anchoring inflation expectations, and restoring price stability at the Fed's 2% target. I also look forward to discussing the Fed's regulatory and supervisory activities. As the Fed reviews the bank capital framework, it needs to consider the impact to the real economy and our global competitiveness when raising capital requirements and sidelining capital would work at cross purposes with monetary tightening, constraining the supply side when we need more, not less, investment to fix supply chains and reduce inflation. Tailored regulations are required of the Fed by law, and a one-size-fits-all approach would be the wrong path to take. Finally, I urge the Fed, in your words, to stick to its knitting and not attempt to be a climate regulator. I yield back.
Gentleman's time has expired. We'll now recognize the ranking member of the Financial Institutions Subcommittee, Mr. Foster, for 1 minute.
Thank you, and thank you, Chair Powell, for being here today. Today is the 15th anniversary of when I was first elected to Congress and placed on the Financial Services
you want all that
Committee,
crust?
just as the economy was about to collapse.
I don't know about turkey.
And so that was my trial by fire.
Maybe.
The emergency response to rescue the economy
Wait
and
for,
the legislative
the
response.
floor
that
and
Dodd-Frank
momentum to
Act
the upside
that
and grab it
successfully
again.
stabilized our financial system. So 15 years later, as I take my place as the ranking member on the Committee of
got a
Oversight
couple more
of
gaps
U.S.
down here.
Banking and Monetary Policy, I recall the
24
solemn
cents.
oath that I swore to myself back then to make
22
sure that
22
this
cents.
kind of calamity never happens again. The monetary policy report that we're receiving today is largely a narrative of a return to normal. And lead times to manufacturers are back to pre-COVID levels. The job market retains supernatural strength, and inflation is responding more or less as predicted to the usual measures. And by far, the largest threat on the horizon is a repeat of the 2011 default crisis. Congress has the power to avoid that, and we owe it to the American people to do so. And I yield back.
Today, we welcome the testimony of Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell was appointed, reappointed, and sworn in for a second four-year term as chair on May 23rd, 2022. Chair Powell also serves as chairman of the Federal Open Markets Committee and the system's principal monetary
we're checking
policy
HKD out.
committee, which is the system's
It
principal
like
monetary policy making
rounded at bottom.
body. Chair Powell, we thank you for
here on the
taking time to
hourly.
be here. We will recognize you for 5 minutes to give an oral presentation or testimony. Without objection, your written statement will be made part of the record.
Actually find a
Chairman
floor.
Powell, you're recognized.
Chairman McHenry, Ranking Member Waters, and other members of the committee, good morning. And I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant
wrong guy.
hardship.
Wrong guy.
We're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our tightening so
GME
far
back
are
at
yet
this
to be
level.
felt. Even so, we have
Bouncing
more
on
work
that
to do.
1762.
Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we had seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with the revisions to the previous quarter, suggest that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above our longer-run objective of 2%. The 12-month change in total PCE prices has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, which accounts for more than half of core consumer expenditures. To restore price stability, we will need to see lower inflation in this sector, and there will very likely be some softening in labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above
new
what
low.
is consistent with 2% inflation and current trends in productivity.
1, 3,
Strong
10
wage growth
hit,
is
I
good
think.
for workers, but only if it's not eroded by inflation. Turning to growth,
This the
US
same
economy
speech as yesterday?
slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%.
Hey, Jason.
Although consumer spending appears to be expanding at a solid pace this
Best
quarter,
platform to show on.
other recent indicators
know.
point
Whatever your
to
favorite
subdued
platform is.
growth of spending and production.
Do it.
The activity in the housing sector continues to weaken, largely reflecting higher
Whatever
mortgage
platform
rates.
you're on, you just have to get margin.
Higher interest rates and slower output growth also appear to
should
be
be able to
weighing
short.
on business fixed investment. Despite the slowdown in growth, the labor market remains extremely
Gene.
tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remain
Thanks for your
very
likes,
strong
guys.
in
I
January,
appreciate
while
it.
the supply
Listen to
of
Jay
labor
Powell
has continued
testify.
to lag. As of the end of December, there
27
were
likes.
1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historic lows. Turning to monetary policy. With inflation well above our longer-run goal of 2% and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy
adding to my
that is
shorts here a little
sufficiently
bit.
restrictive to bring inflation down
get
to
much of a
2%
bounce.
over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy.
Check your
It will take time, however,
Your
for the
permissions
full
and
effects of
privileges
monetary
or whatever
restraint
it's
to be
called on
realized,
eToro.
especially on inflation.
might have to
In light
enable
of the
margin, like I
cumulative
said.
tightening of monetary policy and the lags with which monetary policy affects economic activity and
Why the heck
inflation,
are we not
the committee slowed the pace of interest rate increases over its past 2 meetings.
in the world?
We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic
Do
activity.
they not have
and inflation.
permission to?
Although inflation has been moderating in recent months,
Don't
the
have the rights
process
to
of
put
getting
Jay
inflation
Powell
back down to 2%
on film?
has a long way to go and is likely to be bumpy. As I mentioned,
Keep
the
shorting
latest
the low.
economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If, and I stress that no decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals, taking into account the totality of the incoming data
Thank you,
and their implications
Chairman
for the outlook for
I'll now
economic
recognize
activity
myself for 5
and
minutes.
inflation. Although inflation's been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates
why
is
is this
likely
so
to be
much
higher than
behind?
previously anticipated. If, and I stress that no decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that if I turn to the March meeting, I guess I would say that we have some potentially important data coming up, data to be analyzed. One of them came out at exactly 10 o'clock. That would be the JOLTS report, which of course I haven't seen, being sitting here at 10 o'clock.
We're
also getting a jobs report on Friday and a CPI and PPI inflation report next week. So those will be important and we'll scrutinize them. When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to come. They're going to be important in our assessment of the higher readings that we have very recently received.
Big grip here on SPY.
And of the overall direction of the economy and of our progress in bringing inflation down. And we'll be carefully analyzing them. Again, we have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
But you've also said higher longer. Is that still the case?
Yeah, so, and as I said in my testimony, we look at the data since January and also the revisions to the November and December inflation data, and they suggest that the ultimate level of interest rates is likely to be higher than we'd expected.
What are those economic factors?
So going back to January, as I mentioned, the softer inflation readings of November and December were revised up. We got a very strong inflation report for January. We got an extraordinarily strong employment report, very strong consumer
jump
spending,
on Webull
strong
or TD
manufacturing
Ameritrade
data
or
right
something.
across the board. And as I pointed out, some of that may have been affected by the very warm January weather, but nonetheless, all of it pointed in the same direction.
Right, his own
Okay,
data.
let's move to regulation. Chair Powell, in January, the Federal Reserve put out a policy statement noting that digital asset custody is a permissible activity if done in a safe and sound manner. However, if a bank can demonstrate to the Fed that it can conduct that activity in a safe and sound manner, the capital impact of the SEC's staff accounting bulletin effectively precludes banks from offering digital asset custody service at any scale. Are you aware of this staff accounting bulletin by the Securities Exchange Commission and its impact on custodial services?
I am aware of it. Of course, it's an SEC accounting bill. This is SAB 121, I think. And
That's right.
Certainly aware of it, and we do follow general accepted accounting principles in our
Yes.
capital regulation.
Okay, well, without objection, I'll submit to the, submit for the record my letter to the bank regulators about this. So while the Fed says it can be done in a safe and sound manner, the Securities Exchange Commission has regulated it so that it cannot be done. Next question is certainly about bank capital standards. You got questions about this yesterday. Chair Barr has announced a holistic review of capital requirements. As I said in my opening statement, there are a lot of questions about this process. And previous statements by members of the Fed governors about the adequacy of current capital standards. And so while the Vice Chair for Supervision has announced that the Fed will engage in a holistic review of capital regulation, is that Fed staff? Is that done at the, at the governor's, the board level? What is the process? There are a lot of questions that people have about his statements. And so we want to understand why it's necessary for the Fed to conduct a holistic review and what that process is. So, my general question is, do you still agree with your previous statements about the adequacy on a generalized basis of our financial system? Or are we to read into this that we're not adequately capitalized and there's a high level of risk in the system that we're unaware of at this point?
I'll take another shorter
Thank you. So the why really just is that as a new Vice Chair for Supervision, Vice Chair Barr has launched into, he's taking a fresh look at everything, including capital. That actually is typical of the last two people to have this job. So that makes a lot of sense. In terms of the process, it's certainly conducted under Vice Chair Barr's leadership with input from the staff and discussions with governors on that committee, and I'm kept broadly apprised about what's going on. But the bottom line is nothing has been proposed to the board. Nothing has been formalized at this point. It's a lot of work that's going on. I think discussions are going on, meetings with industry and that kind of thing. When we get to the place where that's appropriate, the board will be carefully briefed. Ultimately, we'll vote on a proposal, and that proposal will go out for comment, and we'll solicit comment from any and all commenters, and we'll look very carefully at that. So it'll be a wide open process in the sunshine.
Thank you. I yield back. Now recognize the gentlewoman from California, the ranking member, Ms. Waters.
Thank you very much. Chair Powell, I agree with what you said on February 1st, that Congress must raise the debt limit because of what you described as the highly risky consequences of failing to do so. You are perhaps the most important expert on the debt limit, which is why I find it very concerning that your recommendation to raise the debt limit in a timely manner is being ignored by my colleagues on the other side of the aisle.
Trying to find a better stream.
I'm also concerned that the consequences of this brinksmanship are imminent. Fitch Ratings said this week they may seriously look at downgrading the U.S. debt based on the escalating brinksmanship they are observing, even if Congress ultimately addresses the debt limit at the last minute. This is history repeating itself. Standard & Poor's downgraded our debt back in 2011 when Republicans last controlled the House and threatened default. The Bipartisan Policy Center later found that the 2011 debt limit debate cost us $18.9 billion in higher borrowing costs, even though we never defaulted. To put that into perspective, that could have been leveraged to provide up to $200 billion in loans to small businesses through the State Small Business Credit Initiative, or to provide hundreds of thousands of people down payment assistance to buy their first home. So I want to emphasize that House Republicans, including most of the Republicans on this committee, had no qualms about paying our debts when Trump was in office. 3 times they addressed the debt ceiling in a timely manner without holding our country hostage. But Republicans are ready to tear down the hard work of Americans everywhere to weather the pandemic and build back a strong recovery. Chair Powell, can you describe for us the risk you see if Congress continues to delay action on the debt limit, both for our economy and for individuals and families?
Let me start briefly by saying that we have no role and seek no role in what is really at the heart of fiscal policy, except I will limit myself to the two things that other Fed chairs have said about this. One is just that Congress raising the debt ceiling is really the only alternative. There are no rabbits in hats to be pulled out on this. Two really is just that no one should assume that the Fed can protect the economy from except I will limit myself to the two things that other Fed chairs have said about
moving
this.
around.
One is just that Congress raising the debt ceiling is really
Pretty
the
close
only
on timing.
alternative. There are no rabbits in hats to be pulled out on this. Two really is just that no one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here, but no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
Thank you very much. I don't want to miss what you said. I somewhat quoted you when you said that Congress must raise the debt limit because of what you described as a highly risky consequence of failing to do so. Is that your language?
Must in the sense that it's really the only way for the debt limit to be raised is Congress must act. Again, these are fiscal discussions, and we don't want to be a part of them, and really they're between elected officials.
But you are an expert on the subject.
Well, I spent a lot of time on this, as you'll recall.
As an expert on this subject, you are concerned about the high risky consequence of failing to do so. Is that correct? Did I correctly quote you?
That's correct.
Thank you. And so, again, let me just go a little bit further. The chair mentioned that he had either written a letter or maybe even had some conversation from Janet Yellen about the time limits that she had attempted to describe. Is it your understanding that she said she could maneuver and kind of manipulate things so that she paid the bills that were coming due, but this could only last until about June? Is that your understanding?
Honestly, I would really have to not try to interpret the Secretary's words for you. That's really up to her to do.
Can she keep us afloat until about June?
I don't, honestly. That's not for me to say. These are really questions for the Secretary. I'm sorry.
Have you had any conversation with her about the statement that she made about being able to manipulate the debt and pay bills that were coming due out of another account, et cetera? Did you have that conversation with her?
The conversations that you and I have privately don't go anywhere. I don't talk about them with anybody, and the conversations I have with Secretary Yellen, I don't.
Okay, and I don't want to get you in a...
Gentlelady's time is expired.
Objection.
The gentlelady's time is expired.
Did I have equal time with you?
You sure did. He went over time.
If I did, thank you. I yield back.
I now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas.
Gentlelady's time.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us. You're welcome anytime. Don't wait till we ask. If you want to volunteer and come, we love having your views on many topics. Thanks for talking about your commitment to price stability. You know, we've had this discussion last June between us of, I do think that's the primary mission of the Fed, and I think it should be the only priority of the Fed is price stability, because it's the legislative branch and the executive branch that really are responsible for, quote, full employment and having that policy environment and making sure that that's right. So your commitment to price stability is welcome.
She was going nowhere with it anyways.
Committee.
Just pushing you on private conversations.
Yesterday in the Senate, you suggested that you supported a regulatory framework, a broadly regulatory framework for digital assets. Is that right?
Yes.
And is it your view that if we had a regulatory framework here in the United States for digital assets, that there'd be more transparency and rules of the road for both consumers, investors, and developers?
Absolutely.
And would it, if we had those rules of the road for business seeking to use and develop blockchain as a potential new technology in their business and tokenized payments, that again, that would be beneficial to business to know how to go about that.
Yes, and to assure that it's all done in a safe and sound manner when we're talking about banks.
Right. And then my next point would be exactly that, to help banks, investment brokers, custodians understand how they could even participate in that market in a safe and sound manner. You agree that a regulatory framework would help on that?
Yes.
And then finally, we've grown up in our country, and it's unique in the world, that we have a dual banking system, and due to a quirk here in Congress over 100 years ago, we have insurance is regulated exclusively by the states.
Bounced, I think.
So would you believe that regulatory framework would also have to preserve some sort of role subject to safety and soundness, for states to play some role in that regulatory framework for digital assets?
Let me just say, I think that it certainly works in banking and insurance. I have no problem with those.
Right.
I'd have
But
to think
do
about
you think it could, you consider it possible that it could also work in digital assets?
Certainly possible.
Yeah. Thank you. Turning to a topic that's been a subject here for nearly 4 years, central bank digital currencies. Article 1 of the Constitution reserves coins and coin issuance, money issuance to the Congress. And we've in turn delegated that to the U.S. Treasury, which has, since 1912, engaged the Federal Reserve as their fiscal agent. You've testified here many times before that to issue a central bank digital currency, that would have to be authorized by statute by Congress. Is that still your testimony?
So that is absolutely the case as it relates to a retail CBDC. There are potential forms of a wholesale CBDC that we need to look at. It's less clear. But we've always been talking about retail CBDC, and that's something we would certainly need congressional approval for.
And what would be a parameter on something that's not a retail CBDC where you think that could be issued in some form or fashion without Congress's direct statutory authorization?
It would be, for example, it would just be something between banks, so it would look an awful lot like a bank reserve. And you might ask, well, why would we need it? And that's a really good question too.
Yeah.
But just something that's literally within a wholesale market.
But that speaks that you might have a blockchain between banks and the Fed using a central bank digital currency token to settle transactions institutionally inside yeah. Yes. So that leads me to FedNow, which is supposed to be up and running, I think, this summer, somewhat behind the scene there. I would like to ask you to formally have this full committee briefed on that by the Federal Reserve. I know
Thank you, Ace.
the chair of the
Appreciate it, man.
Kansas City Bank was involved. She's now left, and I think the
Updated
committee
that
has a
gift
lot
just for you,
of
buddy.
questions about FedNow, how its interoperability will work, how it's going to roll out, and also just a question that we've been asked that why the Fed wire system isn't up 24 hours a day, 7 days a week now to benefit consumers that are using Venmo. Do you have a thought on that?
I'm not sure why we're not 24/7 on that, and we, of course, would be delighted to come up and brief the committee on FedNow.
That'd be good. We'll take you up on that and the right person from the Fed. And Mr. Chairman, I yield back.
Gentleman yields back. We'll now recognize the the ranking member of the Capital Markets Subcommittee, Mr. Sherman of California, for 5 minutes.
Thank you. Mr. Chairman, I want to thank you for bringing to our committee's attention several years ago the importance of tough legacy LIBOR, some $16 trillion of instruments where the creditor wouldn't know how much the debtor was supposed to pay. This committee, we passed legislation over a year before the LIBOR hit the fan. You issued regulations 7 months before the absolute deadline. I hope we do this in other areas, and it's my understanding that with those final regulations, we're done, and we've solved the LIBOR issue. Is that correct?
That's my understanding as well.
Good. People talk about inflation, and they somehow say that it's a matter of the personalities and politics in the United States. Others argue that the entire world is hit by inflation because Ukraine and COVID. I think we've got the answer to this question in that inflation is considerably higher in the Eurozone than it is in the United States today. and it's very hard to say that Joe Biden is responsible for inflation in Germany. I commend the ranking member for bringing up the debt limit and the harm that's already done to our economy. If we solve the problem tomorrow, we had less investment than we would have had yesterday. And I would say that I commend the president. He's going to issue a budget plan tomorrow, and perhaps in their time, one of our Republican colleagues can tell us when the Republican budget plan will be released. We are all eagerly awaiting it. Housing is a huge part of inflation, and we've left it to local government, but the permitting process there guarantees scarcity, which guarantees high housing costs. Mr. Chair, we've talked back in 2001 and several times, even before that, about wire fraud. And having just bought a home, I saw the process up front. Everybody's very nervous about one thing, and that is, will the buyer of the house be tricked into wiring their down payment to the wrong account? Or will the seller, the buyer be tricked into, or the escrow agent be tricked into sending the money to someone other than the seller of the property? We talked about this back in 2001, where I urged you with your FedNow system, which I'm glad is on track to move forward, to have what the Brits have. When you send the wire, you identify not only the number of the account you're sending it to, but also the name of the person or entity that's supposed to receive that. At that time, back in 2001, you said that payee matching is not the best way to do it. There are other ways to do it, and that you'd be happy to get back to me as to how you're going to make sure that an email from a Nigerian prince does not get the wired funds, particularly in a housing transaction, wired to an account number that turns out to be in Lagos. What progress do you have? When can home buyers have a system where they're sending it to a named payee as well as to a number?
So I hope we did come back in a timely way to you on that. But it's a problem you've brought to our attention, you're right, over many years. And we continue to focus on that.
Well, the bureaucrats who are working on this don't want to do what the Brits did. They've proven it can be done. You said you were going to accomplish the same goal in some other way, and it has been a while, and it's not solved. Nor are you aware of any solution. Is this the right form for this question to be brought up? I would hope that you would go back and say, we don't want to add this anxiety to every real estate transaction. We go back to the drawing boards, follow what the Brits have done, and have payee matching. Finally, as to crypto, cryptocurrency says what it means. Hidden money. That's what it means. And if we impose know your customer and anti-money laundering statutes to it, it won't be crypto anymore. What crypto wants is to have part of its ecosystem above the waterline, visible and subject to know your customer, and then have the rest of the iceberg below the waterline.
Gentleman's time's expired. I will now go to the gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Chairman McHenry, thank you very much. Chairman Powell, thank you for joining us today. We appreciate not only your professionalism, but your direction at us. Chairman Powell, I know that the Fed considers divergences, and you talked about it as you spoke in your opening statement about consumer price index, personal consumer expenditures, inflation, GDP, and all these things are talked about in your report, monetary report, March 3, 2023. Thank you. A couple days ago, I had an opportunity to see that an economist, Arthur Laffer, produced a report that spoke about literally this country doubling GDP. Now, I know we're putting CPI, PCE, inflation, all these things into a mix. But he said that if we made changes in healthcare to efficiencies, we could double the current GDP rate. My question to you that I hope you can answer is, what do you think about that? Is that something that is in this document that I have missed? And it's seemingly to a person who follows this, as Art Laffer does for 50 years, what do you think is an important way to look at efficiencies in healthcare? Thank you.
So no, that's not in our monetary policy report. I'll just say one thing, and that is we do spend something like 17 or 18 in that range % of GDP delivering healthcare. Other similarly wealthy countries spend 10%. So it's the delivery system. It's not that the benefits are incredibly rich or anything like that. It's just that the delivery system is very expensive. That's $1 trillion a year that we spend and get nothing for it. This is fiscal policy, but I'm responding to your. So I would think that he may have meant that if we had a delivery system that saved that $1 trillion that doesn't really get us anything, then that would be great for the economy, which I would agree with.
So you've spoken of supply chain disruptions because it in fact is an inhibitor or an accelerator as we gain that advantage. You just talked about some seemingly which would offer some validation to Mr. Laffer as he spoke about the huge importance of this. Is that something you should start paying attention to where policy people, not only at the Fed, but your Fed banks around the country would start looking at and start putting pressure on us to gain those efficiencies as a result of a global view?
So on supply chains generally, they have suddenly been tremendously important in inflation, as you know, for the last couple of years, and for the first time really have been something that we've had to study carefully. In terms of healthcare delivery, that is strictly a question for you and for the parts of the government that are charged with it. The Fed does not have a role to play and does not seek a role in that.
Does not see a role. And yet, as I look at this, you've got a role in projecting confidence. You've got a role in education. You've got a role in who's in the workplace. You've got a role. Interest rates, and yet my point is, it's such a staggering number that impacts us. Just love to have you go back. Perhaps we from this committee need to give you some direction on that. But I think your testimony today, it recognizes the staggering impact on that. I don't think it's political. The answer may be political, but I think the actual numbers are not political.
I'll probably say
It's an
something hawkish here.
inefficiency that is happening across
We're
the
going to be
country,
behind the market a bit.
not a regional matter. And so I wanted to get your take on that, and I appreciate you being here as always. Thank you for your confidence and your hard work that you give this country. Mr. Chairman, I yield back my time.
Gentleman yields back. We'll now recognize the ranking member of the Agriculture Committee, Mr. Scott of Georgia, for 5 minutes.
Thank you very much, Chairman, and welcome back, Chairman Powell. Now, Chairman Powell, listen to me very carefully here, because I think we're on the verge of making a terrible mistake. Back in 2008, if you recall, Barney Frank then and Ms. Waters asked me to take a look and kind of work with you and the Fed. You were a board member in 2008. And we came to the conclusion that we needed a more equitable
UNG, natural gas coming down more.
field
I'll look for some more dip buys.
between our large banks, like Goldman Sachs, Citigroup, and our regional and smaller banks, like Truist and our community banks.
Televangelist.
And we changed that. But now I hear
Whoa, BY just flushed.
that the Fed and the
128.
FDIC plan to drop a new rule which seeks to apply the long-term and higher capital requirements that were created, and you and I did this back in 2008.
Yeah, 127's that low.
That were
Today might be the
created
day.
for the Goldman Sachs and for them. And now we want to apply these rules to the regional banks. There's a big difference, and we've omitted this difference if you proceed in this manner. I think it's very misguided. It works, and you and I worked on this. You recall this.
Don't
You
lose till
were
you
a
sell
board member.
Bears.
And we saw that we needed to have a better playing field to protect. And if you all go along with this, it could put many of our regional banks and small community banks out of business. So I want you to reverse this. First of all, tell me, am I speaking the truth? Are you all planning to all of a sudden
Confirmation of a reversal?
put these smaller and regional banks under the same heavy
All sorts of different ways we can get
financial
confirmation.
load as your large worldwide banks? Tell me.
No, we're not planning that. We
Well-
believe strongly and always have in tailoring to address the different size and risk characteristics of financial institutions, and certainly nothing like that for the regionals. They won't have anything like what the very large, most systemically important banks have in terms of overall regulation.
Yeah, because I remember clearly you and I were back, I think we were on this side then, talking about this in this same committee room. And you worked with us on that. I'm glad to hear that. Where is that coming from? I mean, it's a concern. It's just a rumor. Have there been any discussions about removing the playing field and the guardrails we have here, the differentiations in the requirements between the regional banks, community banks, and your larger global banks?
So
There's nothing to that?
Well, I would say this. We're required by the law now, and we're doing this. Dodd-Frank actually required us.
Yes, we did.
Suggested that we should tailor, and then the S2155 then required it. And anything that we do, we're
Yeah, I think this file keep coming down.
reflect appropriate tailoring.
There's not
All right,
crazy
so
response for the Q&A. I think once it's done,
that's off
it'll
the
probably
board.
keep selling off.
We're not going
Based on
to
a statement
change
yesterday,
and
I mean,
put
This
the smaller and regional
pricing in,
banks under the same
50 basis
financial
points and
obligation
potentially up into the
role as the large
6%
banks.
terminal. So
We got that right from you.
I don't think this is
correct?
priced that in,
Yeah,
just
that's right.
that one
All
day
right,
there. I
good.
think we've got
Now let me turn to
more down to go.
China. I'm really worried about China, and right now people may not
I've been
know
averaging
it,
into shorts on
but
lows, on
China is
highs.
the world's largest economy in terms of purchasing power. Now, at our last meeting, I talked about this move where
Yeah,
we
broke
didn't
138
blow
or
the
130.
balloon up.
128 we hit on BBY. 127 is the low
And this is an example of what I was pointing out.
from the
Gentleman's time's expired. We'll now
multi-decade
recognize the
low.
Chair of the Science Committee, Mr.
127.
Lucas of Oklahoma, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, I'd like to follow up on the topic of capital standards. One of those things we've discussed
You
many
know, it'd
times
save these
together.
guys a lot if they could talk
As
faster.
you know, commodity markets have been
They'd actually get to
have
say a
seen
lot more in their
significant
allotted time.
volatility in the last few years.
They should take speaking
And
classes.
during times of tremendous economic
Turn it up
uncertainty,
1.5.
we've seen end users turn to the markets to hedge risk, particularly those in the agriculture.
I mean,
and
Spike good to
energy
have a rip
sectors.
out of nowhere too,
I
based
know
on
that
his
the Fed
response.
is
So
early in the review process
sure it will,
of
but
potential changes in capital requirements.
just you got to be kind of careful when they're
Can
still
you,
talking because go either
Well, I'll
direction
ask
pretty heavy.
anyway. Can you commit to ensuring that these changes will not increase the cost for banks providing those commodity derivatives to end users?
That's a really
Yeah, we're about to
specific,
set a 52
can
week low.
Can I go look at that? I mean, I'm not actually
Multi-decade.
sure that the work even addresses that, so.
Fair
I'd be happy
point.
to come back to you on that.
And that particular response makes me feel better, because after all, those
It's
products
your
are very
favorite
important to
words.
my folks. And make a great deal of difference in how they're able to address their issues. So, as you discussed earlier, and as you've consistently assured, the Fed's not a climate-making policymaker. You and I have talked about this issue, again, many times in the past. However, I'm concerned that the Fed could be heading in that direction and could be laying the groundwork for climate-related stress tests that would reduce access to capital for entire sectors of the economy. This would also open up the Federal Reserve potentially to political pressure and force the Fed, in fact, to make policy decisions related to climate change. We've seen, for example, this administration turn to regulators to impose climate policy as an alternative to the legislative process.
Well, yesterday was a different.
Chairman Powell,
We
how
had the catalyst
careful are
yesterday,
you
so.
in ensuring that the Fed does not place itself into the climate debate? And how can Congress ensure that the Fed's regulatory toolkit is not, shall we say, warped into creating climate policy outcomes?
So I think we do have a narrow but real role there, which is around bank supervision, making sure the banks understand.
It's a good deal to some people.
Their risks over time from climate.
Maybe not everybody.
I think my colleagues and
What
I
you sell,
all
I buy. What I buy,
understand
you sell. That's a
that
market.
It's a tightly circumscribed role that we're playing, and that we're
Part-time
not
divorce.
looking to, move into an area where we're actually becoming a climate policymaker. I would completely agree with you, though, that over time, that border needs to be very carefully guarded. And I will tell you that I will do that as long as I'm at the Board of Governors.
I very much appreciate that because, again, it's a very important issue to the 3rd District of Oklahoma. Traditional production agriculture, oil and gas, and the actions that the Fed takes have a significant impact back home. So it's vital that we resist the demands to do that sort of thing now or in the future. And I very much appreciate that response. And with that, I'll yield back the balance of my time, Mr. Chairman.
Gentleman yields back. The gentleman from Massachusetts, the ranking member of the Digital Asset Subcommittee, Mr. Lynch, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, and for your willingness to come here and to update us. Last week, the Treasury Department announced that leaders from Treasury would begin to meet regularly with leaders from the Fed and from the White House to discuss a possible CBDC, central bank digital currency, and other payment innovations. In the statement, it was mentioned, and I'll quote from it, it said that the Fed is encouraged to provide periodic public updates as it continues its research and its technical experimentation on central bank digital currencies. I was wondering, first of all, when you might be expecting to share some of these public updates. What's the timing on that?
So we did go out for comment in general on a CBDC a year or so ago, and I do expect we'll go out. I can't give you a date, but we'll certainly go out and engage. We engage with the public on an ongoing basis.
Yeah.
We're also doing research on policy and also on technology. That's what we're up to.
I'm aware of the Boston Fed has a partnership there, the Hamilton project over there with the folks from MIT Media Lab. They're doing a great job. But, it says here that the discussions would include technical experimentation. I was just wondering at what level are you talking about making decisions on architecture for a CBDC, a retail CBDC?
We're not at the stage of making any real decisions. What we're doing is experimenting in kind of early stage experimentation. How would this work? Does it work? What's the best technology? What's the most efficient? We're really at an early stage but we're making progress on sort of technological issues. The policy issues are equally important, though. We haven't decided that this is something that the financial system in the country want or need.
Right.
So that's going to be very important.
Right. Well, I think I speak for the chairman as well. Would love to have more dialogue with the Fed on that, and maybe bring in the folks from MIT as well, and just make sure that Congress and this committee is as up to date.
Oh, there's 127 on BBBY.
As others. Let me switch over to Fed now. There are some champions of digital currency and stable coins in particular that continue to cite the need for faster payment systems. However, as was earlier mentioned, the Fed Now is a service that the Fed is working on to finalize that will allow for instant payments between bank accounts. And the Fed has a target release date for Fed Now between May and July. which is right around the corner.
Well.
Do you see any reason why cryptocurrencies would provide faster payments than the FedNow system?
Could not believe my eyes.
Would this offer,
I
with the
can't believe it's
transparency
butter.
of FedNow, would it offer distinct advantages over some of these stable coins that are
Hey, trader.
touting faster payments?
So
What FedNow will do is it will enable
Bath hit
all
that
the banks,
low.
any bank in the United States, not just the
Very
big ones,
possibly could
to
go
offer
below it, and then
instant,
we'd
you know, instantly available
potentially
funds
getting
and
our
real-time payments
divergence,
to their
which
customers. That's what it will do.
would be a
That's
good
a
sign
great
of
thing.
a
You know, a
reversal.
CBDC, I
Better
think
than
you're
just
asking
a
whether
engulfing
a
candle.
CBDC would serve some of that, but a CBDC is going to
MACD
be
wants to
years
flip
in the
bullish, even with
evaluation.
how much we've come down
And,
today.
you know, I think we can get this into the hands of the public very quickly, and I think we'll have real-time payments in this country very, very soon.
It's actually odd.
And so that's a good thing.
It is.
It's strange
You know,
looking.
I do have an overriding question, and that is, you know, before the greenback, everybody had their own currency. You know, you
TBD.
had rail companies, you had coal companies, you had, you know, state banks that were authorized to issue their own currency. But when the greenback came out, all of those various currencies went to zero because everyone had, you know, because the greenback had the full faith and credit of the United States behind it. I'm worried about a lot of these stable coins and other cryptocurrencies. Do they go to zero when we come up with a CBDC that has the full faith and credit of the United States behind it? And
That
you've
gas looks
got
like it's
thousands of
double
these out
bottoming
there,
on the
and you've got
5-minute.
people investing millions and millions of dollars in these, well, trillions right now. And I'm just
CBD.
thinking, if we had those advantages built into a CDBC, wouldn't those alternatives go to zero if they did not have the transparency and the full faith and credit that we enjoy?
So certainly
Nice head and
unbacked
shoulders here on AMC.
cryptocurrencies that don't have any intrinsic value, but nonetheless trade for a positive number, those I've never understood the valuation of
Yeah,
those.
I bet that gap gets
Stablecoins
filled
are
on
actually,
AMC.
many of them are really,
408.
they're drawing on the credibility of the dollar. They have dollar-based, they're dollar-denominated mainly, dollar-based reserves, although we don't know what's in the reserves because there's no regulation.
Gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes, the chair of the National Security Subcommittee.
Thank you, Mr. Chairman.
All biz
Thank you,
bouncing
Chairman
here.
Fowl, for being here this morning. The reserve currency status of the dollar
Starting to rip.
to the U.S. has enormous financial and national security benefits. In the wake of Russia's unprovoked invasion of Ukraine, the Fed took action to prevent the Kremlin from accessing
Venus
more
holding.
than $300 billion in reserves, roughly half of Russia's reserves. However, this led to an accelerated effort by countries like China to de-dollarize their official foreign exchange reserves. Just last week, there was an article in the Wall Street Journal titled, "Russia Turns to the Yuan in an Effort to Ditch the Dollar." Not only that, but China's President Xi Jinping pushed for the settlement of energy trades in the Chinese yuan at a summit with Arab leaders in December. The question is, are you concerned about these actions by Russia and China to establish different reserves and conduct transactions in non-U.S. dollars?
So the U.S. dollar is the widely accepted and really the only serious candidate for the world's principal reserve currency, and that's because of our democratic institutions, our liquid markets, the rule of law, and all those kinds of things, and also the fact that the dollar has held its value over time. So other countries who are competing on other playing fields may want to establish different currencies, but really the dollar is the one that's going to be used more broadly in international commerce because we have those aspects and other countries don't.
Well, that's true to now, but my question is, are you concerned about the actions of these countries because if they see themselves being challenged or are concerned, for instance, if China would invade Taiwan, as Russia invaded Ukraine, there were some sanctions put on, and I don't disagree with the sanctions. The last time you were here, though, Mr. Chairman, I asked the question, because it's an instructive moment for us, from the standpoint that knowing that we put sanctions on Russia, all their different accounts, as well as the oligarchs from that country, are we thinking about doing the same thing to China when they invade Taiwan? And your answer at that point was no. We passed a bill out of this committee last week to ask the administration, basically, to start thinking about that in those terms. What kind of situations can you come up with? Are you talking to allies, begin to talk to them to start putting together
Yeah, I'm starting to go
a
long
list
here
of
on
how
that
you would
gas.
go about sanctioning the different individuals, the different
Got an order for one
accounts,
more.
things like that. So have you started thinking about that at all yet?
Well, let me say,
Not sure how
the
much
business
lower
of
this goes.
sanctions is entirely in the hands of the elected government and the Treasury Department. We are an implementer as it relates to banks. That's it.
Yeah,
We
but
don't make those
we're going
decisions.
to
We're
take
not
your advice
consulted
on
those.
different aspects of this. Mr.
Sorry?
We're going to take your advice on the different
Oil's still
aspects of this.
dumping.
Well, I mean, honestly, when the sanctions
Oil's
were being put
rallying.
in place, the
Market should
Treasury
come
was
down,
doing it.
I
We
would
weren't
imagine.
doing it.
Okay.
I mean, that's the way it works.
Probably have to wait for this to be over.
Next question. There was an article again in one of the political newspapers yesterday, I guess it was, and it talked about the problem that we have here with the Fed's balance sheet. It says it now appears similar to a hedge fund whose long-term assets are financed by short-term borrowing. And the bottom line is that
earnings.
It's going to cost money. The Fed now has a negative income as a result of having to do this. And so it says here that the Fed will simply borrow the money to pay the bills. Is this true? That the Fed's losing money right now?
Actually, no bid support on BBY until $1.50.
The borrowings
So,
that you've
probably break this
purchased,
low here.
structured?
The place I would start
can make
is
it to $1.50.
that the Fed has, we always turn over all of our earnings in every year. We turn them over
got
on an ongoing basis. And we've
1160
turned over
as a
something like
support.
$1.2 trillion
And then 88
in earnings
cents.
just in the last, decade or so. So we always know that when,
Retail fired up.
when we raise interest rates,
Okay.
you're going to lose money.
Okay,
And
it's
so
rallying
you
a little
agree with
bit.
the point that we have a negative income right now.
That's
And
right.
this makes my point to my next question, or my concern is, the CFPB gets their money. The CFPB gets their money to run their agency from the
He's going
Fed.
up with the SPY.
So basically, there's no money for the Fed to pay the CFPB's bills if this is the case, unless you continue to borrow,
116.
which is basically what's going to happen now, is you're going to have to
Just
borrow
behind
money
like
to
IPO
be able to
day.
pay the CFPB's bills.
I don't
Is
know
that
if these
not
levels
correct?
matter
We
anymore
don't
since
borrow
it's so
money.
long ago, but
We issue, basically, yes, we
There's
can,
no
we
other
can,
way to-
we don't
no other
shut
levels
down
to
the
look
Fed
at.
when we have negative income.
Okay.
We can pay our bills and we can pay.
So my
the
question,
CFPB.
my follow-up question then is, do you do any accountability or assessing of the CFPB's spending of these dollars at all?
see this right here, 116.
No, we don't.
So they just get a
Inspector
blank
General-
check.
88.
You just told me they just got a blank check. They send you a bill, you send them a check. There's no accountability for them.
I think there are limits built into the law, which I don't have in the front of my head.
I don't
I've yet to see a limit.
Someone's
Mr. Chairman.
holding
I'd love to
BY
see
from
what the limits are,
1982.
Because I don't think that they've ever agreed that they have that.
God
But I
bless
see
them.
my time is up. Mr. Chairman, I yield back.
Gentleman's time has expired. We'll now go to Mr. Foster, the ranking member of the Financial Institutions Monetary Policy Subcommittee.
Yeah, I saw Tops
Thank
was
you.
rallying
And
a
just
bit.
a quick comment. I think it's a mistake
I got
to
out.
imagine that you can completely
Basically
hide from the
back to where I bought it, I
macroeconomic
think.
effects of technology in your scenario planning. We just talked briefly about healthcare costs. Obesity, half of our healthcare costs, and there are treatments in these GLP-1 receptor agonists
Might be.
that
It
look
looks
like
pretty good.
they're just a home run against obesity. And so these will be near-term impacts which will have macroeconomic effects. So just a comment. I hope you have a certain fraction of futurists in the room when you're talking about your
1992,
scenario
not
planning,
82.
because a lot of that future is like now. Okay,
Exit
back to
strategy.
economics. So we have this historically low unemployment rate.
Once it goes below your cost
3.4%.
basis from the
And
90s,
historically, this would
then
be
you exit.
considered to drive runaway
Thank you.
inflation. Your predecessor, Alan Greenspan, repeatedly referred to dangerously low levels of unemployment. And yet we see inflation is coming down.
Yeah,
so
I don't-
what is going on here? How can we have these historically low levels of unemployment without having inflation take off? Is it possible that we simply have less frictional unemployment in our system, due perhaps to the fact that people get their new jobs online and have a job lined up before they quit?
So inflation is coming down, but it's very high.
Yeah, that's what I was thinking.
Some part, I've never said all of it or most of it, but some part of the high inflation that we're experiencing is very likely related to an extremely tight labor market. Wages affect prices and prices affect wages, so I do think that's part of it. More to your point, though, there was a time when there was a tight relationship between inflation and unemployment. In other words,
I
the
think he's
Phillips
keeping
curve
his
was
cool.
steep, and that went away over the period of the great moderation. And really, in our thinking, that's because people came to expect
Got a little
2%
ruffled yesterday,
inflation,
but
and we had 2% inflation.
he's very
and people
emotionally
just
mature,
stopped
I'd say.
focusing on inflation, and it stayed very low. So there was really no relationship, or very, very tiny relationship. We could have very weak economic growth or very strong economic growth.
600,000?
And we wouldn't have inflation respond very much.
What L2 are you looking at?
That was
Barrett?
before the pandemic.
I see 150,000 on the one.
Well,
at
I hope you
127.
don't overlearn, some of the lessons there. It's one of my worries, that there've been a number of exogenous shocks to the system here, and it'll take a while to go through them, and if, you want to be careful there. Now, in a related issue, when you say refer to the totality of factors, you're looking at a mixture of leading and lagging indicators when you look in this totality of factors. And my question, if perhaps you might be paying too much attention to the lagging indicators and not enough to the leading indicators. The example that's referenced, the reference in your remarks and is in more detail in the report about the difference between using current rental payments versus the amount that you pay for a new rental contract, in difference in how much they lag. Had you paid more attention, for example, to the leading indicators like current rental contracts, then you probably would have picked up inflation earlier. You would have been, not gotten so far behind the curve on that. And secondly, there are policy implications going forward. If you look at current rental prices for new contracts, we're much farther along.
That gas moving up did double bottom there.
And that you can take your foot off the brake. And so what's your thinking on that, and whether you may perhaps be systematically not paying enough attention to leading indicators versus lagging ones?
So we've had our eyes on the whole housing inflation thing from the very beginning, and right now what I would say is that
there's an order for 260,000.
Every forecaster is baking in lower rent increases. That's a big part of why people think inflation is going to come down in 2023.
But what strike, Moon?
The thing with transitory was more had to do with goods, and it had to do with the thought that these supply side disruptions would go away
one more little
quicker
low.
than they would, that
the
the labor
divergence.
market disruptions would go away much quicker than they did.
It's a nice flush
And
wick.
in hindsight, it just took much longer for those disturbances to go away.
Yeah. So with hindsight, and if you, allow yourself to Monday morning quarterback yourself, you probably would have gone up to 4% earlier and not had such a big problem with inflation. And so what is your, are there structural things you can contemplate or even after action reviews to say what would have happened if we would have paid more attention to the leading indicators or improve the band in engineering term?
No, there hasn't been real trading.
Feedback
They're just getting barcoding and
that this is something, if you want to get the best result, you need a high bandwidth feedback in the system, even when there's averaging on the back end.
So this is something we only think about during waking and sleeping hours, as you can imagine. It's really hard to know what the lessons are. Again, we really thought things would. Nobody had seen the supply chains collapse. No one had seen labor force participation plummet. We didn't know, or unemployment go to 14% and higher than that, really. We didn't know how long it would take to go away. And if we ever see this pitch again, we'll know how to swing at it. But it's been
we'll now recognize
pretty bunch of firsts. Sorry.
Gentleman's time has expired. The gentleman, his time has expired. We'll now go to the gentlewoman from Missouri, the chair of the Capital Markets Subcommittee, Ms. Wagner, for 5 minutes.
Hi, thank you, Chairman McHenry. And Chair Powell, welcome. Thank you for your service and for being here today. Yesterday, I was pleased to hear you discuss how inflation is severely hurting the working people in America. In your testimony, you also state that strong wage growth is good for workers, but only if it is not eroded by inflation. And that is key. Inflation is a tax, a hidden tax on every American. If the Federal Reserve were to shirk its mandates to stabilize prices, leaving inflation alarmingly high, what would it cost America's hard-working families in Missouri's 2nd Congressional District and beyond?
So I think the costs of failure to restore price stability would be extremely high, and while there will be costs to success, the costs of failure will be much higher. You'd be looking at an extended period where people learn to expect and live with high and volatile inflation, and it's very, very hard to have rising real incomes during such a period. So it'd be a bad thing for the country.
Can you reassure the committee that the Fed remains committed to bringing prices down for our constituents?
Yes, I do.
Thank you.
I hereby assure you.
And changing topics here a bit, as China's economy reopens and about 18% of the world's population resumes its consumption of oil and other key goods, what sort of inflationary impact will we see here in the United States, sir?
So a stronger, a faster reopening of China, which it looks like we may be seeing, it does have the potential to put upward pressure on commodity prices, but it also would mean a faster sort of unraveling of the problems in supply chain. So those would be offsetting effects. I think sitting here today, we don't expect the net effect to be big for the United States. It might be bigger for other parts of the world, but we think it ought to be moderate overall.
Well, China is one of the world's top oil importers. And do you expect any inflationary effects on global energy markets as China's oil consumption returns to their previous levels?
So I think oil prices could be affected, and I think that's a big concern in Europe, for example. We have our own domestic oil, and we've got a lot of natural gas as well.
We sure do. I wish we were actually harvesting more of that liquid natural gas.
I mean, it's cash.
Chair Powell,
debt.
you, Vice Chair Barr, and many others have recently identified that
that's
the
a good point.
banking system is well capitalized
cash.
and strong. Bank capitalization remained robust during the shock of the pandemic
Price for
and related
bankruptcy, so-
shutdowns of economic activity. Capitalization of large financial institutions weathered severe stress testing mandated by the Fed. And despite all of that, as also previously mentioned by Chairman McHenry, Vice Chair Barr insists on conducting a review of capital rules. I'm concerned that this review is being conducted in a silo and that the findings will not be made fully available to the public. Taking such an approach in the context of this holistic capital requirement review would make it impossible to conduct a transparent rulemaking process, denying the public information necessary to consider and to comment. I think this is just simply not appropriate in this situation, and I'm concerned by the lack of clarity, I think is the best word, perhaps at this point, by the Vice Chair. A couple questions. You've served on the Fed board for over 10 years since the financial crisis regulatory framework has been put in place. And over that period, have you seen any real-world evidence that America's banks are undercapitalized?
So American banks are strongly capitalized, and I believe Vice Chair Barr has said that as well. But
Yes.
the point is there haven't been any real proposals to evaluate yet, and when there are, that will be done in a highly transparent manner.
I hope so. I'm glad to hear you say in a highly transparent manner. Do you agree that excessively high capital levels constrain banks'
He's not serious.
lending capacity with spillover effects on jobs and living standards for Americans?
So I think it's always a balance, right? More capital means more safety and soundness and more ability to withstand terribly stressful periods. But it also, it's more expensive. Equity capital is more expensive. U.S. banks have competed incredibly well around the world.
Yes,
with
they have,
high levels of
internationally.
capital. But so that's a trade-off that you're always going to be making when you think about capital.
Gentlewoman's
My
time
time
has
is
expired.
expired. Yes, thank you.
We'll now
Madam
recognize the gentlewoman from Ohio, the ranking member of the National Security Subcommittee, Ms. Beatty. Ms. Beatty, for 5 minutes.
Thank you, Mr. Chair, and I like that title. To Chairman Powell, thank you for coming and being such a good colleague and friend. I have a couple questions I'm going to try to get through quickly. Chair Powell, in a press conference last month, you stated, quote, "There is a lot of spending coming into the construction pipeline, both private and public, and so that's going to support economic activity," end of quote.
I mean, what you mentioned about nat gas
How
wasn't.
do you think the strong pipeline
Move it, I
of
guess.
funding from what the Democrats put
I think we're
together
gonna
in
get a flush.
passing the Inflation Reduction Act, the Infrastructure
A bounce.
Investment Jobs Act, and the
Maybe in the
CHIPS
same day.
Science Act will do to have economic activity this year and moving forward?
So I guess I was making the point that there are a lot of sources of demand that we can rely on, even though demand has been relatively increasing at a relatively modest rate. Part of it is
will this help in that demand?
Yes, I mean there is state and local governments I mentioned are about.
So would you say this is a great thing that we've done? Coming from the left over here.
Not for me to judge the merits of what gets done, but I'm just saying there's.
But it will contribute.
There that will support
it. And support it. Yeah. So I'm going to assume from that that's a positive. Let me go to the second question.
Ops new high there.
Chairman Powell, the Federal Open Markets Committee is projecting that unemployment will increase to 4.6% by the end of the year, and those costs, as we know, won't be borne equally. If we look at the ratio from the last time unemployment was 4.6% and compare it to our numbers now, it would mean that white unemployment would go up to about 0.9, but black unemployment would go up by 2.3%. Does that sound somewhat accurate to you?
Yes.
Can you address the disparity impact with that? And before you answer, let me go to the book, and thank you that was put at our places together. You made in this book with your signature on it is stated, however, while disparities in unemployment have largely returned to pre-pandemic levels, there still remain significant disparities in absolute levels of employment across groups like African Americans and Hispanics. So can you address that?
I can. So right now, to your point, actually, African-American unemployment is, I think, 5.4%, which is just about as low as it's been since we started tracking it in 1972.
But differential from majority
by... I'm going to say, so that's 5.4, whereas the overall is 3.4, and that includes blacks, so that means for whites is well lower than that. What happens is, so there's a persistent gap between black and white unemployment, and also, when unemployment goes up quickly in a recession, it goes up much faster for African Americans. When the economy grows again, it comes down faster. So that's just that's somehow embedded in our economy. We don't really have the best thing we can do is achieve stable prices so that we can have long expansions. And what happens in those long expansions is that the labor market gets tight, sustainably tight. And we have historic lows in unemployment, including for African Americans.
Let me say thank you, and let me also again thank you. As you know, in the 117th, I was the chair of the D&I committee, and let the record state that you always pushed for making sure that you understood and respected that. And in that, this is very minor and certainly personal to me. In this report, maybe those who helped you author it, I would like to see the areas that talks about unemployment not under a title of special topics, but something that draws a little more attention to it as some of the others, just very minor. Last question I have. Can you tell me if the Feds is committed to working with the other agencies like the FDIC and the OCC to finalize a rule soon on CRA? Certainly that's something of great interest to many of my colleagues. So can you give us any updates on it, or how the process is going, or what we can expect?
Well, it's going up and down.
So with Governor Brainerd's
to me, it looks like consolidation after sell-off,
which Chair Barr to take the lead in.
If the momentum continues, it's down, which is what I'm betting on is going to keep going down.
That there's essentially agreement between the three banking agencies on
a longer time frame.
Changes to be made. That's
couple
all
hours. I don't
written
know.
up and vetted, and at a certain point, members of the Board of Governors will be briefed on it. We'll vote on it.
Is there anything we can do to help with that?
No, I think we're hard at work on it, and it's going to take some months, but I think we're nearing the. We can see the airport, and we'll be landing in a few
Gentlewoman's
months.
time has expired. The
Thank you.
gentleman from Kentucky, the chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, is recognized for 5 minutes.
Thank you, Chairman McHenry. And Chairman Powell, economic data are mixed, as you know. On the one hand, low unemployment, robust hiring, strong consumer spending, and persistent core inflation, and a CPI that's still more than 3 times your 2% target suggests more aggressive tightening is warranted. On the other hand, because the Fed misjudged the inflationary impact of Democrats' overspending kept interest rates too low for far too long, and failed to end quantitative easing soon enough,
BBBY.
the Fed has been forced to raise the Fed funds rate
129.
450 basis points in just 11 months
130.
and reduced the M2 money supply at the fastest rate since the 1930s. As a result, wage gains have slowed, credit card
get our
debt is at an
flush.
all-time high, the housing market is in a slump, and the yield curve is inverted. I agree with you that the historical record cautions strongly against prematurely loosening policy. But what would you say to those who caution about the lag effects of monetary policy, the precipitous decline in liquidity? Will the economy have to suffer a recession in order to bring inflation down to 2%?
We are very well aware of the lags with which monetary policy affects economic activity and inflation. Those are long and variable, and I would stress highly uncertain. There is really no agreement on exactly how long they are, but we know that slowing down the pace of rate hikes this year is a way for us to see more of those effects as they come in.
In December, most Fed officials expected to lift rates this year to between 5 and 5.5%. Is that still your estimated terminal rate, or does the data suggest that the terminal rate could be higher than 5.5%?
My colleagues and I will write down new forecasts and release them to the public on March 22, but as I mentioned in my testimony, the data we've seen so far this year suggests that the ultimate level of rates will need to be higher. But we still have some more data to come in between now and the meeting, but as of today, it suggests a higher level than that.
Let's go to Vice Chairman Barr's review of the capital framework. A lot of questions for you on that. When Governors Brainerd, Quarles, Clarida, Bowman, and Waller made up the board under your leadership, major changes in policy were addressed following board consensus and not when there was significant dissent. Will you commit to not implementing a new capital framework following this holistic review or the Basel Endgame if there is considerable dissent from the board?
I can't really commit to that. You know, we are a consensus kind of an organization, and that's what we'll work toward. But ultimately, you know, we
Would that be a break from your prior practices? You're a consensus builder, Mr. Chairman. You pride yourself in that, and we credit you for being a consensus-oriented chairman. Will you commit to continuing that practice and not allow major changes to the bank capital regulatory framework to be made by one person?
Well, they can't be made by any one person, but I do commit to that, and I commit to doing everything I possibly can to bring people together in consensus, to have something that can be broadly supported.
Thank you. Earlier this year, you said, and I quote, "We are not and will not be a climate policy maker." However, in the Fed's draft principles on climate-related financial risks, one proposed principle suggested that boards of directors or of a financial institution should consider making changes to its compensation policies to align with values in the context of supposed climate risks. It appears then that the Federal Reserve, through regulation, wants to begin implementing climate policies.
Things going bankrupt.
So which is it? There seems to be a disconnect between your statements publicly and the rules that the board is putting forward for comment.
That's a good point, Trader.
Well, I feel strongly that climate change is an important issue that needs to be addressed by elected people. It's just not something that we've been charged with by Congress, clearly. So we do have a narrow role, and that role will be around making sure that banks understand and can manage the risks that they're running, and that's going to be it. And I, as I said before, we don't want to drift
down here a bit.
Climate policymaker, and we'll have to guard that border very carefully.
Regarding the Fed's climate scenario analysis pilot program, did the board vote to approve the creation of that pilot program?
I have to check, but I don't think so. I think it was already authorized.
And this is a concern that I have. I'm concerned that one governor acting unilaterally to implement major policy changes without board consensus is a problem. And so I would urge you and your colleagues on the board to continue a consensus-oriented approach, and I yield.
Gentleman's time has expired. We'll now go to the ranking member of the House Intelligence Committee, Mr. Himes of Connecticut, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Thank you for your careful conduct of monetary policy, independent of the many political desires that circulate in this building. Independent monetary policy is a bedrock of a solid economy. I want to reflect for a moment on another bedrock of the American economy, the full faith and credit of the United States government, which is now being put at risk by the Republican majority. My Republican friends know how very dangerous a game they are playing. They know that salary payments to our soldiers are at risk. They know that their irresponsibility will raise mortgage rates for new home buyers. But they say this is the only time we focus on spending in the debt, which of course is baloney. It's a pernicious form of baloney. The time to focus on the deficit is when you are voting for the spending and the tax cuts that create the deficit. When you're voting for the Trump tax cuts, which the CBO said would add $2 trillion to the national debt, that's the moment to consider whether you want to do that. Not when the good name of the United States is hanging in the balance. This stuff gets a little complicated, but the American people really need to understand what's happening here.
Thanks
Congress
for
sits
dealing with all
down
the political
to
jargon,
a huge 10-course
and then
meal
just
of
goes
tax
on
cuts and spending
to
and
feed
more defense
political
spending
jargon.
and expansion of this program and stimulus, all of which we vote for collectively. First course, second course, white wine, red wine,
Thanks
4
for dealing
servings
with
of
me.
dessert.
Now here I go.
And then the bill comes and my Republicans say, whoa, 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 wait a minute, hold on, look at this bill. This is irresponsible. Do we really want to pay this bill? That's not the moment for the consideration. The moment is when you're
BBBY
ordering
just
4
popped
helpings of
the view
dessert.
up there.
That's when we should be talking about it and taking
Converting spy
responsibility
here.
for the choices that we
Cursing.
make without putting the full faith and credit of the United States at risk. Now here's where the hypocrisy comes in. My Republican friends like to point the finger at this side of the aisle and blame us. But Chairman, as you know, fully 1/4, 25% of today's United States debt
Did you ask me a question?
was accrued in the 4 years of the Trump administration. This country's been around for 246 years, and fully 1/4 of the United States debt was accrued under President Trump. By the way, speaking of hypocrisy, in the 4 years of President Trump, the debt ceiling was raised or suspended 3 times. I didn't even notice. But now, of course, we have a different president, and so the calculus is different. Now, Mr. Chairman, I don't think I'm going to persuade the majority to act responsibly here. I actually think the markets will persuade them. And you'll recall, because we were watching this closely, September 29th, 2008, the Republican House of Representatives voted down the Great Recession Rescue Package. As the vote was going down in the House of Representatives, the equity market dropped 7%. $1.2 trillion lost in people's retirement accounts. Now, Congress sobered up, and a couple days later, we passed the Rescue Act. So, Mr. Chairman, there is a question here, and the question is this. You and I both watch the markets pretty closely. Treasury tells us that on June 5th, that's just 3 months away, on June 5th, the Treasury runs out of money. So my question to you, Mr. Chairman, I know I'm asking you to be a little speculative here, but what should we watch for? What market signals could indicate that the markets are getting fed up with the manifest irresponsibility around this?
Thanks for your likes, guys. I
Give us
appreciate
some
it.
things that we should be looking for.
Powell, testify here. Spies
And I'd
coming
love
down.
to, but I'm going to limit myself to what other Fed chairs have said about the debt
37
ceiling,
thumbs
which
up.
is
That's
that
awesome.
It does need to be raised by Congress in the end. There are no rabbits in hats, as I mentioned, and also that no one should assume that we, the Fed, this is the Fed's business, is to protect the economy from various events. And you know, I wouldn't assume, no one should assume that we have the tools to protect the highly uncertain effects of that kind of an event.
Yeah, NatGas settling down a
So
bit.
monetary policy is obviously very concerned with interest rates. If global capital markets begin to decide that we're really serious about hurting ourselves this time, is it possible that we could see interest rates rise more because borrowers of United States debt decide that we're actually a little risky? Is that possible?
I think that and many other things are possible. The thing is, we've never crossed that line, and if we cross that line, we're going to find out, and I think it's highly uncertain.
Okay, so that's possible, and you know I don't like pressing you on these things, but you said this and many other things are possible. You want to elaborate on what might be in the category of many other things?
Rather not, actually.
Okay. I figured. All right, thank you, Mr. Powell, again. I really thank you for your really responsible conduct of monetary policy, and there's a reason that you are insulated from our political desires, and I very much appreciate that, and yield back.
Gentleman yields back. We'll now recognize the chair of the Small Business Committee, Mr. Roger Williams of Texas.
Thank you, Mr. Chairman, and Chairman, it's good to see you. Always good to have you here. In past congressional testimonies, you've repeatedly stated that you support protecting the state-based system of insurance regulation, which is the most effective and competitive in the world. In my home state of Texas, is the world's 7th largest insurance market, proving the success of this system. Now at the International Association for Insurance Supervisors Conference in November, there is the opportunity to have the U.S. state-based aggregation method become formally recognized as comparable or equivalent to the insurance capital standard. We should not be following the European model that has increased regulations and less competition, and we should prioritize a model that encourages deregulation, competition, and less government involvement in pricing. So my question is, Chairman, can you highlight the benefits of the U.S. state-based aggregation method compared to the European model regarding market resiliency and systematic risk? And can you confirm that you will push for aggregation method to be deemed equivalent by the IAIS?
JNS is coming back down.
I can say this, I do think that our insurance regulatory system has proved itself appropriate and adequate and gotten the job done for a long time, and we don't need to be copying other countries or other regions' insurance regulatory system. I'm a little rusty on the details of the capital requirements, but that sounds right.
But our bottom line is our side works, the other doesn't. We need to stay where we are.
Our side works.
Yeah, thank you. Also in the past, you stated that banks were well capitalized. We've talked about that today, but now there have been increased conversations about raising capital requirements. Numerous economic studies have found that raising capital requirements for banks will increase borrowing costs for their consumer and commercial customers, and I'm somebody that's owned 50 years. I've never had a day I wasn't out of debt. So this.
I mean, BBY,
implementing additional regulatory capital requirements will slow economic
give it
growth
some time to see if
and
this is
limit
a double bottom
financial
here.
institutions' lending ability. So do you believe that raising
day-to-day tomorrow
requirements
green,
would
we
raise
get
the
bounce.
cost of borrowing and add cost to our economy and Main Street America?
Basically show
Well, it depends on
upside.
which banks
Then yeah, you'd say that's a double
experience
bottom.
higher capital requirements.
So we hit
There isn't
127
any
again. It's
proposal to
literally a
evaluate
double
right now,
bottom.
of course, but it's always a trade-off. You know, higher capital is good in a sense because it keeps banks able to lend during bad times. That's really a good thing. Too much capital, though, probably limits credit availability. So we're trying to strike that balance.
Lock-ins on profit on what?
And this has been touched on a little today, but let me come from a different angle.
Tops is ripping.
The Reserve was
Just broke
created to act
$1.
as a nonpartisan
He's gonna
entity
get
that
halted.
remains separate from party politics. Talked about that, and unfortunately, throughout recent
Got a
years,
gap
the Fed
fill here up
has
to
gotten caught up
130.
in politically charged issues like economic inequality, gender and race
should have held this
discrimination,
one.
and climate change. Recently, the Federal Reserve Board proposed guidance on managing climate-related risks for large banks, further proving that the Fed is giving in to some political pressure and operating outside its intended purpose and responsibilities. So our country's financial leaders, in my mind, should be focusing on
BBY does
aggressive
this stuff in the
runaway
after
inflation,
hours, so
instead of worrying about the
can
financial
even
institutions are
close
doing
the
to
after
monitor
hours.
climate change.
You're not looking to hold it.
And we touched on this a little bit, but how can the Fed ensure that they're not placing undue
you might
regulation
get a
and
127
guidance
fill again.
on banks by forcing involvement in partisan
Pretty minor
politics? And how's the Federal Reserve
movement,
ensuring
though,
they
if
remain
we do get a
separate from
bounce.
political influence?
I think
Maybe
it's absolutely
4%.
critical that we do. I mean, our independence is partly founded on the idea that we will stay out of
No,
stuff that
BBY
you have
doesn't
not
really
assigned
follow
us to
SPY.
do. And if we're going to wander all over and take on that issue,
if anything, it
today,
inverses at
our
times.
case for our independence is dramatically weakened. On climate change, I think we do. You mentioned the guidance, and then there are also the stress scenarios.
I think volume will
those
pick
are
up
the
a
two
lot.
things that
That's one sign of a
we've done. We tried to keep
reversal of
those
support,
tightly
so
focused on understanding
to,
the
but
banks.
that'd be a
Understanding and being
bullish
able
sign.
to manage the risks that they'll run over the
volume
longer,
starts to
over
increase.
the longer time periods on climate, and not slide into a broader sort of policy-making role on climate change. And I accept that could be a slippery slope and a moving border. And I just want to say, and I think my colleagues feel the same way on the board, that we're going to guard that border carefully, and we're going to stick to our role and not try to be policymakers the way in many other countries the central bank is out there in the lead with the support of the public doing climate policy.
You give your shares to lend.
That's
That's
not
not
where we
doesn't
are
really
in the
matter the
United
price.
States,
It's just
we're not gonna
what
pretend
the
that it is.
what the current
There's
rates
some time
are.
left, I'll yield back, but I just want to say
lending
as an
rates.
auto dealer, I'm looking for the
Cost to
first day
borrow.
of that rate cut. So, thank you for being here. We
But
appreciate
as far
it.
as being attractive as shorts,
Gentleman's
yes,
time
isn't a
has
very
expired. We'll now
attractive
go
price, I would
to the
imagine, for
gentleman
shorts to
from
enter.
California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chairman, and again, thank you for holding this hearing. Chairman Powell, pleasure to see you again. I've said
bounced
it
off that
before, and I'll
low.
say it again. It's always great to
Those I
see
could've
you
closed
because I
out there,
always
but-
think of the old Republicans, the ones who are very noble, did the right thing, didn't play chicken with the economy, very forthright. And so anyway, I appreciate you being here very much. Like some of my colleagues on the other side, I'd say the same thing about some of them. And I appreciate it.
The same thing about
So
some
we
of them.
heard today that the inflation is Biden's fault.
Yeah, tops is ripping for sure.
So what is the inflation rate in the European Union today?
It's high.
It's high. Is it 10% possibly?
I think if you're talking about headline, I don't have this figure in my head, but it's very, very high from a headline standpoint. And they've had core inflation move up too.
So are they following Biden's then policies? Is that what caused the inflation? Because it seems to be Biden's fault.
So I think inflation is everywhere, and it must have to do with a common factor, and that common factor has to be the reopening of the economy after and the things that were done on COVID. On the other hand, each country has a little bit different case, and I think you have to be careful. We had much more of a demand-oriented issue than they did. Now they have their inflation looks a lot like ours did a year ago.
Right. Yeah, I just had to bring it up because, again, Sherman brought it up, but it's interesting every time I hear inflation is caused by Biden, I wonder why is it all over the world? I mean, it's not because of the pandemic, of course, or, Europe's at war. I mean, that wouldn't cause it, of course. It'd have to be Biden's policies. That's ridiculous. And I think the voters saw through it last time. So I haven't been here 15 years as my good friend, Mr. Foster. I've only been here 11. But when I first got here, the boogeyman, and I heard it all from my friends on the other side, was Dodd-Frank. Dodd-Frank was going to be the end of banking.
35%.
And in fact, some of my colleagues would almost scream.
Yeah, it's got a gap.
How horrible this was. And then we got the bankers up here during a real stress test, which was the pandemic. And we asked them, has it been helpful to have Dodd-Frank? And you know what they said? Do you know what they said?
I don't.
Oh, they said it was helpful. In fact, it kept the banks capitalized. It was fascinating. Now, to be fair to them, they did complain about some of the smaller issues, but not Dodd-Frank in general, the bill. Then it seemed that CFPB, that became the next boogeyman. But they're starting to seem to fade on that, and I think the reason for that is the CFPB has actually helped so many people that now a lot of their own constituents now are getting helped by the CFPB, so all of a sudden there's not quite the energy. So now they're attacking ESG. ESG. And they're saying that you and everybody else is somehow conspiring to make sure they don't buy their oil or their coal. Are you conspiring to do that? Are you conspiring?
I don't believe we're conspiring.
No. Now, I heard it was supposed climate risk. Is there risk in the climate change?
Yes.
There is? Could it affect the bank?
Certainly, in the longer run, yes.
Yeah, of course it can. Do you think insurance companies take this into account?
Yes, actually, I believe they do.
They absolutely do.
Who write long duration liabilities, they certainly do.
Of course they do. I mean, they're very concerned with it. Weather is a big deal. I was a vice president of Liberty Mutual in their corporate legal department, and I can tell you weather and the changing of the weather, we used to have what we call catastrophes. And these catastrophes happen every 25, 50, 100 years. Now those 25, 50, and 100-year events happen every 5 years, every 2 years. So of course it is. I mean, it's ridiculous not to take a look at these ESG factors. We have to. And again, I'm glad that you guys are taking a look at it because it's real. I'm glad that the president's taking a look at it. And it's sad that my colleagues on the other side just want to stick their head in the sand and say, no, climate change is supposed climate change. No, the reality is it's real climate change, and it's costing billions and billions of dollars, and if you don't believe it, go ask all those poor people in Florida that had those huge hurricanes come through and wipe them out. So again, I appreciate very much the work that you've done. The only thing I hope is, as you said, if we ever see this pitch again, we'll know how to swing at it, and I hope we don't get the pitch of defaulting, because I'm not sure we'll know how to swing at that one. So thank you again, Mr. Chairman. Thank you for being here.
Done it before.
I yield back.
Gentleman's time, gentleman yields back.
pitiful.
Gentleman's time has expired. We'll now go to the Chair of the Oversight Subcommittee, the gentleman from Michigan, Mr. Heisinger, for 5 minutes.
Thank you, Mr. Chairman. I'm going to move quickly, and good to see you again, Chair. You know, I caught a little bit of the Senate hearings yesterday, and
Saw it bounce on that
you had a
bottom.
lot of pressure
Tight little
to
range
keep the
today so
sugar high
far.
going. And frankly, if the Fed and many of our colleagues had listened to what many of us were saying, we should have been weaned off that artificially low, cheap money that kept the party going, and frankly, we wouldn't be in this position. To reference Chair Greenspan's punch bowl analogy, not only did no one have the courage to remove the punch bowl, you had people cheering on the pouring of another bottle of 151 rum into the punch bowl.
151
And here you got folks wanting to do the exact same thing. Let's spend more. It's just, and now here we are. You have an impossible decision to slow the economy or let everyone get crushed by inflation. And we know tightening means a slower economy. Slower economy means fewer jobs. Fewer jobs hit those who can least afford to lose a job. And so in short, the lower rungs of the economic ladder will suffer more than the rest of the ladder. So that's the state of play of where we're at. I have to hit a couple of quick issues here. I wanted to start off by discussing climate, especially given the Fed's announcement in January that it was going to conduct a pilot climate scenario analysis exercise. The Fed, along with the OCC and FDIC, have each issued proposed climate risk management principles for banks that you are attempting to finalize those by the end of the year, and the requirements don't stop at the border. The UK and the EU central banks are moving to require significant ESG disclosure regimes as well. I know the Fed is taking a look at commodities capital charges in the holistic review, but even though the Fed isn't forcing banks to encompass climate analysis in their stress tests, there are many initiatives at the Fed that are going to make it more costly for banks to finance traditional fossil fuel companies. So I want to ask you a very specific question. Will you commit that you will withhold support for a new capital rule that increases capital charges on bank activities in traditional energy companies?
You know, I can't sit here and promise what I will and will not vote
big rip
for
on
because
SPY.
I don't know what's going to be in the proposal. But
You said something
that's,
right here,
That's
but
not the kind of thing I think we're looking at.
I'm sorry, it's not the kind of thing.
So this isn't about this is about overall capital levels more than anything else, I think, rather than the specific thing you're talking about.
Okay. We're going to follow up on that because we need to have a real-time conversation about what that is going on there. I want to quickly switch topics and go in a different direction for this next question. I want to ask you about two opinions issued by your legal staff in November of 2019 and December of 2020 to the asset managers Vanguard and BlackRock. Mr. Chairman McHenry, I'd like to submit the two letters for the record.
Without objection.
Thank you. These opinions appear to outline the parameters of both how both Vanguard and BlackRock can operate without being deemed a bank holding company. In addition to the legal restrictions outlined by the bank holding company, these opinions listed out here in quite detail list out commitments that the companies would need to take to avoid being viewed as having, quote, control. These opinions also appear to provide assurances that the Federal Reserve Board staff would not recommend that the board find the asset managers to be bank holding companies. Further, it is unclear whether the board will take any steps beyond a periodic self-certification by the asset managers to monitor compliance with the condition that they, quote, not take any action to control a banking organization. As some asset managers play a larger role and clearly strive to influence policy in companies across the free market, we need to remain vigilant. So, Chair Powell, is the board taking any steps to assess or monitor whether Vanguard and BlackRock are complying with the commitments made in November of 2019 and December of 2020, respectively?
Wait.
I would have to check and get back to you on that.
Okay.
Familiar with the issue.
I appreciate that, but that says to me that doesn't sound like there's an assessment that's taking place ongoing or scrutiny of that. Is somebody reviewing that, or is someone in charge of reviewing that?
Honestly, that's a very specific, narrow question. I'm quite familiar with the issue.
Well, it's specific and narrow to two companies, but not to an industry. I mean, that's what we need to be driving at. And I guess we need to find out whether there's somebody proactively reviewing these activities and these commitments that the companies have made as well as the Fed has made. So how often do you think they should be reassessed? Annually, monthly, biannually?
You know, this is a This is a very
so it's
narrow
going to keep going again.
set of questions. I can get you great answers really easily.
Powell
but
is
I don't have them
pumping.
in my head.
I look forward to those great
15%.
answers, and I yield
We'll
back.
now go to the gentleman from New Jersey, Mr. Godheimer. for
Powell
5
looks
minutes.
nice.
Thank you,
though.
Mr. Chairman, and Chairman Powell for joining us today. Chairman Powell, when you testified before the committee last June, PCE inflation was up 6.3% year over year. Just a few weeks ago, PCE data showed that the numbers decreased to 5.4%. We're moving in the right direction, but despite the Federal Reserve raising interest rates at the highest rate since October 2007, we're still far off from the 2% inflation that the Federal Reserve is targeting.
The high on the day for
Do you
SPY.
believe 2% is still the right target for inflation? And given the ongoing energy transition, the push to shift supply chains out of China, and the labor shortage here in the U.S., should the Fed consider adjusting its target to avoid overly burdening Americans? Would a decline to 3% inflation be enough to offer price stability without excessive economic pain?
No, 2% inflation is going to remain our longer-term inflation goal.
Are you concerned given all the other factors that I mentioned, or do you think we just have to keep sticking with that?
I think that's got to remain our longer-term inflation goal. It's the global standard, and it's our standard, and this is
We're
not a
gonna go
time at which
jump back in long?
we can start talking about changing it. We have no instinct to do that.
Thank you, Mr. Chairman. The gig economy has grown significantly in recent years.
Yeah,
as
that good
more
news that
Americans
actually
are
pumped them
working
up today,
As
so-
contractors are running small businesses.
I'm not sure
The
this
Dallas Federal
rally
Reserve
right
has
now
written that
necessarily
gig workers
keep
are
going
often
on
not
help
included
is.
in payrolls and not counted among the unemployed, and this may understate the number of Americans who could be counted as unemployed. The Fed has also noted the large number of Americans who are missing from
bullish
the
on the
workforce
hourly.
after the pandemic. Do we need to change the way we think about measuring unemployment to account for these changes?
I missed the word you're saying.
Sorry, do you think we need to change the way we think about measuring unemployment to account for these changes?
I didn't catch this. You said, what was the word?
Gig. Oh, sorry, gig. Gig
Gig
workers.
workers. Gig
Yeah,
workers.
so I'm sorry.
I
Gig
didn't
workers.
hear that. That's the word I didn't hear.
I look at SPY after hours,
we,
but
we
look
clearly
at the
need
future,
to
so
incorporate gig workers both into the labor force and to whether they're working.
yeah.
They
It's
certainly
basically
are
the SPY.
We try to do that. It's not
But
that
it
we're
doesn't
not trying
close.
to do that. We may not be doing it perfectly.
Is there a better way to
Except
capture
for
them? Just worried
1
that
hour
you'll
every
have the
day.
unemployment numbers may not, given we're
weekends.
still using older measurement ways. Are we updating our measurement?
We absolutely try. We're definitely trying to get those people, self-employed people. They do report in the household survey, I believe. I can get more for you on that. but
BBBY.
I'm sure we're not doing a perfect job at it because it's a relatively new thing, but we're
candle
very well
through
aware of it, and
BWAP.
they're supposed to be included.
It'd be great. I'd love to talk to you more about that.
Great.
Thank you. As you're also aware, many of us are having discussions about the long-term fiscal health of our country and our economy. Like many, I worry that higher interest rates will put upward pressure on the national debt. CBO already estimates that annual interest costs will nearly triple for the U.S. over the next decade. You said to the Senate yesterday that interest payments are not a consideration of the Fed, but are you concerned that higher interest rates will more rapidly make payments on the debt unsustainable? And are there actions Congress should consider to address this issue?
So I'll say what my predecessors have said, which is that we're on an unsustainable path, and we really need to. Ultimately, we will get back on a sustainable path, and the sooner we get to work on that, the less painful it will be.
And rates, of course, were low between the
GME might be
financial
kinda
crisis
double
and the end
bottoming
of
here.
2021, particularly low. After the target inflation rates hit,
It's
what do you think the new
short-term,
normal looks like in terms of rates and the Fed balance sheet over the next 5 to 10 years?
You know, it's a really good question. There was a secular decline
That
in
1940
longer-term
resistance
interest
was
rates,
pretty
which we
bad,
don't
though.
control, for 40 years to the point where they
Nice
were
short here on
where
SPY,
the
maybe.
10-year was at 10-year Treasury was
Like the
at
time the
10%,
tops.
and at the end of 40 years it was quite low. You're at higher levels. You're at, as you pointed out, levels we haven't seen since earlier in this century. I don't think anybody knows what this is going to look like 5 years down the road. So you have to ask. Demographics haven't gotten better. Globalization may actually move a little bit in reverse, which would tend to produce higher inflation and thus higher rates. But you have to ask the factors that caused low rates, how much of that has changed, and some of it has, but much of it hasn't.
Building on that a little bit, what's the right metric you think for, if you're in our shoes, for assessing our fiscal health? Do you think we should be focused on maintaining a specific debt to GDP ratio, or is there a specific number? Are there other measures lawmakers should be focusing on?
So we've traditionally focused on debt to GDP,
Drifting.
but many people pointed out before the
BBBY
pandemic
moving up past
that
VWAP here.
rates were secularly lower.
Interesting
and therefore you could
bullishness.
look at sort of real debt service. There was a lot of research by those measures. Actually, debt service was much more easy to handle. Now we have the 10 years back close to 4%, and I think we need to be careful not to assume that these secularly
Validation for
low
tops up here.
longer-term rates are going to
Dollar
continue
grinding up.
indefinitely, because that doesn't look likely now. And frankly, most forecasts have always shown things like the 10-year going back to a higher level. So it won't be that big of a change.
Oil
I
hasn't
think
been
it's
coming
more or
up.
less
The
been
SPY
handled,
rally's
for
not-
example, by CBO.
Not with energy.
Excellent. Thank
Not
you
with
so
the
much.
dollar,
And I
really.
yield back.
Dollar's been rallying.
Now I'll go to the gentleman, the Vice Chair of the Digital Assets Subcommittee and the Chair of the Housing Subcommittee, Mr. Davidson of Ohio, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you. It's an honor to be able to talk with you today and appreciate the work you and the monetary policy-focused portion of the Fed does. We're rooting for maybe a more consistent input from our bank regulators. So for the regulatory side, I've spoken with multiple bankers who tell me that they've never seen a higher degree of regulatory burden, steering, guidance, shaping activities in the market from regulators. And I don't think that's just narrowly focused on the Fed, but I'd ask you to look into it. There are a lot of people that feel like there's an Operation Choke Point 2.0 going on, and it's particularly focused on debanking people that are disfavored by, the current executive branch primarily.
All right, add it to my
just
short
like
up
the
here.
previous Operation Choke Point was. And so to the extent that you yield any influence over the regulatory component of the Federal Reserve, I think that would be meaningful and important because, our monetary system, part of the strength of the U.S. dollar is, of course, a stable store of value. Currencies around the world are wrestling with that and inflation, and you guys are working to tackle it. But the other part is it's an efficient means of an exchange. And when people really feel like some third party is going to steer or shape their money, they don't trust it. I mean, the unbanked and the underbanked, fundamentally, that's lack of trust is part of why they don't use our banking system today. In fact, that's part of the appeal of the digital asset space, is the permissionless nature of it. It seems that a lot of people
GME is almost up 1%.
in the financial services space that have grown up in it, that are leading it today, feel threatened by the prospect of change. And if they've maybe reluctantly concluded that you can't ban crypto, they at least want to keep it account-based so that some third party can actually control the assets, which is a polite way of saying we don't actually trust our citizens to control their money or their assets. We'll let somebody else do it for them because we can control those third parties. And in fact, that's what the regulators do, isn't it?
Isn't what?
They control the third parties. I mean, if you don't comply with the regulatory regime, you don't get to operate a financial services business, right?
That's right.
Yeah. And so at the end of the day, I think a lot of people were concerned by your remarks yesterday. I know I was, by saying that permissionless digital assets pose a systemic risk to the financial system.
Well, what we said in our guidance, I think if you read through the digital guidance, which I did getting ready for this hearing, of course I read it before we put it out the first time, but it's pretty careful to say that we don't want
BBBY,
regulation to
130,
impose innovation and thus entrench
3
incumbents and
on the
things
high,
like
that candle.
It's pretty balanced, the language, and I think it essentially goes to the question of protecting the safety and soundness of institutions. And there is one, I think what we say about, I'll paraphrase it, what we say about permissionless blockchain is that they have been vehicles for fraud.
Yeah, 0.24%. So if you follow your own report on fraud, it's a fraction of what it is with the U.S. dollar. So speaking of the dollar, is there any real current threat to the dollar's preeminence as the world's reserve currency?
You're asking a question. I didn't.
Yes, sir.
Is there a real threat?
Is there a threat?
I think that our status as the world's reserve currency is not under particularly strong threat right now.
1-3
I think it's a
resistance
pretty
on this
stable
run.
equilibrium. It's not a permanent equilibrium, but there isn't really a
1.5,
serious
then
competitor,
gap
and that's
fill,
not
maybe.
because of any of this. It's because of our democratic institutions and the rule of law, and the fact that the dollar's value is pretty stable.
Okay. So quickly on the repo market, just any insight into that, and then I'll have my last comment here and just leave the last word to you. But particularly curious about the repo market. But I'll close by simply saying I'd ask you to turn off the purchase of mortgage-backed securities. As the chairman of Housing and Insurance, I'm particularly concerned about affordable housing And the artificial prop for the mortgage-backed securities does raise the cost of capital in that space. So whether you own it or occupy it or rent it, it's going to raise the cost there. But I'd just ask if you'd comment on the safety and soundness of the repo market, if you would.
Of the repo market. As far as I know, the repo market is functioning reasonably well these days. Are you talking about the reverse repo facility? Or
Yes.
The reverse repo facility is a different thing. We can continue this.
I'd like to follow up with you later, and my time has expired. I yield.
Thanks.
Gentleman from Illinois, Mr. Caston's recognized for 5 minutes.
Thank you, Mr. Chair. Always a pleasure to see you, and appreciate your time here today.
Getting kind of
I want to
frisky with his RRP comment. We'll be asking about those trillions.
Chart in your monetary policy report, which I think is fascinating. Chart 14 on page 17. This is this history of wage growth and job growth. And for those of you who don't have it in front of you, broadly speaking, from 2000 to 2017, we had more workers than jobs. From 17 until the COVID crisis, it was about the same. And since COVID, we've had more jobs than workers. And there's tons of rich stuff in here that I just enjoyed reading. But broadly speaking, if that was the only thing going on in the economy, I would assume that we had 20 years where it was essentially a buyer's market for labor, and the last year and a half where it's been a seller's market for labor, as you look at that. And if I go through and I look at from 2010 to 2020, CPI was up 20% over the period, and real median wages less than 10%.
I might be rejecting this.
So for half of the economy, they didn't keep up with wages, even though we think of that as a very low inflationary period. Corporate profits were also up strongly, as you would expect. I'm not saying that with judgment, right? If it's a buyer's market for labor, you would expect the gains from labor productivity to flow to consumers and profits, and that looks like what it did.
Which chart are you looking at?
This is chart 14 on page 17 of the monitor. It's the top right corner there.
Got it. Okay, thanks.
In the last year and a half, median wages are up 5%, which is almost as much as they grew during that 10-year period before. And yes, inflation is still a bit higher than that. But what I'm wondering is, as you look at the economy, is wage growth universally bad in your view, or is wage growth good to the extent that it's keeping up with wages? Because historically, wages didn't keep up. And how do you think through that nuance? Because interest rates are a very blunt tool. And, if we are now, if you agree with me that we're now basically in a seller's market for labor, shouldn't we expect and welcome some wage inflation that goes with that?
So I'd say two things. First, we want wages to go up in ways that are consistent with over time with the increase in productivity and inflation, and that makes all the sense in the world.
Get the silly monkey.
The other thing I would say is that in this instance, what we've seen is inflation eating up these very high nominal wage gains have very largely been eaten up by higher inflation. So it's very important that we restore price stability so that we can start to see real wage gains after inflation across the income spectrum.
Yeah, no, and to be clear, we're all opposed to inflation here, but in that 2010 to 2020 period that we all viewed as a very low inflationary period, wages, the gains from productivity did not flow to labor. Wages did not keep up with inflation. And we didn't think about that as a problem for the Fed to fix because overall inflation was down. So, this gets sort of theoretical, but let's say that we had 6% wage inflation and 5% CPI. There'd be more money in people's pockets, but would we view that as a inflationary period to clamp down on? Because we didn't view the inverse as a problem, if you will.
So our job is to restore price stability and keep price stability. It isn't to keep wages down, and it's certainly not to get involved in trying to establish the appropriate level of labor share of profits, for example. That's not the way we think about it at all. We think about price stability, and when we think about price stability, we think about wages as an important input to that.
Does not make sense.
We're not targeting a particular level of prices, and we would never say that we don't want real wages to go up. What we're really charged with is price stability, and to do that, we have to think about wages. But in particular, no one at the Fed would be upset to see the labor share go up, but that's not something that our policies affect. That's set by globalization and the advance of technology and educational and skills and aptitude and all those things. That's what drives and productivity. That's what drives, labor share.
Yeah, and it's hard to have these conversations in 5 minutes, I realize.
Happy to follow up.
I guess what's hard is that also in that 2010 to 2020 period, median home prices went up by 50%.
Yeah.
We didn't view that as inflationary. 401ks went up a lot. We didn't view that as inflationary because those were asset increases. And so as we have shifted the gains from people who had wealth to people who were dependent on wages, there needs to be some correction, and I leave it there because I'm out of time. But how we think about
Gentleman's
that.
time has
Thank you.
expired.
Go back.
We'll now go to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Clear sign of a bunch of money pumping into the economy.
Us today, Chairman Powell.
Give people money.
Chair Powell, I just want to
Stuff's getting
echo
expensive.
at the outset some of the concerns that my
Your dollar
colleagues have
loses value.
raised about Vice Chair Michael Barr's, quote, holistic, unquote, holistic review, unquote, of capital markets, and also about the Fed engaging in climate policy, as well as your decision to put Vice Chair Barr in charge of the Community Reinvestment Act rulemaking. With that said, I'm going to dive right into my questions. Chair Powell, I was pleased to see that the U.S. Coin Task Force released their report on the state of coin a few months ago. The report notes that the Federal Reserve and U.S. Mint will be jointly contracting with a third-party consultant to review the coin supply chain and develop recommendations to improve it. Chairman Powell, could you provide us with an update on what the Fed has learned from its review of the coin circulation issues that occurred during the pandemic?
So we know that the flow of coins, the natural flow of coins in the economy slowed down a lot because people were staying home and that kind of thing, and they may have switched to non-coin-based means of payment.
You say
And
Coinbase?
we feel like the evidence is that that's continued now. People are paying electronically and things like that, and coins are sitting in jars and on people's desks and at home, and they're not
Back to
circulating
VWAP.
back into the banks and thus to the retail stores. And so we're working on that. We're working with the Mint. We're working with all the stakeholders in the coin ecosystem to try to address this problem, and we're well aware of it.
So it seems to me that what we learned from that is that it's probably necessary to have a greater reserve of coins if there is such an interruption in the future, so that commerce is not indeed interrupted. Would you share that broad view?
That sounds right. I'm not an expert. I will say
This dude's a coin
it feels like
collector.
we need more coins now because more of them are sitting in people's homes and pockets, and they're not flowing.
There was a
back to
shortage of
where
coins after
retailers in
COVID
particular need the flow
because
of coins.
money wasn't
That sounds right to
circulating.
me.
On a related note, could you speak about the importance of maintaining cash as a viable payment option, particularly for those that lack or don't have access to traditional financial services?
We think it's absolutely critical because there are people who don't have credit cards. Many people don't have credit cards. They don't have good credit, and they need to be paying in cash. And when stores are not dealing with people who don't have cash, it's a serious problem for those people in the economy. We have it at the Board of Governors, and you see it elsewhere because most payments are now taken care of by credit cards, and it's very efficient. But we need to be looking out for people who use cash.
Thank you. I appreciate that perspective. Picking up on Mr. Lukemeier's concerns that he expressed earlier, as you know, the Consumer Financial Protection Bureau's funding mechanism is intricately linked to the Federal Reserve System. According to Title 10 of Dodd-Frank, each quarter the CFPB director requests an amount that is reasonably necessary to carry out the Bureau's authorities, and the Federal Reserve must transfer that amount so long as it does not exceed 12% of the Federal Reserve's total operating expenses. For the first 5 years of the existence of CFPB, of course, there was a relaxation there with respect to that 12% cap that allowed $200 million annually to be spent beyond that number, so long as it was reported, so long as the reported excess was sent to the President and congressional appropriators. Chair Powell, during your chairmanship, has the Fed ever rejected a CFPB budget request?
I do not believe so.
And could you tell us what policies and procedures are in place at the Fed to ensure that there is no waste, fraud, or abuse, or that these limits are not otherwise exceeded?
So we have no role in engaging with that. It's really what we share a common inspector general who does work on those issues, but we don't in any way We don't have any governance of any kind over the CFPB. We're just a source to them.
Thank you. I appreciate that insight. In closing, Chair Powell, yesterday Senator Warren asked you what you would say to the 2 million people who may lose their jobs if the Fed keeps raising interest rates. Frankly, Senator Warren should be asking herself the same question when she voted and advocated for the Democrats' reckless spending packages that caused this inflation that we are seeing today, and is the reason the Fed has had to raise interest rates, in my view. Frankly, I would call on Senator Warren, the President, and the Democratic Party, for that matter, to apologize to the American people for causing this kitchen table crisis across the country. With that, Chairman, I yield back.
Now recognize the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Chairman Powell, for joining us today and for your testimony. I'm going to focus my comments and my questions on the high costs that families in my district are seeing because of your interest rate hikes. Now, while the Fed has acknowledged that higher interest rates are not the primary driver for the slowdown in price increases, you continue to raise interest rates, risking not only millions of jobs, but also a recession. Based on projections from the Fed, approximately 2 million people will lose their jobs. So that's 2 million families who will struggle to put food on the table, keep a roof over their heads, and to make ends meet. But the economic hardship does not end there. Mr. Chair, I would like to request unanimous consent to submit a recent paper by the Federal Reserve Bank of Cleveland titled Post-COVID Inflation Dynamics into the record.
Without objection.
Chairman Powell, are you familiar with this publication, yes or no?
No, I'm not.
Okay. Well, let me give you some context. In this paper, the Fed's own economists predict that reaching the 2% inflation goal that you have set will be impossible without causing a recession and spiking the unemployment rate to 7.4%, which translates to millions of working people losing their jobs. Now, Chairman Powell, many economists agree with me when I say that engineering a recession to bring inflation under control is not the right strategy, especially at a time when we are seeing inflation cool in real time, independent of your rate hikes. So on behalf of the people of this country, to prevent a recession, yes or no, Chairman Powell, will you pause future interest rate hikes?
We're not seeking to have a recession, and we don't think we need to have a recession to get price stability back.
Will you pause interest rate hikes, yes or no?
I don't do yes or no on will I pause interest rate hikes. Yeah, that's a serious question, and I can't tell you because I don't know all the facts. That's not a
Reclaiming my time. And in fact, it is a very serious question because it has a very serious implications. The people who will bear the brunt of an economic recession are our most vulnerable. We know from past experiences that recessions have catastrophic and deeply inequitable consequences. In fact, while some will catch a cold, others will catch pneumonia. But you know that. An economic cold or pneumonia. In fact, in your opening statement, you said, "We will stay the course until the job is done." To conclude, we understand that our actions affect communities, families, and businesses across the country.
Kyle is still going.
Could you elaborate what is this
again.
effect to communities, families, and businesses, these interest rate hikes?
Well, right now we're trying to bring down inflation on behalf of all those families. I think high inflation is hurting particularly working families all around the country very badly. And as you know, if you're on a very limited budget and you don't have a lot of excess earnings, when prices start going up, you're in trouble right away. People, middle and upper middle class people have more resources. So we think it's absolutely critical for the working people of this country that we get inflation back under control. And also, while we're at it, we have a dual mandate.
Apologies, Mr. Chair, I'm just reclaiming my time here. Here's the thing. The most devastating impacts will be to our most vulnerable.
Yeah, she doesn't want an answer. She just
Veterans to our most vulnerable. Veterans, the elderly, low-income workers, black and brown workers, those who have often ignored and been neglected in the name of what you refer to as appropriate monetary policy. And yet, you assert that you will stay the course. It's unconscionable, and our most vulnerable workers and families cannot afford to wait for you to realize the harm that you were doing. In my opinion, this sounds more like the assertions of a greedy corporation than someone who has a public mission on behalf of the people of this country. One more question with my remaining time here. Chairman Powell, another consequence of your interest rate hikes has been the increase of the average 30-year fixed mortgage rate to 6.6%, double of what it was 2 years ago. Do you see this widening inequity in the housing market as a problem? And what steps will you take to make housing more affordable? This is putting home ownership further and further out of reach for my constituents, new parents, millennials, people of color, contributing to inequities and the racial wealth gap. So what are your thoughts on that?
Well, our policies do
Gentlemen,
affect.
Gentlelady's time has expired. Chairs can submit for the record or answer.
I'll briefly say that if I can, that interest rate policies affect interest-sensitive spending very directly. When we cut rates, they help housing. When we raise rates, you see the effect on housing. So
thank you.
Ops 40%.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us today. We currently have $32 trillion in debt. Our debt-to-GDP ratio is 120%, the highest it's ever been. And yes, we have a debt ceiling fight brewing for this summer. I would argue it's an opportunity to get our fiscal house in order. But sadly, there's no meaningful bipartisan effort to responsibly address our debt. Both sides have even preemptively started political attacks, alleging either side wants to cut Social Security and health care. But politics and talking points will not fix our problem. Our debt is the greatest national security threat. Social Security will be insolvent in 2033, and our healthcare system is fundamentally broken. We spend twice as much as the average country per person, and our obesity rate is 3 times the average. I want to be clear, though, I'm not advocating cuts to Social Security, but my Social Security will have to be different than my father's, and we must change the incentive structures of our healthcare system. Briefly, let's go over some history. Social Security was created in 1937. The retirement age then was 65, and average life expectancy was 60. Easy to see how that math works. In 1960, Congress raised the retirement age to 67. It has not been increased since then. That year, life expectancy was 69. That math still works due to a growing population, but it's getting narrower. I will throw in another few statistics for that year, 1960. 14% of Americans were obese, and our debt-to-GDP ratio was 53%. Let's fast forward to this year. Our retirement age is still 67, but our life expectancy is 77. That math clearly does not work, nor is the program functioning in the purpose for which it was designed. And shockingly, our obesity rate is 37%, and we spend $13,000 per person on health care compared to the global average of $6,000 per person and 13% obesity rate. Clearly, our healthcare system is failing. Our system focuses on managing sickness where we should be facilitating health and wellness.
Is it?
We will only meaningfully be able to address the debt ceiling by focusing on the biggest drivers of our debt. Responsible policymakers should be focused on saving Social Security by reforming it and transforming our healthcare system to facilitate a healthy citizenry capable of working and being contributing members of society. The American people deserve more than the political nonsense. 5 years ago, the #1 issue I ran on was debt. It has been and continues to be our greatest national security risk. I hate to say it, but the last 4 years, it's gotten way worse. Congress has spent $7 trillion, of which $5 trillion was done mostly on party lines. The Democrat majority has not only spent money we don't have over the last 4 years, but their fiscal policy has caused out-of-control inflation, which caused you to raise interest rates. Last year, I asked you if you ever took into consideration the impact of interest rate increases on the cost of our debt service. You appropriately and adamantly said no. Our debt service cost the next 10 years will be over $10 trillion. I'm going to point out 2 things. Number one, that is more than all of our debt service since 1940 combined, the last 80 years. And while you did not take interest rate increases impact on our debt service into your decision-making, the best estimate is that those rate increases will increase our debt service cost by $2 trillion in the next 10 years. So basically, the $7 trillion that the Democrats spent in the last 4 years is going to cost us an additional $2 trillion. And that's not factoring in future rate increases as you continue to appropriately try to get inflation under control. As you can tell, this is a huge problem. The $7 trillion in unnecessary spending in the last 4 years has caused inflation. Some of my colleagues across the aisle disagree with that causal relationship. Clinton's Treasury Secretary and Obama's Director of National Economic Council, Larry Summers, wrote an op-ed before they spent the money and said it was going to cause inflation. And he has gone on the I was right tour for the last couple years. We need responsible policymakers to address our debt. Let's talk about what's not serious, and that's minting a $1 trillion coin. Many of my colleagues across the aisle have advocated for this. Luckily, both President Biden and Secretary Yellen have said that this is not a serious proposal, and they have no plans of considering it. Unfortunately, the Biden administration has a bit of a history of doing a 180 when the political winds blow. Most recently, he said he would veto the D.C. crime bill, and now he's adamantly supporting it and plans to sign it. So, Chair Powell, my only question of you is if Biden and Yellen send you a $1 trillion coin, will you accept it?
What I will say to that is that this only winds up one way, and that is with Congress raising the debt ceiling.
So you will not accept a $1 trillion coin and treat it as $1 trillion if it's sent to you?
I'll add there are no rabbits to be pulled out of hats here. This only ends with Congress.
I know you don't like yes or no's, but if you are sent a $1 trillion coin and asked to treat it as $1 trillion, will you treat it as $1 trillion?
That would be a rabbit coming out of a hat.
I'll take that as a no. Thank you. Mr. Chairman, I yield back.
Now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you so much, Mr. Chairman. Thank you, Chair Powell, for being here. You have a lot of economic, projections, economic projections, various data, various reports that are coming out. How much, and you've studied inflation, right? I mean, obviously, it's your #1 priority right now. How much is inflation impacted by these 3 things? Corporate profiteering, egregious executive pay, and the use of stock buybacks.
So I don't have numbers, but I would say in the case of executive pay and in the case of share repurchases, I can't think of how it would affect inflation. In the case of executive pay, that would be very small in terms of the broader economy. In terms of profits, though, the way I think about that is profits are high. The places where profits are really high is places where there are shortages and supply chain issues. And as those things get better, as they are, you're going to see inflation come down and even prices come down, and you'll see corporate margins come down there. And that'll be part of how inflation comes down.
So does that corporate profiteering does impact inflation? You don't have any stats of percentage-wise how much of it? Yeah. Because you seem, I really paid attention to your testimony in the Senate hearing yesterday, and there was a lot of conversation about, my neighbors and residents' wages and so forth. They're finally starting to see a little bit more closer to possibly getting fair wages. It's not even far enough, but I don't know if the Feds is paying closer attention to monopolies, corporate profiteering, and executive egregious pay. All of it, even the stock buybacks, you're saying all of that aside, you're focused more on wages and increasing the interest rate than on those other
Our focus is really on price stability, not so much wages. Wages play into that because they're an important cost for business, but they're not. We're not trying to achieve a particular level of wages.
I think SPY just consolidate until this is over.
Yeah, and I think it's really important.
Momentum's still down from yesterday, though.
What we saw during the pandemic is, the wealthy and the corporations continued to profit in large scale and still do buybacks and still do really egregious executive pay and benefits and so forth for those at the top. And then, of course, the communities and such were impacted by it. But what I hear consistently is folks thinking that's the reason. All of a sudden wages are skyrocketing, all this. But all I see is continuation, again, of those that are already getting a huge benefit, the folks at the top, the executives and so forth. My friend Glenn taught me this today, that the Feds are actually sitting on something in Dodd-Frank, Section 956. You all are sitting on the last 12 years on guidance regarding executive compensation and the high risks of it. Like around, there was some sort of proposal done, not implemented,
again, it's been 12 years. Why is that something that you're not concerned about regarding inflation?
Well,
like you guys are sitting, one, you're sitting on it, right? Why?
Well,
It's been 12 years. And then two, why is that you're saying that's not big deal? That's not going to impact the cost of products and so forth for our residents?
It's a multi-agency rule, and there have been repeated attempts to get 5 or 6 or 7, however many it is, agencies to agree. That's one thing.
On disclosures?
No, this is on, it's on policies to.
Yeah, which include disclosures and arrangements regarding executive pay and the risk of it.
There. Anyway, 956 is, you're right, we haven't been able to get agreement among agencies. But more to the point, you know, boards long since, this is just for the big banks where we have this authority, long since board of directors are very focused on how executive compensation works and that it not reward, you know, unnecessarily risky behavior and that kinds of things.
Yeah, but in Dodd-Frank, which Congress passed, there should, you know, you're supposed to put something in place, and it's not in place. And look, I'm saying this because so many people in this chamber, and I feel like the feds are more obsessed with wages than they are in regards to the monopolies, the corporate profiteering. There hasn't been any, I mean, really, I don't think there is a laser focus on that, and it's really, you know, because I think the feds and Congress can support fair wages and still combat inflation if you are fair in combating egregious executive pay, monopolies, and corporate profiteering.
We don't do competition policy, and we also don't, broadly speaking, regulate corporate wages.
But 956 would have addressed it. 956 addresses it. You should have it's 12 years.
The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Powell. Appreciate you coming in. I don't have to tell you the fact that housing, so goes the economy. I'm from a state that, from South Carolina, we have people moving in, the population's increasing. And I can tell you housing, not just single-family housing, is in trouble. People are finishing what's in the pipeline. It's now affected multifamily apartments, the high rents that they did get with inflation. That's
see when it breaks out of this
entirely
range.
caused, for the most part, by the policies of this administration with gas, buying it from other countries, with supply chain shortages. There's no reason to start a project when you can't get supplies. And that's what we're facing in the housing industry at all levels. So any increase in interest
BBBY
is
made a low there.
Another dagger that's going to kill the housing industry along with commercial projects that, again, the pipeline's filling up, but the pipeline, once it leaves, you're not going to have any. And I'm from a state that's with people moving in. One of the things that you hear, I think Mr. Davidson mentioned, was regulations. Banks are complaining about being overregulated and the costs associated with it. CRA, I know when Brainerd left, it's in a state of flux. Who's determining that, and when will you have some guidelines out?
That'll be done by the whole Board of Governors when we vote on it, and also by the OCC and the FDIC.
Will they have any input from those who are having to pay the price of implementing CRA? Like, get any input from banks that are having to navigate?
So I know that throughout the multi-year process, there's been a tremendous amount of interaction with banks, tremendous amount, and bank lobby groups and also consumer groups. And then, but yeah, there's been a ton of input and working with the industry to try
Bungie,
to
how many GME shares do you own?
These statutory goals efficiently. I won't say it's perfect, but there's certainly been a lot of interaction.
So they're getting input prior to implementing the requirements for CRA or the guidelines for CRA?
Yes, I think there's, I'm pretty sure there's been quite a bit of interaction with the industry in terms of what, you know, what to do and how to do it.
Okay. Now, I think you've stated that you don't feel it's the Federal Reserve's policy to get into implementing climate change.
We're not, and we shouldn't be climate policymakers. We do have a small,
just wondering who's big,
focused role
who are the
to
big
play,
shareholders in our
principally
Discord.
with the larger banks.
I mentioned
to make
you.
sure
You're
they
one of them.
understand and can manage their climate risks
how many you had
in the long run.
I thought
Should
you were
it be
in the,
mandated?
whatever 5 figures.
Should what be mandated?
Climate change policies be mandated by the Federal Reserve?
You know, I think, again, climate change is something that's going to affect businesses and people and regions and states and whole countries. And
You might
I
be
think
saying
that's,
something here.
that's got to be a job for elected people by and large. I think
You're
what
not.
we're going to affect is we just want to make sure
That
that
gas
banks
bouncing up.
understand and can manage the risks that they're running, and these are principally longer-term risks.
What's concerning to those of us in the business community who have to borrow for banks, the Federal Reserve is conducting a pilot climate scenario analysis that's being mandated, not asked, it's being mandated for the six largest banks to participate in. That seems to me like a pretty good, when you
Thanks
have
for your
to do a
thumbs up today,
scenario
guys.
and
I know I'm not
mandate that they do
doing
that.
much to deserve a thumbs up.
Is
Just
that
watching
not
this
the
with you,
Federal
but
Reserve getting directly involved?
still much appreciated.
Mandating?
You know,
Trying to keep an eye on the
I think
markets
the
and
banks
some
actually
of these
want
plays
this.
we're in.
They want these six
Got
big
43
banks,
of
they
them.
have to face this
Appreciate you guys.
globally. And what they want is uniform approaches and guidance on how to have one set of rules. They're already running, the big six banks that we're talking to, they're already running climate scenarios all the time, multiple climate scenarios.
Most of the banks are well capitalized now.
Flushing
That
now
could
a little
change.
bit.
And this is just another expense that is out there. On the CFPB, the history, I think you said it was 12%, it cannot go above 12% ratio. Has that, I mean, that does not seem logical to me. Has it ever been below the 12% from your perspective?
You know, someone here quoted the law, and that rang a bell for me. So that is what the law says. Had
Got a
they been
Google
below,
Rewards survey on your videos,
I'd have
Happy?
to go back. I'm happy to provide. It's all
If you could, because
Happy
it
to
seems to me
provide.
like that's if you've got that cap,
Really?
businesses couldn't operate like that.
How does that work? It asks you
Because it would be no
like my
incentive
videos
to
or something?
reduce the price as long as it's automated.
That's
Thank
the way the law is set up.
Right. Thank you for being here.
Thank you.
The gentlewoman from Texas, Ms. Garcia, is now
That guy's
recognized for
moving
5
up to
minutes.
the
Thank you,
WAP.
Mr. Chairman, and thank you, Chairman Powell, for being
Well
with us
done.
today.
Thanks for
The
completing
end
it.
is in sight. I would like to
so
begin by
weird.
highlighting an issue that has been a concern for the Congressional Hispanic Caucus and
Does
others.
that come up on
the
YouTube?
Chairman
Going
has
on YouTube?
suggested that we're going to weave in the diversity and inclusion issues throughout our hearings. So here goes my concern. There has never been a Latino Federal Reserve president. And further, only about 5% of
100K?
the Federal Reserve's overall
has amazing
workforce
buy price,
identifies as
cost
Hispanic or
basis.
Latino. As we
Oh,
know, over
Google
the
Rewards
past year or
app?
so, there have been several presidential vacancies at the
Oh,
Federal
you used their
Reserve
app.
banks, and there has still been consistent failure to appoint a Latino candidate. Chair Powell, are you aware of this trend, and do you agree that it's a problem that our diversity and inclusion numbers are in Federal Reserve Board are not reflective of the Latino population?
Yes, it's something we've been focusing on.
All right, and can we get a commitment from you that you'll work on the workforce issues internally?
Yes.
Well, thank you so much. And I'd like to now follow up a little bit on some of the questions from Representative Norman, because I too have a concern about housing costs, particularly as it relates to equity and the negative impact on minority communities. I think you said in your paper that activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. As he mentioned, the rates are higher, not only impacting single-family housing, but multifamily
Hey,
housing.
not everyone has a cost
And it's
basis
also
of like
becoming
12
even
on GME
more,
like you.
and more difficult for people in my district, which is 77% Latino, to be able to buy their first home buyer.
Yeah, that's a good
The
plan.
workforce,
Moon.
entry-level kind of housing. As financing homes get harder, as
Go over
mortgage
120.
to find and mortgage rates rise, the population of home buyers is skewing
that's
towards
resistance
older,
and it
wealthier,
rejected it.
and whiter communities. In many cases, in our suburbs, equity firms are buying out the housing stock. Chair Powell, can you please speak about the relationship
kinda
between
bouncing
Federal
that level now.
Reserve interest rate hikes and housing inequity,
Not a
and what
sell-off
needs to
yet.
change here?
Well, what needs to change is we need to get inflation under control so that interest rates can come back down.
BBBY.
In the meantime,
Maybe
they're
double
high
bought me on the
because
day.
inflation is hurting all of your constituents, not just
hit
the housing
127
sector,
again.
and all of everybody's constituents. And it's our job under the law to restore price stability and also to keep maximum employment.
Is there anything else that Congress can be doing in this respect?
That would be up to Congress, but you know, there are lots of ways in which Congress can support people in various ways, but that's really in your hands.
Right. Now, I want to move on into the numbers that you mentioned again in your remarks at page 2. You mentioned that, of course, we all know there's been a record historic unemployment rate. It's down now to 3.4%, the lowest, I believe, in history. And thank you, Mr. President, for that. But you also mentioned that there's 1.9 job openings for each unemployed individual. I wondered if you could tell me how you define unemployed individual. What does the unemployed individual profile look like?
So that has a very specific meaning. It's someone who is not working but is actively seeking a job. So, for example, if you take 6 months off and stop looking for a job,
all the despair on BBY is a good sign.
That means there's a group of people who are kind of around the edges of the labor force who don't count as unemployed. And those people are marginally attached to the labor force, that kind of thing. But to be actually unemployed, you've got to be looking actively for work in the statistics.
Right, so it does not include people who are perhaps disabled and cannot find accommodations in the workplace to be able to get a job. Unless
they're looking for it. If it's the test is whether you're actively looking. I think in the last
actively looking, regardless of age,
that's right.
Whether or not they're.
It's not a value judgment. It's the way we assess unemployment. We look at the other groups.
Go along here.
Actual unemployment is.
How do you factor in the people that actually are on unemployment insurance?
Sorry?
How do you factor in the people who are on unemployment insurance?
Well, they're unemployed. They've got to be, by definition, we count them as unemployed, or they wouldn't qualify under the state requirements.
All right. Well, I just want to make sure that we clearly understand that there's children, there's people that are older, people that are disabled, people that can't find daycare. There's so many other reasons why someone is unemployed.
Yes.
All right, thank you. I yield back.
Gentleman from Wisconsin, Mr. Stile, the chair of the House Administration Committee, is recognized for 5 minutes.
Chairman Powell, thank you for being here with us today. Your testimony today has been insightful as we look to tackle inflation, the impact that it's having on families across the United States right now. I want to go back to a comment that was quoted to you as regards to a question from Senator Kennedy yesterday regarding the impact that fiscal policy is having as it relates to inflation. And the quote that was attributed to you was that it wasn't a big factor. As we look at kind of a whole host of policies here on Capitol Hill, from reckless spending that we saw in the previous Congress, a lack of what we just discussed, individuals who are outside the labor market, how do we get these folks back into the labor market, whether or not we have policies that are discouraging folks to come back into work, as we look at high energy costs and opportunity to drive energy prices lower by unleashing American energy. How do you factor in the fiscal policies, or how should policymakers factor in the fiscal policies and their impact that's also having on inflation? Not looking for your advice on the fiscal policies, because I know you want to stay out of that, but how should lawmakers be looking at the fiscal policy and its impact on inflation?
So let's take energy, for example. So remember, inflation is the change in prices. It's not the level, as you well know. So energy prices have been coming down. Right, they're still high, but they've been coming down, and they're contributing negatively to headline inflation. So when I say it's not contributing to inflation, that's what I mean. In addition, if you look at aggregate spending, it peaked, and then it's been coming down. So the fiscal impulse is actually negative at this point. It's no longer most of the inflation that we now have, something like 2/3 of the contribution of inflation in core PCE inflation comes from the services sector. And that isn't really about fiscal policy. Fiscal policy was important at the very beginning, so was monetary policy, by the way, but now it's more about just inflation is out there, and you have to bring it down. The record is it doesn't come down by itself unless it's driven by transitory factors. For example, in the goods sector, the supply chains have been getting better, and as that's happened, goods inflation has come way down, and sometimes it's negative now. I hope that's helpful.
Yeah, no, thank you. And so to take that one step further, we're waiting on the president's budget. It's over a month late, but we're anticipating receiving that in the near term. And as we look at interest payments on the debt and the cash flow implications that has, not asking for what you're going to do at the next board meeting for obvious reasons, but as you are in those deliberations to future board meetings and potential rate increases, how does the impact of interest on the debt factor into the calculus of you and your colleagues?
So we don't look at that. We're not, if we started to
it could be a little
change our
double bottom here
monetary
on
policy
BBBY.
because we were concerned about the level of debt payments and things like that, that's not something that the United States needs to do, and it's not something that we do.
Why would it be something the United States doesn't need to do? Could you elaborate on that?
Yeah, we're going to do our job. Congress has given us the job: maximum employment, price stability, regulate the banks, manage the payment system to some extent. We'll do those jobs. We don't have to worry about the United States budget. That is not our job. And it isn't that the debt today is unsustainable. It's that the path is unsustainable. So we can service our debts. It's just that we're on an unsustainable path, meaning that the debt is growing faster than the economy. So we would never consider. We will never look. If a central bank has to avoid taking actions because it's concerned about the budget, that's called fiscal dominance, and that's a thing you don't see among advanced economies, and it would be something we think we're a long way from that.
Thanks for your feedback on that point. The CBO just released their report showing potential interest payments on the debt accelerating dramatically over the next decade, showing it would be 14% of our fiscal spend. To compare that, right, national defense would be 13, Social Security is also 14, so it's in that level. That's a policymaker issue, but your insights are helpful. I know I only have a few seconds left, and a handful of my colleagues have commented on the ongoing review of bank capital standards. I just want to echo those concerns about what the impact would be of a significant capital level increase. Could you just comment briefly about how you quantify the cost of higher capital and the supposed benefits, and how you balance out that risk and reward?
So it's always a balance, exactly as you say. We know that the capital increases that I supported back in 12, 13, 14, 15, 16, earlier in my time at the Fed, they made the banks stronger and they made them more resilient, and you really want that. You want a banking system that can stand up and keep doing its job in times of crisis. So, but the exact balance between that and the availability of capital and the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. As the member of Congress representing Atlanta, the city with the highest racial wealth gap in the country, I'm focused on creating an economy of inclusion, an economy that works for everyone and brings the most marginalized into our economy. Americans and Atlantans flourish when the economy works for everyone. The Federal Reserve has a mandate of maximum employment that is measured by analyzing various data points of economic conditions. In 2020, the Federal Reserve updated its approach to fulfilling and measuring this mandate to include job growth that was broad-based and inclusive. Chairman Powell, do you agree that broad-based and inclusive growth means job growth that helps reduce racial, employment, unemployment, and wage disparities?
I think it means what it says. We don't target any particular. We can't really target a particular racial or ethnic group with that, but we like to think that
so weak today.
Our decisions are informed by an understanding of diverse groups across the economy.
Well, Chairman Powell, could you share examples of how the Fed is including broad-based and inclusive job growth in the maximum employment mandate?
Sure, I'd be glad to. So one thing we do is we always, it's always part of the data that we look at each meeting. We always talk about it. We always mention it. Different unemployment rates and labor force participation rates and wage rates and things like that by racial, ethnic, gender groups and that kind of thing. That's always in the data that we look at and talk about. That's the first thing. So it informs our pursuit of maximum employment. We're trying to take a broader and more inclusive understanding of what that statutory goal means.
Thank you. 2 weeks ago, the Federal Trade Commission released data indicating that Georgians reported the most fraud and scam claims of any other state in 2022, amounting to millions of stolen money. The Federal Reserve's website has resources to help consumers protect themselves from scams where criminals leverage the Federal Reserve's name, including emails claiming potential victims are eligible for lottery winnings, robocalls threatening arrest in exchange for money, and other phishing communications. Chairman Powell, how does the Federal Reserve measure whether its counter-fraud communications are reaching the most vulnerable households and communities, especially those that might not be following the Federal Reserve press releases or your website or have limited access to broadband?
So we do, when those kind of scams happen, particularly when they involve us, we go on social media to try to reach people and tell them that if they're contacted by someone pretending to be a Federal Reserve person, that's not. So we do that. We work with our Inspector General who works with law enforcement to make sure that law enforcement's involved. So we're aware of these scams. I think you're talking about the ones that involve people pretending to be a Federal Reserve person and get in touch with me and we'll send you some money. And so we do what we can to reach out to the public on that.
So is that after the fact, but what happens before so that the general public is aware that this is happening? For those people who are not on social media or tracking is there another way to get this information out to the general public?
We do what we can. We're not an institution that deals with the general public very much. We deal with banks, and of course our rate hikes and rate cuts, our monetary policy affects all Americans. But I think when something like that happens, it's a broad program. It's a bunch of people who are perpetuating a fraud on many, many people, and we try to get out there quickly and try to reach people, and again, also alert law enforcement.
Thank you, Chairman. And Chairman McHenry, I yield back the balance of my time.
That is very kind and gracious of you. The first of the day. We need to commend that for the record. With that, we'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Chairman McHenry. Thank you, Chairman Powell, for being with us. Chairman, is the Fed's commitment regarding ESG not to force investment banks to renege on their fiduciary responsibilities?
We don't actually have policies in effect in that space. That's not an assignment that we have.
You saw some issuances by heads of some investment banks, not to mention any names, that felt that was the case.
That the Fed was asking them to, we don't.
SEC, Fed, you stated a couple of minutes ago that you feel that some sort of ESG, you stated that banks want it. And
I'm talking, no, that's different, completely different. It's regulated financial institutions that we regulate and supervise. They're subject to, particularly the big ones, are subject
to
the
Fed,
climate change.
You agree that
climate
the Fed
change issues all over the country.
won't ask banks to renege on their fiduciary responsibilities. The Fed won't do that.
We don't regulate the investment banks. The SEC does.
Okay, so the answer is no.
What's the question again?
I'll move on. Earlier, some of my colleagues and Chairman McHenry questioned the holistic review of the capital bank holdings. This holistic review, which no one has seen, according to my sources, but there are published reports that it will call for more capital to be held by banks. I understand the deferral to Vice Chair Barr, but do you have any thing that you could add that would warrant a need for large banks' capital increase?
So there isn't a proposal to evaluate or talk about yet. Vice Chair Barr has indicated he was going to take a look. He said he thinks capital is strong, and the question really is it strong enough? And I know he's been working, and there'll be a process when he does arrive at conclusions. He has no authority to enact something himself. It has to go through the Board of Governors, also through the FDIC and the OCC.
Okay, this has nothing to do with the QT.
Process.
I'm sorry, with the QT initiative, the tightening of the money supply. They're not related at all?
No, I would say not.
Are you comfortable with the QT reductions which have taken place?
Yes, the balance sheet is, we have the balance sheet moving down at a healthy clip, and it seems to be going pretty well.
Okay, so the Biden administration's fiscal and energy policy has caused trillions in deficit spending, as you well know, very, very excessive trillions. Meanwhile, energy costs for the average American have, from heating oils to gasoline, have increased by over 40%, and businesses, of course, in just over the last 2 years. So high energy obviously affects the cost for manufacturing, wages, general cost of living in almost every aspect of society. Would not such fiscal and energy policy of the Biden administration working hand in hand with initiatives such as QT and initiatives of the Fed be far more effective than the Fed fighting inflation on your own?
Well, I mean, we are the agency that has the responsibility to restore price stability, and we just have to do it. That's the task we've been given under the law. It's great if Congress helps. It's great if the administration helps. But we have to deliver it, and we will. That's our responsibility, which we fully accept.
We're not risking stagflation if the fiscal policy and monetary policy are working against each other?
Again, we don't comment on fiscal policy. That's for elected people, and we have a job, maximum employment and price stability. We use our tools. We try to stay in our lane, stick to our knitting.
It's just the fear of a number of people that we're going to have high interest rates and higher than 2% inflation if there's not that level of fiscal and monetary cooperation.
Again, fiscal policy does what it's going to do. We take that as exogenous. That's the fiscal policy will be what you and your colleagues do with, and that comes into the economy, and we see it, and we don't have a view. We don't try to comment on the decisions that you make, and we use our tools to restore price stability no matter what.
BBY GME hype
Happens outside of our building.
Sure. Okay. Mr. Chairman, I'll yield back.
Gentleman yields back. We now recognize the
Tess
ranking
is
member of
so
the
weak.
Oversight Subcommittee, Mr. Green of Texas, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Powell, for being with us today.
Stocks broke 120. Did you sell it, Moon?
Your work. But I would like to take just a few moments to talk about how our legislative bodies have legitimized systemic racism. It's been done by having a Fed that has a responsibility to produce maximum employment.
Time's up.
Knowing that the 2-to-1 black-white wage gap exists traditionally, and also knowing that traditional actions and methodologies will not change that. But yet, we won't give you the authority to make recommendations or to take actions that would directly target that. It's not your fault. It's the legislative body's fault. We perpetuate systemic racism in your mandate of maximum employment. We also perpetuate it in lending because we know that invidious discrimination exists in lending. We know it exists. And there are laws that will prevent and punish persons who cheat banks. You will be prosecuted and you will be fined criminally if you cheat a bank. No such law exists if you cheat a customer. And we know that black people
That's so racist.
who are more qualified than whites will get less money when they get a loan and pay a higher interest rate. These are all things that are the case. They're true. So legislative bodies continue to legitimize systemic racism. And the bodies have become so bold now, so many of the members, they're so bold now as to say they're sick and tired of hearing about this. They don't want a discussion about racism and systemic discrimination. They believe that all is well as long as all is well in the white world. But many, they won't say it that way, Mr. Powell, but that's the way their actions would lead one to conclude they have positioned themselves. Many of these people are my friends.
See if the spy bounces here.
People that
Put
I
engulfing at the bottom.
associate with, talk to regularly.
Greedy trying to go long.
But there comes a time when you just have to be truthful. Systemic racism can be eliminated. It can be dealt with. We know how to, but we don't have the will to do it. So I don't fault you. I don't fault you. Not one scintilla of blame would I cast your way. It's the legislative body.
Never used that
It's
word
the
before.
people who sit on this committee who won't allow laws to be passed, making it a crime to deny a person a loan who is qualified to get that loan.
Scintilla.
People on this committee
I don't even know how to spell it.
who will say they don't want to hear anymore. And
That gas
encourage
rejected VWAP.
persons who are
By
professionals,
working here.
experts, encourage them to push back against talk about
See if we can move back up to the top of this
invidious
range. But
discrimination.
I'm wanting a short by the time this thing's over.
Systemic racism emanates from the legislative body. And you, sir, are in a very awkward position because I genuinely believe that you'd like to do something about it, but you can't. It creates a sad state of affairs. I thank you for the time, Mr. Chairman, and I yield back.
Gentleman's time has expired and yields back. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized for 5 minutes.
Chairman, thanks for being here today. Probably get right under the wire here. I just had one, and some of my colleagues have touched on this today again, that there's certainly, I think we're well aware, I'm well aware, that there's a dynamic back in the district and across this nation. There's a certain segment of adults, 25 to 35-year-olds, many of them dual income, no kids, and they are completely froze out of the housing market right now, either because the cost of a home at a new subdivision in any municipality is $500,000 or more. And as a result of that, it's not only by actions of the Fed, I think, on the interest rates, but certainly the other thing I wanted to bring up, because the balance sheet at the Fed has gone from $4 trillion to $9 trillion post-pandemic, could the Fed, by no longer buying mortgage-backed securities, in a smaller universe of the private sector buyers who demand a higher rate of return, right? Is there not another kind of built-in trigger there that mortgage rates are going to continue to go higher, unrelated to what the Fed does? Because I think the concern is that between the dynamics of no new subdivisions, 25 to 35-year-olds unable to get a loan, and then interest rates continuing to climb, all of these factors are just, we're going to lose a generation of adults here that are never going to get home ownership. They're never going to benefit, which we all know is the big wealth builder for any family. So I'm just, if there's anything I take away from what we heard today in the questions asked, I hope that that is something that the Fed is in tune to and is looking at closely.
One thing is that the challenge with supply nationally, and that's zoning, it's people, it's materials, and so the housing stock is constrained to some extent by just harder to find zoning anymore because things are so built up in so many places, and those are not things that we can control. In terms of our ownership of mortgage-backed securities, what happens with them is they mature, or they're repaid or prepaid, and they run off on their own. That's a passive sort of way to shrink the balance sheet. And of course, they don't run off very quickly when rates are this high because people are not refinancing their mortgages because they have much lower mortgage rates. So, there's no evidence at this point that, that the market's having a hard time absorbing, the supply.
That'd be it. Hey, thanks, Ace. Appreciate it, man.
It's
That's
probably right. It has to be right that
very generous birthday
we're
gift.
No longer buying mortgages.
Oh, gee, let me think.
Now, and
Sure.
I hope we don't have to buy any more mortgage-backed. We don't buy individual. We buy mortgage-backed securities. I hope we're not doing that anytime soon. We only do that in really severe situations. That the fixed income markets are gigantic, and there's a lot of buyers out there. And where there's a yield, there'll be buyers, and I think I expect that'll be the case. It might, not that it wouldn't have some upward pressure on rates for us not to be a buyer anymore, but we we weren't a buyer for a very long time. We thought we'd never go back in after the global financial crisis, and we kind of had to after the pandemic financial crisis just to keep the markets working, and now we've stopped again.
Good. Thank you very much, Chair, and I yield back.
Gentleman yields back.
Thanks, Ace.
Noteworthy.
Appreciate the support, man.
I want to thank in particular our members, Mr. Fitzgerald and Ms. Williams, for their additional minutes back to the Fed chair. In a rate environment like this, time is money, and that's much more valuable these days. I'd like to thank the chair for his testimony. Without objection, all members will
Consolidation
file
for sure
legislative
today.
days with whom wish to submit additional written
Once this is over, we'll
questions
see
to
if
the,
that
witness
get
to
that
the chair,
drop.
which will be forwarded to the witness for his response. Ask you, Chair Powell, to please respond as promptly as you're able. And with that, the hearing's adjourned.
Thank you.
That's it. Ooh, all right. Nothing new. Oh, shoot. Now we're getting the sell-off. It's happening so fast. Don't happen so fast. I panic shorted. Close my lungs. Look how quick that. It's literally right when it ended. Boop, red. Yeah, nothing too new there. I don't think. We can look at the headlines. We'll just sift through all that. Happy birthday, Happy. Biden budget aims to cut deficit but nearly. Yeah. Need more coins as more are sitting in people's homes. That was a problem during COVID. I don't feel like circulation is probably fine now. They were just talking about it. That coin collector guy on there. Didn't want that ever to happen again. Alright, SPY's coming down here. It literally was right when that thing ended. I knew better than to try and go along for one more bounce. Powell said $1 trillion coin solution to the debt ceiling crisis would be a rabbit out of the hat. There are no rabbit out of the hat solutions. U.S. FERC allows Freeport LNG production up to the maximum capacity authorized. That came out at 12:30. It didn't really cause any change on the nat gas. Yeah, answer yes or no whether the Fed will pause rate increases. I don't do yes or no. You're gonna be breaking legs. Flipping that coin into a fountain. Better be a good wish. Let's see where the day shakes out now that that's over with. I think, let's see, it's Wednesday. Got Beige Book in an hour. That's only it's left today. And then tomorrow, jobless claims, which definitely could have some effect. And then Barr speaks. And Friday, unemployment report, unemployment rate, average hourly wages, employment report. So not a whole lot. I think I'll probably keep shorting bounces, adding to the MES. U.S. 9-year, 11-month notes rise 3.985%. Powell says we only buy mortgage-backed securities in severe situations. Jean-Pierre says economic indicators do not support a recession.
Signed for this company. They also got price hikes from Citigroup, Barclays, JP Morgan, BMO Capital, just to name a few. Street still feels really positive on this name, Alex.
Yeah, that's a takeaway to me, is there wasn't anything in this report that
Crowd
changed
strike.
that. If anything, it increased the optimism. You can see across the board in that far right column,
Today's
buy,
his birthday.
outperform, overweight, buy, outperform. Different ways of all saying the exact same thing, which is we like this company. You see a couple holds. Those are the exception, both at Stifel and Jefferies. But all in all, high price targets.
Yeah,
on this
not a whole
name,
lot new,
pretty
I
much
don't think, in
across the
that
board, only getting higher
testimony.
post earnings. Of course, the stock itself is reacting positively as well, but it has come down just a little bit as the overall market has lost some of its momentum. Going to say upvote for CrowdStrike. Always a
Buys
good
bouncing here a
opportunity to talk
bit.
this name, as it's been so much in focus in that key kind of cybersecurity space, but also in the technology space, in that high beta space that's been punished. So it's sort of got
BBY
one,
retested the
on the good
127,
side of
but
things and
it's
one
now
foot on
barcoding
the
above it.
struggle side of things,
So
and so that always makes it
maybe a little double bottom on the
fun
day.
conversation. Maybe the technicals can clear up that dichotomy just a little bit, but
Ops.
go ahead and downvote tab.
Came back
upvote
down to
CrowdStrike.
VWAP.
Next on the list though is on another name in green. A lot of green today. amongst
GNS
these
actually
names-
green.
these names.
I know, similar to actually yesterday, we were talking just the outperformers of the day. I like kicking things off on a
Cosmo's
positive
still holding
note.
up nice. I
On
still like this.
Semiconductor, that has been a story that's been positive longer than even outside of this year and today. Really, over the last 12 months, shares are up 46%, which is something we haven't seen consistently with a lot of these semiconductor names.
Powell is
although
now
seeing
coming down
relative
below
strength across
VWAP.
the board here. But B of A now fueling the hype, raising its price target on Semiconductor to $100 a share from 90 with a buy rating. This follows, they said, management's confident presentation at a broker event, as well as recent news of an EV win
Bath,
with
a little wick
BMW
higher there.
partnering with On Semiconductor. The analyst said that despite
Haven't
these
really had a
macro
pop
headwinds,
like we did
auto
yesterday yet.
semis remain a bright spot.
Only 1 o'clock, I
as
suppose.
confirmed by On as well as several
That gas
other
is also
peers, and they continue to identify the stock
kind of making
as the stock
higher
as a
lows on the
top
5-minute.
autos pick. Now up a whopping 82% from its low, down only about 7% from its high. So an interesting chart over the last 12 months.
Yeah, we've talked about this analogy a couple times, and they're never perfect comparisons. But we talked about the gold rush time, and, all the
melting.
miners flocking out to the West Coast to, find that gold. And we talked about how, if you were just someone who happened to be selling mining picks at that time, that it would be a pretty lucrative business, for example. Well, in this way, this is almost a modern take on that in some capacity. All these EVs have all this technology built in them. And of course, we know that when it comes to the minerals and things that they need to build those
BBBY now at
batteries.
130.
But they also need these semiconductor chips. And so if you can be well positioned to deliver that across the board or to some key
Head and shoulders
players
with
within
extended
that
hours.
electric vehicle space, you don't even necessarily
Even without it.
need EVs to be surging, but rather just constantly growing a little bit, and this is sort of that byproduct of that. So I think it's a kind of a fascinating take. Who knows ultimately how it'll all play out
Point
for
short
On
on SPY.
Semiconductor and the rest of its peers. But I'm going to say upvote today.
All right, yeah, right, literally right in the meeting end. Ended was right here.
That presentation at
red
the Morgan
candled.
Stanley event.
I don't know if we're gonna move like
and
yesterday
obviously the
since
stock's doing
there's
quite
nothing new,
nice.
and
$100 price target, that's a 25%
this happened from his statement
rally
already.
from here.
The
if we were to
trend
get
though is
there.
probably
It's pretty impressive that B of A is showing for this company.
Okay, now our next name, in a complete contrast to On Semiconductor, is Occidental Petroleum. And why I say that's a contrast is the fact that Occidental Petroleum has been
we're
a
already at the low,
consistent
so
name
going
of
short here,
strength over the last
you're going
12
for a
months, but
breakout.
giving up a lot of those gains and enthusiasm with this new year. Shares are actually lower 2% for the year. But Warren Buffett still feels pretty optimistic, as we did see Berkshire Hathaway add to its already massive Occidental Petroleum stake over the past several trading sessions per a regulatory filing we got on Tuesday. The company bought nearly 5.8 million shares of Occidental in a few separate trades on Friday, Monday, and Tuesday, paying prices ranging from just shy of $60 a share to roughly $62 per the filing. And now the latest purchase, which totals more than $350 million, marked the first time that Buffett has hiked his bet since September. There have been a
Lebanon's
string of
commercial banks don't have
purchases
enough
from
liquidity to
Warren
pay
Buffett
back
and Berkshire
depositors.
Hathaway that since paused. So
Oh.
now seeing him
Secretary General
re-enter
of the
the name.
country's
No wonder we are seeing shares lift
Banking Association
today.
has said.
Berkshire now owns roughly 200 million shares of Occidental, worth about 12.2 billion, just, you know, small sum. But they also own about 10 billion of Occidental preferred stock and have warrants to buy another 84 million shares worth about $5 billion. So they do still have the room to further add to this position. And what I find fascinating is this isn't even their top holding. That just goes to show how massive Berkshire Hathaway and their holdings really are.
And I think it also highlights the fact that to move the dial at a company like Berkshire, you gotta make big positions,
what
right?
this was
I mean,
from.
you just talked about this isn't the biggest position, yet it's a massive
Is that a real
position. All by all metrics. But if we could we pull up a 5-year chart of Occidental? And I want to highlight something. You could compare and contrast this to any name.
That's right when it came out.
CrowdStrike potentially
That was
could
crazy.
be a good one as a name that we talked about.
Yeah,
We
I think
talked about
I
it
went
so
short there.
often
Actually, that was my first short. Was down here.
Post-pandemic, we saw these giant run-ups in companies,
Be
and
patient
then the
sometimes.
subsequent
It's
sell-off
exciting,
over
you
the
gotta go
last
slow.
year. Well, you see the exact opposite in Occidental Petroleum, a name tied to crude oil, where we know crude oil had that vicious sell-off and run with volatility post-pandemic. We saw demand fall off a cliff. But then last year was the opposite. There was intensifying demand and, of course, supply concerns leading to the rally. But if you really look at it in the context of the last 5 years, as impressive as last year's rally was,
You should
just
paper
getting
trade it
back
if
to
you're asking that
kind of
question.
where it was before the
Learn
pandemic.
how to paper trade
So
it first.
things have a way of normalizing, not to say that prices mean reverting or anything like that, but oftentimes when you see kind of these big shifts in asset allocation, the underperforming names of the previous years become the outperformers, and the outperformers become the underperformers. I think that the last couple of years really highlight that as you compare and contrast Occidental Petroleum, for example, with really any of those big tech names.
Yeah, like you said, a complete inverse of a lot of the other names we've looked at, like a CrowdStrike or an ON Semiconductor, which is why I found that chart so fascinating. But we'll be moving forward today with our two uploads, those being CrowdStrike as well as ON Semiconductor. We'll be diving into the technicals, looking at some example trades in both of those names coming up next.
The video, Ruthless shared this video on Discord. What talking about? Always showing the fractals. That's a pretty cool tool. Not delved into TradingView. Yeah, so I'm saying it's exactly what I was saying. It's been stretched out. So the good news, okay, good news if we do get the RSI divergence on GME and it's repeating a pattern, is that it's still in a pattern and it's still broken. It's not been fixed. Bad news is that they've stretched out the time frame. It's not a play as often. What is he getting at here? I'm looking at trade spotting, yeah. Wait, what did he just do there? You should flip it upside down? What the heck? Just a bit of opium. He's going by the date, but then it flipping up. Zero risk in trading a stock. Okay. Kind of interesting. SPY's hanging out at the low still. Can't believe I looked away from SPY for that long.
Move
I'm sorry.
upward, but it's taking us back
SPY.
within
Never
an
again.
important technical level here, which is that the boundary of that channel. And we also touched right on the money of this 125 level, this green dashed line here, which was an important point as well because it was the start of this gap right here, and it was also where price topped out twice there and there. And the gaps on this chart are actually looking relatively significant here because we've got, as I said, the 125 level, and we've also got the 137 level here, and that's where this previous earnings gap opened up. So we're kind of bookended between these two gap levels here, 125 and 137, and we're in an area of relatively thin trading as well. You can see on our volume profile here, we're kind of in a trough in terms of the trading volume at the price levels that are near where we are about right now. So we could be in for some movement to either side to get out of this area of low conviction into an area of higher conviction here. RSI also looks a bit better than you might think based on the
SPY's coming down here still.
So far today. We are rising above the previous two peaks that we saw there, making new relative highs with price. So that's a better sign, perhaps, for the bulls here.
After cutting
now,
losses
if we
from
do
my long
keep
here.
regrouping
I didn't know that was
and
supposed to
start
end.
move
Just
upward again,
end so abruptly.
I did mention this 137 level. The 150 level also stood out to me as well because this is the old highs from right here.
Retesting the support down here.
Roughly the level of our
See if it flushes
252-day
through it or
exponential moving average in purple there, which is about 151 or so. So that could be another a key area to watch going forward. To the downside, we've got this area right here. Our confluence of our yellow 21-day EMA, our orange 63-day EMA, and our lower trend line of that channel all coming together right around the 119 mark.
Really, Rick, seeing less optimism here with this move now fading significantly on the day, which I think is a really good point, but not necessarily the massive selling we've seen in a lot of these software peers.
Starting to get
so for
some
that reason, I
BBBY
am
shares.
still optimistic on CrowdStrike. We saw names that are similar, like a Zscaler sell off like 10% post earnings. So sort of putting it right now in the middle to high end of the pack of the cloud names we've heard from thus far. So Alex, with that in mind, we're not seeing this outsized move and it's not able to hold. And as we were speaking, I noticed the NASDAQ now slipped into the red territory. So
buy
perhaps some more.
Yeah, if you're down 40%, that's a nice average if you still believe in it.
Well, the analysts seem to be
Believe the same thing you did when you bought it.
With the results,
You're down
liked what they
half.
saw. You saw a lot of price
You
target hikes. You see a lot
bring
of
your average down quite a bit.
ratings on this name, and say you subscribe to that belief. Rick had highlighted that markup at the 150 level that had stuck out to me
your time
as
frame
well, and I used
Turca.
that
Assuming
in
you trade it
mind when I
today,
built out this
just
trade
got
illustration.
this bounce.
Now, bear in mind though,
Yeah, that was probably
at the
smart to
time
get
I was
out.
looking at this, the stock was closer to.
I think this is more or less a
let's
dead
call it
cat bounce.
129.5.
If the reversal won't
Sold
just
off
immediately
about
happen after a
$1
move
or
like
2
that.
cents. So the pricing may
head and
adjust
shoulders,
slightly
sort
here.
of, shoulder,
But
head.
if you keep that in mind when we're looking at this, I think it'll make a little bit more sense. And so what I looked at was buying a call condor. And so that essentially consists of both buying a debit spread and selling of a credit spread
or at least
using
consolidate
all of one
somewhere.
type of option. In this particular case, we used
This is just a bounce from a huge
for this
reaction to the
illustration.
downside.
And we did something, as Kevin Hinks would say, kind of give it some
resume.
attitude, or really just sort of change the risk profile ever so slightly to reflect a more bullish outlook. And so what I did,
yeah, you heard it here.
I looked at a $10 wide debit
From the
spread,
Fed, it's
one
fake.
strike in the money, then one strike
Fake
out of the money
who
there.
cares?
The 125, 135, and again, the stock was trading closer to 130 at the time, and so that was reflective of that current price. And then, of course, we talked about
Ace,
that
when are you going to start
150
averaging
mark. So
down?
say you're of the belief that you see upside in CrowdStrike, but you think that it's going to bump into some resistance.
Like a dick. Fat
So in order
folds
to
of
chip away
Bobby.
at that debit, increase the probability of success.
So
a little bit, we
descriptive,
went ahead
that
and we
analogy.
added a component to this by selling the 150, 155 call vertical. All of this can be done as one four-legged trade, again referred to as a condor. And this creates almost a plateau-like effect between the 135 and the 150 mark, which is that $15 wide window, which is the max profit. So again, if this is done at 450, the break-even would be 129.5, which at the time was pretty close to the current trading price. It can max out to the width of that $10 wide spread net of the debit paid, so that's 550. But where things get a little bit interesting and maybe less favorable for the investors, if it does breach 150, goes through 155.
It is crazy. BY
To give back
raised
some of those
135
gains.
million
In the
today.
event that all of these
Is it
options were in the
135?
money, they offset each other.
And their market
and
cap
went through
is
that
actually
assignment
150 million.
exercise process, it would level off for a $50 profit, not accounting for transaction fees. So that, of course, would be, again, if all those options were in the money, best case scenario would be a pin between 135 and 150, where the debit
I
spread
think
goes to max value
XM
and the
can go
credit
all the way
spread
down to 0.
goes worthless. So interesting way to look at CrowdStrike here, Jenny. Bullish, but not too bullish.
Last time we were close to this price.
Gears here. For the
There's only
chart,
been
I'm
this
actually
price one
more
other time.
excited about than
Back over here.
CrowdStrike is the on semiconductor, given the fact that it's been able to hold on to now its 46%
Even say
gain over the last
manipulated.
12 months. So
Some
even
would
outside
say.
of the strength we were seeing this year, Rick, I
Eyes
found
bouncing
this,
a bit
this
here.
yearly chart to look really optimistic, considering the space in which it falls, which has been pummeled over the long term. So walk us through what you're thinking here.
Yeah, this one is looking rather strong here. We had a price target upgrade to about 100 today, so that would be roughly 25% or so upside, taking us into new all-time highs. So that would be quite a move that these analysts are foreseeing here. And the more recent price action, ever since we bottomed out here, we had a very sharp, steep upward move here that took us into those all-time highs. We've since backed off a little bit. Not really super uncommon when something has a steep rise like this. Traders kind of tend to regroup afterwards, maybe take some profits. But the level that we ended up around during this decline, right about here, the 63-day EMA is where price opened up and recovered above that level as the day progressed here. This gives us now another trend line to watch, this blue dashed line that's still in play here. So we did break above our yellow 21-day EMA recently, so that becomes a new point to watch for some potential support. 78, 79.
Yeah, buying all-time lows is
that level
not
here.
necessarily a
Just
good thing,
below that as
especially
well,
once
the
it's recently broken
77
it.
mark is about where price topped out here.
I went
and here,
short on
and
Rivian when it
didn't
broke
quite
all-time
reach
lows
77 here.
yesterday.
I'm just using round numbers for ease of reference
From
here. But
news
that's
and dilution
around
as
where,
well,
where
but
price
still.
found some support near this level as well.
If it holds the
looking
all-time
at the
low, that's
RSI,
a
our
spot to
measure
buy.
of momentum here.
A bounce off of
RSI
it.
broke
You're just
above
going for
the
that.
50 midline, so the momentum is back in the hands of the bulls here. And this candle that we're forming today is still pretty close to the highs of the day, so it's looking fairly strong still. In terms of resistance, the 87 mark, just above 87, 88, that would be those all-time highs that we need to break above in order to continue that climb up to the 100 level here. So keep that in mind going forward, but it's looking pretty good.
Market's
like
not
you
as
guys
scared
said.
today.
So some optimism in this name, Rick, and I love to see it when we're seeing not only the RSI match the price, but just overall enthusiasm from
interesting.
our chart master. So we'll leave it there. Appreciate all of your thoughts, as always, Rick Ducat. And Alex, we're looking at trading this name now, considering the same optimism that Rick pointed out, and the fact that we don't have an earnings catalyst really in the near term for this name. What are you thinking for an example?
About 150 more, why not?
Yeah, air may be getting thin up here, as Rick had been talking about, with the lack of price activity, potential new
Yeah, they just
all-time
got
highs. But say
funding
you're a
that
believer in
basically
what Bank
matched
of
their market
America
cap
had to
at this
say
price.
about this company and what this company has done over the last few years, and you see that continuing, and you see that $100 price tag potentially in the near term. I looked at a call calendar that centered around that $100 strike for this particular name on the call side. But to give it a little bit of time for that to actually happen, as I think we all mentioned, it would be about a 25% rally in the stock to actually get to 100. I looked at buying the April-May 100 call calendar on this one. $1 debit means $100 in risk. So with this
something,
one,
GME.
the money spent on the trade is the actual
Don't worry, it's
risk,
going to
not
keep coming
accounting for
down,
the transaction
but it might
fees. And
not be
we've
as
looked at
fast
this
as you
risk
like.
profile so many times
Today it did kind of double bottom
over
there, though.
the last few years on this program and others.
But
This is a strategy that does best the more accurately you can project the future price. And so we used, for illustration purposes, the price target from Bank of America on semiconductor, which was 100. And so this can be customized to a different, particular outlook that an investor or trader may
Ace,
have.
why aren't you selling covered calls on it yet?
You can see the apex of that
I know you've been
profitability
paper
journey is
trading
right
them.
at that strike, which is 100. So in this case, that's the best case scenario. But it isn't necessarily need to be perfect. Just the closer it can be to that,
Every one
the
of us
better.
buy,
And that's
then we
illustrated by
could
the
see
fact that
pushes
you
up.
see the descent from
I
that.
don't
But it isn't
think
just
so.
a sharp
Unfortunately,
descent.
our
It
orders
is
don't
kind
go to
of
the
a
markets
net cast over
that
that
affect the price.
region. And we can look for a move towards that $100 mark, and that would be beneficial. But no doubt it's bullish. If the stock's trading $80 and you have a $100 call counter, you want the stock closer to 100. It's going to need to go up for that to happen.
Yeah, I think that's really well put. And two different ways to look at two different bullish trades and names that are having, although similar price activity today, obviously different price action over the last several months. But also important to keep in mind for both of our example trades today, multiple legs can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now, coming up next, it's time for FOMO. We are looking at Maxian Solar, ticker symbol MAXN, really surging on the day following its fourth quarter results. We'll tell you more about them coming up next.
Buy on the grind down. HKD is still holding up. Check to see how they did. So you did paper trade actually cover calls? What, paper trading account? Yeah, Tesla had nice little sell off, and just very weak all day today. Just flat down here, bear flagging. The only thing is it's oversold on the hourly, and bounce. SPY is now dropping with some velocity. Rivian did better than Tesla today. Paper account, Ace. Simulated account, like your cover calls. New low on SPY there. Looks like it's getting flushy. Go practice disc golf. All right, see you, tree. SPY's flushing. You mean not yet?
might be a little bit on the wishy-washy side, but for a name that is so polarized, people want to hear, is this going to the moon or is this thing going out of business? Because those seem to be the two takes when it
BYY's
comes to Tesla.
It's going to go crazy.
This,
It'll
maybe
happen.
a welcomed, honest
Pretty
reflection on the
confident.
company, saying things are all right, but it's pretty expensive.
Yeah, I mean, the company trades at a very expensive
Disc
multiple
Dan.
compared to some of the other automakers out there. At some point, even 5 or even 6 times the multiples of the traditional automakers like GM or Ford. So yes, there's always that question of, is it rightly valued at this point in time? What is the upside potential here in the near term? So it's always going to have those factors. And then obviously the Elon Musk, I wouldn't call it debacle, but his ability to capture news headlines, if you will, also has an impact on the company. But we had the investor day a little bit over a week ago, I want to say, and they actually did provide a lot of plans for the future, but the market was really upset about it because of the lack of timelines for enacting some of those strategies as well, which is also another reason why we saw the stock sell off a little bit post that event.
No doubt. Kevin Green, thanks for the update. A name that seemingly is in the headlines, not just once a day, but like all day long, every single day in Tesla. But always a pleasure. Thanks for joining us, senior markets correspondent for the TD Ameritrade Network. Let's bring back in Jenny. Not going far within this kind of realm of the future and alternative energy sources. We're going to the solar space, and I think it's pretty clear why when you key this one in on a platform. Symbol MAXN. Things, we're talking about going to the moon. This thing's trying to go to the moon.
I know, and speaking of, Tesla, a name that we talk about the headlines every single day, all day, every day. This name I don't believe we've ever talked about before, but seeing a really interesting move today on the back of what was a mixed fourth quarter, but really strong guidance, which I think is part of the reason we're seeing shares accelerate. But to break down what we saw, shares are up over 33% on the day after the company did log its fourth quarter revenue that came in better than expected on actually adjusted losses that were steeper than what the street had been expecting and sank from even year ago levels. They did, however, really then post, I'd say, all in all, their guidance beat on all cylinders. They did say now they expect their quarterly revenue to fall between 323 and around 323 million, actually, which was well ahead of the 221 million they posted a year ago, and also well ahead of what the street had been expecting at around 315 million. For the first quarter, they expect now earnings to fall between well above consensus, and they do also expect the most important part of this entire thing, Alex, that their first quarter, they are expecting positive earnings on an adjusted basis for the first time since separating from SunPower back in 2020. Now, this company is unique in the fact that it is a Singapore-based company focused on solar panel design and manufacturing. So I would say similar to a lot of the solar names we discussed, like a First Solar, even a SunPower, Sunrun, but different in the fact that this company is an international player.
It's not one to
now
give it
it's
up.
up over 56% here today. It's up over 84% in the last 12 months, so actually outperforming this broader space. Now only down about 10% from its yearly high and up a whopping 185% from its low. So more interesting to me than the earnings actually was its forward-looking guidance and the chart that is absolutely astounding today.
Earnings?
Yeah, definitely. And I think that you highlighted the key piece. You underscored it, you put it in bold, and this is that they're forecasting positive EBITDA. And it's one thing to say it, it's another to actually do it. But we've said this with so many of these names. It's like you can have this big plan for the future. You can save the planet. You can bring all these things that
last year's April
for some of
13th.
these scarce resources as
maybe not till
alternatives.
next month.
But if you can't do it
GME is a bit
profitably,
before then,
how
I
are you
think.
going to do it at scale? How are you going to survive those tough economic hardships? And so to round that turn, assuming that they ultimately pull that off and they're able to do that sustainably, this is an
BBBY
important moment.
owns
This is kind of that
baby.
key moment for a name like
and all those
this.
store
I think
closures, like you're going to see
it's, of
some of
course,
that on the
leading to a
earnings because
tremendous rally today.
the earnings report we're
But
getting
again,
is
it's one
not
thing
like
to say it. It's another whole
I don't know when
different
their
ballgame
fiscal quarter
to
ends, but
actually do it and show those
they've maybe
numbers
closed
next
a lot
time
of
we
them
hear from
since their
Yeah,
fiscal
that's a
quarter
really good point. It's
ended.
another thing for the street to speculate too about their path to profitability. But this company, for
And it'll take time
management
for
to
that
actually
to
address,
even reflect
this will be
on their
a near-term focus for them. I think is a lot
financial
of the reason we're
statements.
seeing enthusiasm today. We did also
Because they were
see
paying
some
for it up,
enthusiasm
that
from
whole quarter
the
and then
street right
just
now.
close them. It's
Northland
not going to change
Capital
stuff
actually
right
raising
away.
its price target to
They'll have to wait a couple
$31
quarters
a
or
share,
at
which
least
would
another
imply a
quarter.
good deal of upside for a stock that's trading at about $25-ish on the day. Given the fact that we're up almost 35%, this analyst feels that there's further upside by about $6. MKM Partners,
BBBY, I
another
think,
name,
definitely
raising its
closed a lot
price
more stores
target,
than GME
although
did, though.
that price target implying about $21, so actually signaling downside from current levels. But difficult to trade this name, Alex, on a day when we're seeing such a
that
move
question is why
higher.
people buy
Another name that
BBBY
I
at this
compare
price.
this to, and a very, just in terms of price action, they're very different companies, is, WW International yesterday posted a massive gain, and then we're seeing things sort of ease off today. So that's always my concern, looking at names making such exuberant moves to the upside or downside.
I think it's a good point. One's a $4 stock going to like 5 or 6.
Right.
One's, at least got some meat to it. At $25 here. And so say you're a believer, say you see this thing going to 30 potentially in the near future, and you want to bet on that through the likes of an options spread trade illustration. I got something for you. So let's take a look at it here. What we're looking at is going out to April, buying the 25-30 call vertical. So oftentimes, Jenny, when we do these, we talk about setting it up where it's, half the width of the strikes. That'll give you sort of that equal risk to equal reward. Well, let's just say that this one could be perceived as a little bit more speculative. You talked about it making this massive move today, and sometimes we see these names go on crazy runs to the upside, and maybe it is somewhat short-lived. And so I wanted to look at something that actually takes a little bit less risk than the potential reward. And so this, one, a function of the current price and the options available, but two, an interesting way to look at this on maybe a more speculative space. And so what this one does, if it's priced at $2, it can actually expand to 5, so we can make 3. So risk 200 to make 300. Break even at 27 is ever so slightly above the current share price. And of course, that doesn't account for transaction fees. But assuming the stock does rally, maybe it goes through 30, this one has a chance to return a little bit over 1.5 times the risk, again, not accounting for those transaction fees. On a directional trade, where oftentimes we look at the ones that are equal risk to equal reward.
Yeah, I think that's really well said. And considering the fact that we are risk defined here in case things do ease up, although this move higher today has held, which is a lot different than our next name we're talking about, and that is Apple. So that does it for our FOMO segment. But like I said, we'll be diving into Apple that has since given up, 1.5% of its earlier strength, still up just shy of 0.5%. We'll dive more into the Wedbush analyst and some bullish price action, despite the fact that its gains are easing on the day, coming up next.
AMC squeezing? With a vote? Jeez. You would think it wouldn't, but maybe that means it would. The vote for dilution. Is there an actual vote? So it's possible if they don't converge? Is it shareholders or board members or who's voting? You could get volatility on it, I suppose. Yeah, one way or another. All shareholders? $14th? Huh. Maybe. Yeah, when AMC had a share offering, that's when it squeezed. They offered all those shares like here, or here. And like 2 weeks later it squeezed, but that might have been irrelevant. But as far as the vote having effect, yeah, you would think if they denied it or didn't vote for it, it would cause it to rally, but not necessarily. Maybe having dilution would cause it to rally. That's a good day to look out for, though, because that could have an effect on GME if it really does make a big move, and even BBY. Tesla's coming down with this. No, not really. Rivian, maybe. I don't know what you're talking about. There's two different chat orders you can view. Use it slow. Live chat and then top chat. Live chat's just the latest chat, no matter who it is. Top chat is like more important chats, I guess. I don't know. I don't feel like the chat moves fast enough for it to actually make a difference.
More of a move to the upside, but it's giving up some of that strength on the day.
It is. In fact, when I reported on it in the pre-market, it was pointing to a higher climb, but right now it's since eased a little bit. However, Dan Ives over at Wedbush has hope for this stock to continue to climb. That's why he raised the price target to $190 from $180, and he kept a buy rating on the stock. And this is all because he believes that a clear demand rebound is happening in China. That's a key region for Apple, of course, iPhones as well. That's the primary thing. And he believes that that reflects a pretty steady demand curve also on the flagship iPhone 14 Pro in the March and June quarters. Now, he said that there hadn't been any major unit cuts from suppliers in Asia, and that also supports that demand curve as well. Now, he says that the United States and Europe are also holding up pretty well when it comes to demand for Apple products and for the iPhone in specific, and that about 25% of the current iPhone installed base has not upgraded their iPhone in over 4 years. Are you a part of that number? I might have upgraded mine maybe 2.5 years ago. But the fact that people haven't updated their iPhones in so many years means that they may be upgrading pretty soon, right? And also,
what's
Dan
forcing
Ives
shorts
talks
to
about
close
the
or longs
possibility
to
of
buy?
other products and of the growing Apple services
some forced
category,
closures.
which will be very important in the
Forced closing
quarters
is buying.
No doubt about it. I think that that's something that Apple's been very keen on, that upgrade cycle extending. I know I'm guilty of that. I think I broke my phone during the pandemic, kind of stay-at-home period, and I remember having to go over to the store and get the new one. Haven't thought about getting the newest one ever since, and so it's very different than it was, 10 years ago. And I say this every time, going from that iPhone 4 to the iPhone 5, you felt the difference. You could see it. It was tangibly improved. It's just such a powerful device now. The changes are incremental. They're subtle. And that isn't necessarily a bad thing. It's just, they're a victim of the successes that they've had. But because we're buying them less often, we tend to buy the more expensive one.
There's been stocks on Reg Show for like years, I think.
Because we know we're going to have it a little bit longer. I know I need to get a new iPad. Mine's couldn't even tell you which one it is. But Renita, I also saw UBS. They didn't change anything. They kept the price target the same. They kept their rating the change. But they weighed in and talked about the company a little bit, saying that the App Store trending flattish was the word they used. Quarter over quarter and year over year. So maybe those services are waning a little bit, and we know that it's been the big focus, though, really has been that pivot. Try to neutralize that iPhone exposure ever so slightly to those services, which I think Dan Ives was mentioning as well.
Right. Absolutely. You're absolutely correct. And so, hey, a lot of times it's the broken current iPhone that leads to buying the new iPhone. So maybe a few people will be upgrading because of that.
She's actually in a real place.
Renita, I'm single-handedly supporting their services revenue right now because I'm the fool that pays. I think I pay like $14.99 per month for their Apple Care Plus because I know myself. My phone likes to go swimming. I don't know why it does. It just does, and I lose a lot of phones to water damage. So for that reason, I just keep replacing my save iPhone 12. So while I do replace it like every year, I haven't upgraded, which is part of the problem, I guess.
I might close my shorts here.
They have made that option available to me, so I'm saving some money, but not great, I guess, for Apple. But at least we are seeing things recover in that key China region, which is a huge, huge part of their
Oh,
overall
so they're in
revenue. So
Germany.
really interesting note from Dan Ives. Apple, always an interesting story.
Yeah.
So like to talk about Apple as much as we
Or in
can, but we'll leave it
America.
there. Renita Young, senior markets correspondent for the network. And now coming up next,
Or
it's
Home
time for
Depot?
Under 30. We're
Maybe-
switching gears
maybe go to
here,
Bed Bath
looking
&
at
Beyond.
Lifetime
Don't know if we're
Group,
gonna have enough
the
time.
fitness operator. We'll dive more into that space with George Tillis coming up next.
No Depot. Wait. Just short the bounces. Urban One is even up a little bit. This thing. Pop's just hanging out the low or at the highs still. Right above that $1.20. Oh, say it might be about to break. ISPO up 22%. Jeez. SLGG up 5%. The gamers. It's your birthday again. JP Morgan is cutting ties with crypto exchange Gemini. GME with a pop. A V pop. AMC did the same thing. Weird. Buy new low there. You have been misled. 10 minutes to 2 o'clock. I got Jason. Tops looks like it broke out. Yep. Tops 1 1/4. $129. Says like the next resistance on there. Not sure if SPY's gonna bounce him here or not. LP. Yep.
3% over the last year.
Lifetime
and
Fitness.
Net Center membership growth actually fell in the last year. So what it really comes down to is the elasticity of demand. Are there enough people willing and able to pay those premium prices for fitness center memberships of this quality? And then again, is the higher price offsetting some of the attrition or people who are canceling memberships just because they just find right now there's no appetite for higher end discretionary spending, especially these recurring subscriptions like gym memberships. Planet Fitness, for all intents and purposes, is extremely cheap. These are the types of memberships that people tend to forget about because they're like $10 or so per month. But when you start getting into the hundreds of dollars per month, especially with inflation right now, people coming back, that might be what we're seeing in playing out in terms of the price action today. The company's guidance for the next quarter was somewhere on the lower end of the midpoint guidance, but just fractionally. But nonetheless, you can see that the stock is down quite a bit because effectively it comes down to, yes, they beat on earnings, they fractionally missed on revenue, but is it quality earnings? Can they, in other words, keep up with these higher price increases on a forward basis versus the lost memberships due to those higher prices?
George, you used the term a want, I believe is how you described it when looking at this type of a price tag for this type of a service or place to go. But I'd take it one step further. I mean, we're talking about Ferrari. I know Ferrari is not the same as Lifetime, but it's not only a want, it's also a can. I want a Ferrari and I can buy one, then I might be able to get one. In the case of spending $300 or more a month on a fitness club, I know they're not all that
Gained weight when
expensive,
you left US?
but there's also probably an element of I can also afford that if I'm going to do that. And there's that added element because it has that sort of barrier to entry. That maybe there's that feeling of exclusivity a little bit. Maybe it feels a little bit like you aren't waiting for machines or whatever it may be. Maybe it's a little bit cleaner. Whatever it might be, it has that feeling that it's worth that to the consumer. And I wonder if you just put a big price tag on something and people just start to believe that.
SPY's getting a bounce there.
I think that is the
See,
case
GME was the
here.
front
I think
runner.
this is the playbook the company is taking.
Follows GME.
In other words, the tactical approach of increasing prices 20%, knowing full well that they're going to lose active members, which they denoted in the quarter. But they again command that exclusive or premium pricing for those who stay on, or those who are willing to now, sign up. That's again these questions you have to ask yourself. There's always a market for exclusive services in this case, or goods. Higher end cars and things like that.
And
then it comes down to the growth of the company and also the growth at a reasonable price. Now, if you look at the reaction today, we're down about 7% or so right now. Not a lot of volume trade in the stock. The market capitalization is around $2.2 billion. But at the end of the day, the company does have about $4 billion in debt as the company re-emerged on the public markets back in 2021. And the other thing is you know, when you're flirting
Restaurant
with
food every
break
day.
even, because in the last 3 quarters,
I see.
excluding the one they just reported, they didn't actually show adjusted
Yeah, they don't
profits.
probably.
This quarter
I mean,
they did.
that's in the
But on a
restaurant, but
forward basis, it's
restaurants
sort
could
of
use
on the flat near
kind
the
of
flat
cheapest
line.
ingredients.
What I'm trying to say is they're not expecting a
Probably
trend in profit
have more
growth
sugars in
going
them and stuff,
forward.
anyways.
And so I think this is one of the reasons we're seeing the sell-off today, because of the fact that, you know, this might have been a second half 2022 story where prices were raised significantly enough to offset some of the attrition or lost consumer subscriptions or memberships in this case, for those who decided they're giving up on it because they don't necessarily find the premium or exclusivity component of this spending to be worth it anymore.
Yeah, and George, that to me makes perfect sense. The fact that they're not necessarily guiding for this continued strength going forward, because I mean, I think fitness is like the most important aspect of my life outside of, you know, like relationships and this job. And I would say I spend a lot of time at the gym. I cannot justify spending the amount that Lifetime, at least near us, charges. It is a lot, to put it lightly, but we will leave it there. George Tillis, appreciate all of your insight as always on this interesting name that is reversing its earlier strength. So we will leave it there. That does it for Alex and myself for Next Gen Investing for this Wednesday. And of course, International Women's Day. Coming up next, we have the Watch List with Nicole Petalides.
Legal. Murder is still legal. How strange that is. It's hard to get into Mexico. I'd rather go illegally. Nat gas made a new low. Just a little fake bounce so far. Maybe it shook me out of the shorts. There wasn't a sign of reversal, but this candle body's starting to get smaller than that big body I just assumed. I got too hasty though. $833 on UNG. UNG with some volume on the futures. Volume and a wick out of there. Oh, you can't see that. Oh, right here. Cosmo Kramer. Oh, I'm in a good insider trading Discord. You got out and already thinking about getting back in, Jason? I thought you already... Bro. Yeah, it's like I said, it's sketcy. Remember when it was bouncing here, getting all hyped? I'm like, dead cat bounce. Every reaction is an overreaction. You get a bounce out of that. The trend is definitely still down. You're in a bear flag below all-time lows. It's not looking good. It's okay to trade the trend and trade with momentum. You know, once you have this big red candle, it's okay to go short. You go, oh, I need to go long here. No, it's okay to go short when it's red. Given I want to do it on that first candle, but once you're here, after it's already moved down, you think, oh, it's a good dip. No, its momentum is this way. Go with momentum. We're trying to swim upstream. I can't short. Then don't open a position. You can short with options, but applied for Weevil. Did you use my link, Jason? I bet you didn't. I bet you didn't.
Less room for disappointment, but he does say that Tesla's new plants in Berlin and
Look at the
in
description,
Austin
man.
offer a multi-year opportunity for revenue,
Click the link in the
growth,
description.
capital, and for labor efficiency, and that those fears that people had about a price
You
war
can short on Weevil with margin.
are largely baked into the market now. In fact, Berenberg sees the fact that Tesla lowered some of its prices of some of its vehicles as an investment in growth, saying that they're really sacrificing margins near term for volumes, which they're incredibly focused on. Meanwhile, a couple other pieces of news about Tesla today that might be hitting on the stock. The U.S. National Highway Traffic Safety is investigating the Model Y vehicle, which in California, apparently the wheels came off of it, the steering wheels. And then it has another piece of news happening surrounding Elon Musk and a comment he made about a former Twitter employee. So the stock is going down today.
Yeah, that former Twitter employee did apologize, but of course that was not received well. It's a good point there too.
Red Bath kind of wicking lower here.
And then we'll take a look here at CrowdStrike. Now this is a different
Everyone
story to the
knows.
upside.
Whoa,
To the
GME's
upside.
getting a
It-
rally.
It's since then
What
actually
the
pulled
heck?
back from some of those earlier gains, but it's
Very
still higher today
interesting.
on better than expected
Yeah, I
earnings
mean,
and an
it did have this double bottom
outlook
here.
that was better than expected as well. Adjusted earnings per share
Just
was
the way it
above
rejected
expectations
1940,
at
I don't know.
47 cents. Revenue was at
Pretty good relative
$637
strength there,
million,
though.
and the average or annual reoccurring revenue, that was a
annual.
great number, and it increased 48% year over year,
Annual.
growing to about $2.6 billion as of the end of January. And this
rip
stock
there on
has
GME.
really performed well in the past few quarters, and so did the earnings over the past 4 quarters. CrowdStrike has surpassed the consensus estimates for 4 times. So 4 out of 4, it's done well. Now looking forward, it's projecting a first quarter non-GAAP of above expectations, as well as revenue, and analysts raised their price targets on this stock. We're
Today's
looking
volume on
at
GME is
Goldman,
already more than
UBS,
yesterday, so it's not a bad sign.
Evercore actually cut it at
I don't know
Evercore,
where
but
that
it's
volume
still
is, just
within the range of where other analysts
consistently overall.
raised
Look
the
at
price
that.
target.
All right, Renita Young, thank you for both those important
Your
stories
stock's in
today.
around in MySpace.
Appreciate it. Thank
You might be.
Renita.
You might be.
Now let's take a look
going
at
up from
the
here
bigger
on GME.
picture. Joining me right here on set, Francis.
See that just consistently higher volume today? Isn't that weird? Not like from spikes.
Capital. Thank you for being here.
Yes, my
pleasure. Just finished with Renita. You're on with us. Happy Women's Day.
Happy
International
Women's Day.
Happy Women's Day.
You know, as we take a look here at the market, you see the red
my wife.
arrows, right? What is going on here? What do you
We're
tell
about to eat or
folks?
something.
You know, we've had a little bit of a reversal. A lot of people started 2023 feeling pretty great.
Yeah. It's so true. So in January, you had certain numbers reaccelerate as
Three-
far as
three
the
in the
economy
cinema?
goes. You had the wild jobs number, which you know, Powell
no,
was very
GME's
careful
kind
to
of
say one data
showing
point
some
does not
strength,
make a
though.
trend. However, you had the reacceleration when it came
We
to
bounced
retail
off the
sales,
bottom
and you
at
sort of
127.
started to see inflation remain stickily high.
Oh.
We have next week we have
The low
February
from over
numbers, so
here,
it's going to
we-
be interesting
we
to
hit.
see But you had that reacceleration,
Not a big bounce, so
and then
it's
you had
possible
the
we
testimony
break
from
through
Powell
it.
yesterday and today, where he's remaining resolutely
It
hawkish,
wasn't like a heavy bounce,
and
a
none
lot
of
of
this is
volume.
good
It's
for equities.
pretty weak.
And so now we're waiting until next week. We get CPI, we
Well, I
get
think
retail,
might have a
to
flush
see
below it
if
maybe tomorrow.
January was an anomaly, or we really do have a meaningful reacceleration in the economy.
And the higher
Heard your
for longer
cries.
concept seems certainly like a reality. And, you know, if it's 5% or 5.5%, why
Start
not
eating in your
6%?
wife.
Be that target
Until we
rate,
break
right?
something.
I mean, doesn't it seem
This
like...
way you're not
I mean,
getting
he
near where the
himself
age you say you
said
are.
that target rate may need to be higher,
Jan.
likely to be higher than I guess they originally anticipated.
So I expected January to be sort of a bear market rally. Those, particularly the tech stocks, were pretty depressed valuation-wise.
Yeah.
But the problem is that he is going to remain higher for longer. We had the soft landing narrative
Gee, what the
nicely
heck?
in January. We had the pivot trade start in October, and
Just
things
closed my
were
calls
looking
yesterday.
like
I
they were
guess that's-
settling back
that's
in.
part of the reason
and
it's
now
rallying.
his hawkish rhetoric,
Has
alongside
permission
the
now
data,
to
has
go.
sort of reversed that sentiment. So every day that we move forward, where we have continued tightening, we have continued balance sheet reduction, we have continued hikes in rates,
$500,000 out the money
the
calls for 17.
probability of a harder landing becomes more and
And the
more
market
and
maker
more.
will love
It's, you know,
farming
it's
all that
rising.
data.
Right.
61% of Americans are living paycheck to paycheck.
Expire
We have a
wordless.
record amount of credit card usage. People are now putting, you know, this is buffering the economy because the credit card usage puts money into the system as he's trying to take money out of the system. Then you had the $600 billion drawdown in the Treasury General account from Yellen trying to stave off the debt ceiling, but that counteracted the $600 billion that Powell took out of the economy via the balance sheet. So you had these buffers that made the soft landing look ever plausible. But as those buffers go away, as that consumer may start defaulting because the credit card service is becoming so onerous at up to 30% in interest rates, you see that hard landing kind of coming into focus.
Well, that's the tough part of it, because they're using these credit cards and then buy now, pay later, and then they realize, as you said, 28%
Could be a double
of
bottom.
that money that you owe. And
Oftentimes
that
at the
just,
double
you know,
bottoms or double
snowballs.
tops, you'll actually get kind of a move through
Let's
it.
talk about, you know, I'm glad you brought up
Won't be
Yellen
a
and
perfect double
Treasury, too. I
bottom,
think
but
that
it'll
was
be
a
a
good point.
stop loss
Big
hunt,
picture
kind of a
for folks and
shakeout.
investors now, I mean, there's been a lot
So
of, at least they're getting some
I'm looking for
reward
that
when it
because I think we
comes
get an
to
RSI
bonds
divergence
or
and if we get a
short-term
bounce after that.
savings or CDs and things like that. What are you
But
telling
yeah, you're
folks
basically
these
at the
days?
lows here
Well,
if
it's
that
funny
need that
because
plays
now
out.
you're getting
So
more rewarded
waiting to
for
try and get
sitting in
a
cash
couple cents
than you
more
are
is
sitting in the stock market.
not crazy if you're looking to
You
buy
know,
it.
if they're paying 5% and sort of the money market funds and things
Or
like
you're waiting
that.
for
So
momentum,
we
and
might
by
see
that
an
case,
exodus from
you won't really
stocks
know if
just
it's good
because you have
momentum
less
until it's
risk
probably
and
like
more
$1.50.
reward to sit in
So,
cash. I don't know. I think that is
which is a
going to be
safer way to do it.
temporary.
But you just won't
I'm
get as low a
loath to
price.
say transitory
Maybe.
ever again, right? But so I think that basically what you had is you had the pivot trade. So you had a decline in the dollar, you had a rise in
She's
gold,
pretty smart. She knows
you had a
what's going
rise
on.
in bonds starting in October, right? You had credit spreads backing off. You've had a depressed VIX, basically. And so now that trade has reversed with the January sentiment. Now we just have to see, is that a Fibonacci retracement? Are those technical levels?
she talking
Does
fibs?
the pivot trade resume with the idea that we're going to get a credit situation, or does it undo itself with this sticky inflation idea? When you look at the forward pricing for inflation, it's kind of on sale. So we do expect inflation to continue to decline because the commodities prices are declining, and now rents are declining. So you've got owner's equivalent rent, which is about a third of the CPI. There's an 18-month lag in that decline before it shows up in the data, but it's going down.
Right. So if things are going in the right direction, but in the meantime, you have a Fed that's quite aggressive. I mean, now we have more likely than not that they're going to do 50 basis points on March 22nd, right?
Yes.
And then we're probably guessing more is coming in May or June, right? I think, you know, when you talked about the dollar and things coming off, and now, you know, I'm hearing folks talking about oil moving back higher. The dollar is at 105 today. I'm feeling like a little bit of the creep happening.
Yes.
You know, are they just creeping higher while I'm not looking? You know, crossed 80 the other day for oil. I know it's come back down, but I feel like we're pushing up against the top in some of these things.
Yeah, and the yield curve inversion. I mean, my goodness, it's greater than 100 bips, right? So it's just amazing to watch all of this stuff in slow
starting
motion.
to rally
but
here.
if
Get
I'm sitting in
shorts.
Powell's shoes, and of course I'm not really critical of him because he has limited tools, right? If I'm sitting in Powell's shoes, I can't stop right now. There's no indication quite yet that there's a systemic credit event coming. If I were to stop right now, Congress in these testimonies would be asking asking, why are you stopping? How irresponsible, inflation, what are you basing this data on? And then he would have to give those data points, and he doesn't want to indicate any kind of something coming down the pike. So he has no choice but to keep going unless the economy, the market, something gives him a reason to stop, particularly credit markets, watching credit spreads, watching the 10-year, watching gold, watching the dollar. The other interesting thing is the dollar goes up as a flight to safety. Right now it's going up because rates are going up, but that correlation will change if we have a credit event, and you'll start to see, historically based, you'll start to see the dollar and gold going up together. So watching for these correlations, early signals in the credit spreads, anything that's saying that we do have a hard landing coming. Right now, what we really only see is the delinquencies in auto loans are going up.
Yeah. This, as Powell said, no decision has been made on the size of the March move. And I think that's certainly spooked the markets. I mean, you had Bostic say shouldn't be more than 25. Markets went higher last week, right? Yeah. Now you have the opposite happening. Just the final look at for investors.
Yeah, I think so.
You did mention cash and the strength of money markets because of the
well, that's a pretty tight time frame.
If you were to put money to work, or
it'll go up.
Strategy for someone who wanted to put some money to work, whether
I think it'll double from here this year.
With balance,
more
risk,
so there you go, double your money.
Yeah, to not day trade the Fed rhetoric, but to really look. I'm looking at those 5 active asset classes. Like so right now,
7 months.
And we're still in the pivot trade. We're still hanging out there because we expect credit conditions to continue to deteriorate as the tightening
It doesn't do much coiling. It's
and if Yellen doesn't
penny stock
keep
algo
money
trading
in circulation to counterbalance the taking off of the balance sheet, then that's going to start to get tighter and tighter and tighter and tighter. So as things start to get tighter, the probability increases, and so that's what we're protecting our investors from.
Yeah, I really am glad you brought up the Yellen story because that's something that we've been talking about for weeks.
Yeah.
One goes one way, one goes the other way. I mean, Bank of Japan easing while we're tightening.
Yes.
So, I mean, it's a little bit tricky, obviously, a lot of it tricky.
And Japan not worried about inflation at all, right?
Exactly. Yeah. Thank you so much, Francis Newton Stacy. Wonderful to have you here on set. Thank you so much, Director of Strategy Market Analyst at Optimal Capital. Later this hour, we'll be joined by the CEO of Smart Security. Stock just began trading on the NASDAQ today. We'll learn about that company a little bit later in the show, and we'll look at tips for how women should be approaching and preparing to enter the market. Our panel.
If SPY makes it to VWAP. On is up 5%. They had a little pop it front ran the SPY. SPY just got dragged up from GME. Oh, the beige book was released at 2. That's right. Oh, right here. Here's some highlights from the beige book. General Dynamics board increases dividend. Bank of France sees GDP growth of 0.1% in Q1. Fed's beige book. The labor market conditions remain stable. Inflationary pressures remained widespread, though price increases in many districts moderated. In early 2023, overall economic activity increased slightly. Amid heightened uncertainty, contacts predicted that economic conditions would not improve significantly in the coming months. Contacts predicted. Wages have generally increased at a moderate rate, which is expected to slow further in the coming year. Overall, loan demand fell, credit standards tightened, and delinquency rates rose. 6 districts reported little or no change in economic activity since the previous report, while 6 reported modest growth. Price increases are expected to remain moderate throughout the year, according to contacts. Some beige book highlights. I kind of just wicking up to that level we have drawn there. I want to start entering some shorts. Boomer stock BBBY. It's true, it totally is. As boomer as GME is, I guess. We are colluding, scheming. Well, GME is not a penny stock. We're collapsing. Having shares of IBM and TWA.
Price target to $31, up from $24, and maintain an outperform rating there. Car chip manufacturer onsemi is seeing a boom after Bank of America maintained the buy rating, saying the stock could grow 25%, raise its price target
I'm
from
gonna enter a short here,
$90
actually.
to $100. Company announced Monday it had signed a long-term deal to make chips for
I'll add more
BMW.
later.
Then there's Dick's Sporting Goods continues to trade higher following its quarterly report. Today it announced a new deal to be the official sporting goods retailer partner for the NCAA, starting with this year's March Madness. Goldman Sachs increasing the price target there from 142 to 163, maintaining the buy rating. And a quick look here at Bitcoin today, 22,055, down 15. Now let's welcome in Hillary Kramer's with
Michael
us.
Dell's house?
Thankful she's here in person.
the owner of
founder,
Dell?
CIO, Kramer Capital Research, for some strategic ideas, perspective on this market. We've had Jay Powell for the last couple of days. I mean, no decision, he said, on March.
You roll all
That's
kinds of deep, huh, Ace?
because they're hearing 50. What are you thinking here?
Partying
Longer
at Dell's
term,
house.
and this is like, and we're setting up for an incredible bull market. But short term, the message I heard from Powell,
Workhorse?
there's a lot of noise, but his actual
Sketchy
message,
investment as
Nicole,
ever.
is that he is data dependent and he
More
hates
sketchy than BBY.
inflation, and that's the big evil. And we still have inflation, and he is not going to go back to a loose monetary policy. So everyone should hold on, because
He has military
even though
checkpoints.
it's
Wow.
been 8 rate increases, 75 basis points, there's more to come.
More to come, and it's becoming more and more likely. People are thinking 50 basis points in March. I mean, look, in the end result will be
Take photos of
higher
his art.
than originally thought, and I think that's the main point.
Or was it for stealing
in
his
the
art?
meantime, when you think about the market here, you did say bull market, or you seem optimistic.
Oh,
and I
yeah.
know you brought us some
Oh, yeah.
picks and things that you have some conviction on, but how are you going about picking where to make money?
We look for companies on a very fundamental level that are undervalued. We look for fallen angels. We look for sectors that have been left for dead, or sectors that were very hot and then the pendulum swung the other direction. We also look at companies, for example, like Old Republic, ORI. That's a title insurance company. The stock is at 25 because, I mean, it has dropped because everyone believes there'll never be another house that's for sale again. And indeed, houses aren't that much for sale because people have refinanced. But still, we look for those kinds of bargains out there. And the new IPOs that are sneaking out, they're very few. They are incredible opportunities there.
Really? And I know you mentioned ORI and the dividend yields. You had that in your notes. And
Right.
that's something that really you get paid to wait, right?
Absolutely. As long as there's a dividend yield, I know that 2.5% doesn't seem like a high dividend yield today, but at the same time, look, you still get something on your money.
Yeah.
And really, it's really short term that you're going to get the 4 to 5% at a bank.
And who knows with what's been going on with rates, whether you're going to have that for any length of time. I mean, they're pushing 3-month CDs right now, but the truth of the matter is who knows where rates will be 6 months, 12 months from now. That being said, some of the other names that you have some conviction around, let's say something like Etsy.
I love Etsy. Etsy, founded by Josh Silverman, who I'm sure you've interviewed and met, who's based in Brooklyn. Yeah. So Etsy's a Brooklyn-born and based consumer website. So it's business to consumer, and it's everything from the two-headed frogs to being able to get specialized, embossed, anything from towels to
Etsy is actually kind of an
grills.
interesting company.
And I love Etsy and because of their growth and the fact that during the pandemic, over 90% of their sellers were women.
Yeah, and as you mentioned, women, you had another one that was a woman-run company, and that's Ventas.
Ventas is really interesting. There we have 3.8% dividend yield, close to 4%. It's like Omega Health, OHI, in that a woman-run company. It's really a baby boomer stock. It's assisted living, nursing homes, medical centers, surgery centers.
We have a lot of baby boomers. That's
right.
No doubt. And some of these others that you have on here, Fibro Animal Health and Barrick Gold. I mean, when you think about commodities.
I know. Barrick Gold is interesting because I'm not usually a gold bug. And even though I'm not, I see Barrick Gold as an opportunity here.
Why is that?
Because they print money, and as long as rates are high,
BBBY
gold goes down. The minute rates are slashed, because that's really what I think Powell is setting us all up for, is one day to say,
I sure hope so.
Yeah, I've gone too far, and all the
So
shorts
far
will be
we've been in a
surprised,
gamma
and
squeeze.
companies like Barrick Gold, they could see a 10% increase
But
in
we
one
just
day.
have been in it going the wrong direction.
And obviously they've run into problems
All
with
that
their
OI on the put
expensive
side has just
inflation.
been
You know, the bulldozer
out of the money to
cost
in the money.
a lot more money these days
Week
for
after
Barrick
week.
Gold.
Yeah. And let's get to the world of IPOs.
I still. Oh, did I get a
and
short?
you're
I
talking about
did.
Next Cracker and Mobileye.
No, that's what you do.
NXT, it's actually Next Tracker. I wrote Next Cracker.
Yeah,
so NXT, I know.
That's why I said
because
it wrong.
it just came out a few weeks
gas,
ago.
new lows.
And it is the devices
Blue lines,
for
BBY?
the utility
supports,
size solar
resistances.
panels so that they keep facing the sun. And they've
I can get rid of those ones
clients
up there,
all
but-
over the world's $4 billion market cap, and no one noticed that NXT went public. NXT, you're going to hear about this one as soon as the...
Especially with the fight for ESG and solar.
127 is the low from over there.
Get away from energy
116 is the high on IPO. 0.88 is
what you're saying as
all-time
far as
low.
just even a concept. When you
Some
look at the
supports,
books, you
resistances.
decided that they'll have the demand?
Oh, absolutely, they'll have the demand because the companies that are getting out there are the ones that actually have real revenue, and those are the ones going public. And there's mandates by the big
these ones?
institutions.
No,
This is
I don't
a
have
good
any
individual
overlays.
investor stock because the
Got some moving
institutions
averages on
sometimes
here,
wait up
too.
to a year or at least 3 or 4 quarters of earnings releases before they'll buy. So if someone wants to get in early as an individual, NXT is great. Because again, just a few weeks old, but and then Mobileye, MBLY, it's already $40, but
I've heard of
we
Mobileye.
think it's
This
going
one
above
we've known
100
for a long time. I mean, this is a popular name.
Right. Well, it was
done pretty well
independent,
from
owned by
IPO.
Intel. Intel sold Mobileye and brought it public in order to raise enough money to start building
Solar
chip
tracker and
companies
software
here in the
solutions.
United States. And now did a public offering last year, and it just missed it. Everyone just sort of ignored Mobileye.
Right.
So was hovering in the 20s, now 40.
Dark lines
but
of
really,
trend we're in.
it really easily could be over $100.
Right.
Yeah, this is a 200 moving average.
And it's self-driving,
This one up
self-driving
there.
cars and assisted driving, and it's software and hardware, and they really have the business Israeli-based.
All right. And then in the world of health, you had a couple of names. You had one that I mentioned earlier, the Fibro Animal Health, but you also had Walgreens Boots Alliance. And that's a big one.
I have Walgreens Boots Alliance. I love the company. Great dividend yield here, almost 6%.
Yeah, I like
The fact
Walgreens.
that it's woman-owned, woman-run, and it has so much scale and growing so much, and
I didn't even realize that.
Yeah, exactly. And doing generics on the beauty items, so it's not just medical. They just are horizontally integrated so well. Amerisource, Bergen, and I
Be a
see
buyer down here,
it's really the
30 bucks.
big players that are going to win in the end. They really will. And Fibro Animal Health, PAHC.
48
I
cent
love that
dividend.
one for individual investors, mainly owned by institutions. because it's for herds and pets, nutraceuticals, vaccines,
The ones that were just up?
medications, vitamins,
Blue lines that are up?
antivirals.
That's just
and
my
it's
mouse.
just like a great little company that
That one.
so few people
Just
have heard
showing
of. It
where
could
mouse is.
easily be acquired, PAHC.
I also think it's interesting how bullish you are. I mean, that you think that this market at some point will just get this sense of relief, but you might have to wait for it, I guess.
That's right.
Hillary Kramer, great to see you. Thank you for being here in person.
Dude, I'm to
Hillary
125
Kramer,
level.
founder, CIO, Kramer Capital
Think
Research.
nothing.
Thank you. Coming up next, we'll be joined by the CEO of Security Matters. The stock just began trading today on the NASDAQ. We'll learn all about that.
Why melting up more? Tesla's not really getting much of a rally, still below VWAP. Rivian's getting some of the love. I don't know what you're talking about, Jason. Blue lines at the bottom? I don't know, dude. Vertical lines? These? The RSI is the MACD. The volume. Why is more bullish than I would have expected? Had a little sell-off after the meeting, but already recovered back to it. Sometimes you have the effect delayed. Try and mask the real effect of it. So it's really bearish, but it's just showing it's subdued and doesn't matter, but then really we'll get the sell-off in the next few days. Yeah, TV might be broken. ISBO 17%. Like gap down to VWAP. Alba's held up nice. Open's been on like a multi-day run, huh? Oh. Not really. Like I keep seeing this one up. Cosmo. Co is suspended. Cosmo's still a nice bull flag. Same with GNS. BBY Moon 2023. Mooning. Maybe to double digits again. After hours, Obi. SPY moving up further. Gas with a bit of a bounce. Bouncy bounce. Triple paycheck. There's a short puts screener. AMC was on here before. And what else? Anything else? Oh, SI is on here now. Look at that. BBBY is showing up. That ain't bad. The dollar strike. about to start playing with the dollar strike. I like that. Just have to get more time. Can't do weeklies. GME up 1.5%. Oh, look at this guy.
This is what we are able to provide.
Yeah, I understand what you're saying. In the meantime, there's so many aspects to the company. So you talk about providing, having the materials, having the chemicals, all the things that you need to make things happen. In the meantime, tell me about the anti-counterfeit and things that, when it comes to client liabilities, what are you doing on that end?
So I'll give you the example of gold. We have an amazing partner, the Perth Mint out of Perth, Australia. So we mark gold at mine site, at refining, at product, and we're able also to do it on silver, aluminum, steel, cobalt. So what you get is, with one technology, the ethical sourcing, the supply chain transparency, the brand efficacy, quality, and the ability to determine, because, as I said, we give materials memory, the ability to say how much within a product is recycled, how much is virgin, and whether this material or product was used once or twice or 3 times. And this is a unique capability backed by more than 100 patents that only we have.
So as you start out here on the public markets in the States for SMX, you have probably more money available at your fingertips. Where will newly raised capital go first?
It's all about execution, our scale and growth plans. We are now entering everything related to electronics and electronics assembly, because we are able to mark electronics while it's manufactured and produced, so help cyber hardware and supply chain challenges in electronics manufacturing. We are pushing forward everything related to fashion and luxury, because the brands there do care. So everything related to leather, silk, coated canvas, organic cotton, we're able to mark, track. And last is everything related to plastic. Everything related to any kind of plastic article, whether it's at material stage, product stage, waste stage. So companies are able to reuse more plastics.
Interesting. Thank you so much for being on with us. Alon H., thank you. Chief Executive Officer there, live at the NASDAQ SMX. Congratulations to you.
Thank you very much.
Thank you.
Stay with us. The second half of our show, we're all lined up. We're going to have tips for women getting started on the market, how they could prepare for investing. And that probably goes for just about anybody ready to dive into this market. Let's take a look at some winners and losers in the S&P 500.
I don't know. Like intraday? Could still have a little pop today. You could be setting up another one of these kind of bull flag things. Got the momentum there. If it can hold up some levels, make a nice bull flag here, probably have another run. That's when I got into it back here. I was holding that support. Then when it broke through here is when I closed. It went boop. I wouldn't be hasty to buy into it today, unless you're just in a day trade it. Close for a scalp. SPY slowing down its rally. Haven't quite made it to VWAP yet. Could grab another put here or another short on the ES. I'll wait. I think it'll go higher. $235. Not much excitement on Bed Bath today. That's sad. RC tweeted.
Or alternative investments.
I was just thinking I need to sell some covered calls.
Thank you so much, Senator Cho. It's wonderful to have you on the show. An important day and time as well. Founder and president, Point Wealth Capital Management. Thank you, Sandra.
Thank you so much, Nicole.
Got these leaps to sell calls on.
Still
I forgot.
ahead, we're bringing in our panel.
Got
We have to
7
talk
of them.
about real estate,
Gotta be over 20.
investing tips, to-dos, not to do. Watch this. We'll be right back.
Got 7. I got to be over 20, so 20 and a half. Just sell these. Premiums are kind of crappy right now, but whatever. 177 bucks. Wow, why not? Next Friday. Okay, I got some short calls. 7 short calls in GME. Actually, maybe time to top on that. That's not bad. SPY. That gas rallied up to VWAP. SPY, one of their short on up here. I don't want 2. Made it to 50 moving average, almost a VWAP. I got 2 for now. 2 more. What is this Twitter you speak of? What does it say? All about China. Chinaman. You guys translate it yet? Hello. He said hello in Chinese? Stock rips. I don't even know if that was Chinese. I love how hyped you guys are on BBY. I come and look, it's like, oh, still below VWAP. Why would Ryan say hello in Chinese? This is a second tweet in a row where it's referenced China some way. Is China gonna buy Bed Bath & Beyond? What? Bought to cover. Just sold short and bought to cover. Why? Okay. Because it defaults to buying. I'll just sell one short. I have 2 of them. Is it high or low? If it's high, how high? I don't know. Bed Bath is back to VWAP though. Oh yeah, so I did cover calls in GME. Now I want to do some of those $1 cash secured puts that are showing up on the scanner. Move it down to $1, why not? $1 for 421. Seems legit. 44 days. So it's okay, I'm gonna grab another short in the US here. Where did that put me at? 3. I'll do another one. Oh, wait. So his cash secured put ties up $100 in collateral because it's a 1 strike. We'll just do 1 for simplicity's sake. So it ties up $100 in collateral. You receive $19 or $18.35 after the commission, which is an ROI of 22%. So 22% on your money in just over a month. Not bad. In 44 days. Annualized, that's 182% on your money. I like it. Keep me afloat since August. Nice. What do you mean keeping you afloat? Because GME has been putting out. Ivy on GME has really dumped. Yeah, I've done the 1.5s, but they kept getting the money, so I'd have to time the close. But now we're low enough to where I'm trying to move down to the dollar strike. And there's nothing on shorter term that the dollar really makes much sense. So, yeah. It's a bit of time, but can always close it early if we get any kind of rip. Wait for it to run back up. Yeah. Yeah, I've been doing cover calls on it too, actually. It's the last couple weeks. But not been super aggressive about it. It was good when I could do the $2 calls, cover calls, and we're closer to that price. But now that it's below that, I'm at the $1.50. It's like not quite as enticing. I need more time on them, I guess. Keep trying to do weeklies, which doesn't always make sense.
Investments, and that includes ones in emerging areas. Great school systems, lots of places to work, but maybe not the target over the last 2 years where we saw that real estate boom. So we're seeing more of the outskirts of different cities. But then that one buyer beware that you
coming down a little bit here.
if you look in these opportunistic investments, here in Florida, we have the Florida Condo Safety Bill, which was passed after
GME's coming
Surfside.
down.
And what it's happening right now is an incredible number of new listings for condos are coming on the market because we have a huge number of special assessments in place to create that
it could
safety
be.
structure, the new
Like that video we
foundations, new
watched.
facades, etc.
Uh-huh.
of these older condo
If
buildings.
it is repeating, it's
So
stretched out the time frame
sometimes
on
the
it,
numbers
unfortunately.
look really good on
Because
MLS,
our timing's way longer
but
now.
what you don't see is those special assessments
So
coming down
if
the
we are
pipe,
in this zone
which
right
will
here,
totally kill your investment.
yeah, we'll look
Or
for some sort of
on
double
the flip
bottom
side, it's a
around
great
1540
opportunity
or
for an
maybe even a
investor
lower
because
low.
some people, these
But with an
current
RSI
owners
divergence.
can't carry the properties anymore with the special assessments. So you can get a huge
And then that
discount
would be
on the
before a
asking
potential
price
rally
for
up for
these
earnings.
condos. So you have to look at both
But
sides
I'm not
of
sure
the
if
coin,
we're
do your due
still repeating
diligence
patterns.
as always.
I think they maybe
Yeah,
fixed
good
it
advice there. And I do want to
after
talk
the
about
split
the tax
potentially.
deferment if we don't run out of time. Debbie Boyd, just a quick thought on,
So I'm not as
investments go
hopeful
up
for
and
it.
down. Some people who bought and they thought that they may have
Even
paid
this-
a high
this
price
move down
during
is
the pandemic and maybe the price came down.
less
but,
like
Wes,
GME.
rates
It's
go
not
up
very
and down.
aggressive.
You said to go
Slowed
for it.
down.
Buy
It's
it. You
bounced.
Can
It's
always refinance later. Is that sort of
it's
still
not
your
like
mentality?
this
or?
move down.
It is because most
seems
people
fixed.
buy real estate for the long haul. They're not buying it for a quick sell and get out in 2 years. You may build your portfolio by living in a house, then selling it and moving up, rolling that money over. A lot of people are doing 1031 exchanges as well. We see people moving from California. They're getting 4 properties for the price of their 1 property in California here in Texas. So 1031 exchanges are available, but most people, when they buy rental properties, are looking for the long haul. We're not going to fix and flip these unless that's the intent. We're going to buy
1031
them
exchange.
and
So
hold them
if
and put
you
renters
sell
in,
real estate
or fix and flip and
and
get
then
out quick.
buy
You
real
don't do
estate
both.
within I think it's like 30 days.
Right. And
You
Aaron,
file a
final thought. I
1031.
know you had
You don't
the
have to pay
tax
taxes
advantage
on
with
the
1031
the gains
tax deferment and REITs as well.
of the
Aaron, final quick thought.
real estate sale.
Yeah, so if you're going after a 1031, just make sure your agent who is helping you buy and sell really understands the 1031. It's a totally different process and you need a specialist.
Yeah. All right. Good to see you both.
Or you can just
Debbie
look
Boyd
it up
and
online.
Aaron Sykes. Debbie Boyd, CEO of DLB Mortgage, and Aaron Sykes,
I'm guessing she's a specialist.
Chief Economist at Nest Seekers. Thank you both. Wonderful to see you.
Yeah, BY made their senior note
That's gonna do it
interest
for us here on the
payment
watch list. I'm Nicole
was
Kempsky.
like
Thanks
a
for
couple
being
weeks
with
ago.
me. And a wonderful,
And there were
happy
just
International
enough
Women's Day
warrants
to you and to
exercised
everybody.
to be able to
Enjoy
make
your
that
day.
payment.
Thanks for watching. Market on Close is next.
So that would lead to you thinking the owner of those warrants is acting in good faith and not here to destroy the company. And then today there was news that they raised another 150 billion or million from offering preferred stock to pay off more debt. And also within that AK they talked about renegotiating their loans and just different terms on stuff. So yeah, I mean the news has been coming out and it's good. Seems like they're not heading towards bankruptcy at this point. BBBY has not announced earnings, neither has GME. Bed Bath will probably be in April. GME very well could be this month. Nat gas is at VWAP, which is kind of the high from earlier. Could flip it, I suppose. I want to hold. I'm gonna get another short on the yes though. I'll come into power hour. Maybe I'll wait a minute, see if we get a little bounce on it. Something that's worth saving. Yeah. That's my take basically. So the amount they raised today is close to their market cap. Which one of you guys pointed out in chat. Kind of interesting. Just what they raised today. You believe that based on historical earnings or a filing? All right, 3 o'clock. Yahoo Finance. Yeah, those are estimates. They're just estimating. So it hasn't been announced when it is yet. We saw it bounce there on Rivian. Not convinced yet. Clap on, clap off. I'll wait another day. I think we might get one flush below this level. That's still a possibility. Okay, I got one more short on the MES. So started with one here, or no, right here. Got like 2 here, and then 1 here, so kind of a little average in there. Once I got the 1 here, I stopped. It was good because we kept rallying. And then when I came back to the computer, we'd already showed signs of the top with these dojis and this breaking of the low. But we'll see. It is power hour. Last 10 minutes, last 30 minutes could get swinging either direction. Could still average in maybe another 1 or 2. Hit medication for it.
And ADP this morning
Here's our
suggests
vapor.
employment is still very strong. Maybe that's where the action will be. Still a couple days though, so perhaps we tread some water here with the S&P 500
not having any
trying to
effect.
hold 4,000.
That was all from algos. They shut those
You can
algos
also
off.
notice on that intraday chart there was a little bit of pop there in the yield, and that was an auction today that wasn't exactly the smoothest.
tell them not to
So
wear
that
square
contributed
lines.
to a little bit of late
Get
date
them more,
bond selling. The point, though, I think, is that ultimately the yield curve
you can fix that.
has a
Interesting
direction
camera.
very well
Camera should have
laid
the
out and trending.
software to do it.
Very important. People at this point are like scoffing at the yield curve. It's like nobody believes the utility anymore. Even Cam Harvey, who first discovered its connection to recessions, has told us here that he doesn't think the signal might not work anymore. He's also a big crypto guy now, so take that as you will. To me, it kind of adds a grain of salt onto it. All right, anyway, love Cam. The destruction of the yield curve is consistent. And as you can see there in the bottom right corner, it's ticking back lower and rolling over again as part of this steady stair step down over the last year. So make no mistake, there is conviction and trend here. We've had stocks in a big rally for 4.5 months,
gas
pushing
broke
back
up through
against
VWAP
the
there.
bear downtrend from last year. We've had rates bouncing around 4%.
wait,
We've
they
had the
told them all to
dollar
get
with
more.
some major swings, maybe going back higher. As all those trends have come and gone, the one consistent thing has been the yield curve vanishing in front of us. And that continues here right in line with the trend. That to me is the most important thing here this week, because there is a little bit of difference in the response to Powell yesterday than the blueprint that we
GME
laid
back
out last
green.
year around inflation and hawkishness. Last year,
Ops had a pretty good bounce out of there.
degree of hawkishness from the Fed. You see interest rates go up. You see the dollar go up. You see tech stocks go down
Dollar's
the
holding up
most,
nice.
dragging the market as
This
valuations
thing's
are
building
repressed.
a nice little cup and handle
But
here.
once again today, the worst performers
I like the upside on Kala
are the
more than
banks. Financials are down. Regional banks are lower
Tops
by a
at this
percent.
point.
The chart of KRE regional banks
also an
is
engulfing
looking
candle.
downright scary at this point. Not trying to be alarming, but this is basically the heartbeat of the economy. It's where small businesses go to get loans. It's where you go to get a home
chart
loan,
looks nice.
a mortgage. It is connected and embedded into the threads of society and economy in a way that some of the big banks are
Buys coming down
not
here.
due to trading revenues and other income. So regional banks down at 52-week lows and getting really slammed this week while the yield curve extends lower tells me that we might be at a moment here where each hawkish tweak applies a straw to the camel's back that might be breaking at this point. Let's see what happens on Friday. Even though stocks don't like yields on the long end going higher, it's what investors should probably root for, that we continue to see stable economic data in the employment numbers that can stave off the damage the Fed looks like it wants to do for as long as possible. But today we don't necessarily have that so much. It's a fairly calm market. These are the things I think we need to watch over the next couple days. I'm also keeping a close eye on crude oil still, as it seems pretty weak for the most part, but largely range bound. I still label that as the wild card for the inflation conversation. Unfortunately, it hasn't revealed
Inflation
itself just
conversation.
yet. Let's bring in Kevin Hanks. Renita
Bonds
Young.
coming
Let's talk some more here
down.
about today's action. On the
Don't need more
surface, it kind of
contracts.
looks like nothing's happening
Maybe.
here, Kevin, but we did get a little bit of a juicy bond sell-off compared to where we were this morning. That's got the dollar flat now, and stocks having some trouble making any upside ground.
Yeah, day 2 of Jerome Powell's testimony didn't make any major new headlines, Oliver, and the markets tried, I think, its best to be resilient. Remember, you had yields go all the way down to 3.90 this morning. Now drifting, may close up on the day. That's a big move in the 10-year yield. When you look at the dollar's move yesterday, that's eked up now to be positive on the day. This last hour might just be not any hard selling, but just a lack of buying, especially after we got an ADP number that was stronger, a JOLTS number that was stronger. We've got jobless claims tomorrow and payrolls. This is going to get interesting, Oliver. And, you know, because we delayed the payroll data a week, this information's getting all bunched up into a short time here. So I'm really watching this data and watch how the day closes. Yeah, Jerome Powell, he said basically similar to what he said yesterday, but he didn't change anything. And some of the knee-jerk reaction to the dollar and yields kind of worked its way back. So, you know, the dollar's hanging on to the gain it made yesterday, and 10-year yields have gone from down pretty big this morning
Red
to
candle
now
back
up
for
on the
BBY.
day. The one strong part of the economy, or the S&P, look at information technology hanging in there with a lot of big names having a green day. That being said, Apple with the Dan Ives upgrade, that's still positive, but hanging in there. But Oliver, this is still a day that people are going to get jittery going into this payroll number on Friday, because last month's, remember, was such a big outlandish number, and the data leading up to it is pointing to another one, Oliver.
And this morning's number is also pretty warm as far as the job situation. Credit to you, Kev. A nice call heading into the JOLTS number. As you kept saying for a couple days, that estimate looked way too low. Indeed, it was. And the revision higher. To your point, I don't know where the analysts thought we were going to drop so hard down to 10. I guess some of these layoffs happening and companies freezing some hiring, but there's enough happening in travel, leisure, services that that number remained robust. So good heads up on that. Let's talk about something that's dragging here, Renita, because after all, we've got a lot of red this afternoon for the most part. Tesla's down pretty big here. And I think this is one of those days you can choose from like multiple Tesla stories. So what's the lead one here in this case?
You're so right. It's so much going on with Tesla today. Right now, though, when we first came in, we talked about this right before markets open, but this stock is down today, and it's actually heading toward its lowest close since February 1st, and it's all first about a downgrade at Berenberg, which took this stock to a hold from a buy. And however, it raised the price target to $210 from $200. And Berenberg believes that the upside for Tesla is pretty limited. It's had a huge run up more than about 48% or 47% now year to date, and that the current evaluation now leaves less room for disappointment. So not entirely positive, but not necessarily negative either. But this analyst says that Tesla's new plants in Berlin and Austin, they offer a multi-year opportunity to grow capital and labor efficiency for this company, and that the fears of a price war, he believes, first off, that those were misplaced. He believes that those appear to have been baked into the market by now. In fact, Berenberg sees the fact that Tesla has been cutting the price of some of its models as really an investment in growth, since the company is sacrificing near-term margins for volumes, which is something that Tesla has been incredibly obsessed with since the very beginning, really, getting those volumes up and continuing to increase those volumes by 40% every year, at least for the past couple of years. But we do have a few more things happening with Tesla. There is a National Highway Traffic Safety investigation happening about the Model Y vehicle, because in California, 2 vehicles saw the steering wheels come off. I can't imagine what will happen if I was driving on a highway and the steering wheel came off. But listen, the NHTSA is investigating it right now. And then Elon Musk is in the news again. He's criticized he was talking about criticizing a laid off Tesla or Twitter rather employee. And he did apologize about it later, but it's a bad look. So it's several things happening.
Daily MACD on BBY.
Geez, the wheel on the Tesla.
Might get across tomorrow, but
that's pretty. Look,
bullish cross on it doesn't matter a whole lot if the price actually stays like this.
You know, I did chemistry, not mechanical
engineering. It seems like it's probably going to do that.
But
if we get it with some price action, that would be good.
Pretty important.
Yeah, absolutely.
My gut tells me.
Control.
My gut tells me. But Kev, this is supposed to be our stock market leader. Tesla's been the rock the last couple months, and now the steering wheels are falling off.
Steering wheels are falling off.
How does a steering wheel fall off without giving you some type of warning or some looseness? I don't get. I am a car guy.
That's a good point.
I've been driving my whole life. If my steering wheel was going to fall off, I'd get a little notice and put the brake on.
Right.
If my steering wheel was falling off. But that being said, remember, Oliver, I'm a big student of the news flow. And at least the news flow in Tesla right now, like Renita just said, it's several little dings in a row here. So if the market gets weak, Tesla could lead this market lower just because of that news flow. They need something to change the direction of that flow.
All right. Yeah, I hear you. First time we've really seen this kind of ebbing with some conviction to the downside here, lower past 200, because it was holding 200 pretty firm for a while there. So we'll see how it fares the rest of this week. And you think with all the fancy software and all the cool tech, it would know the steering wheel's coming off.
It's when you activate autopilot, the steering wheel shoots off and hits you in the face.
Renita Young joining me here to walk through some of the movers. Okay, let's get back into focus here about the big picture for our investors this year as Jerome Powell maybe strikes a little bit more of an aggressive tone. With me in studio, Shana Sissel is the founder and president of Banrian Capital Management. Shana, great to see you in person again.
Great to be back in studio.
It's also International Women's Day, and Banrian, you're building as a female-led or female-only business. Tell us about it.
Well, it's not female-only intentionally, but it is right now female-founded, female-led. So all of my employees are women, and Banrian means queen. So definitely have that going for us, and we're leaning into it for sure.
Perfect. What is it, Irish?
It is. It's Gaelic.
It's Gaelic. Okay, cool. What are you guys doing there, and what's exciting to you right now? What's the market that you want to go after?
So we are using technology to help investment advisors, independent advisors scale and become educated on allocating to alternative investments. And a kind of our secret sauce is that we work within the public markets, and I mean ETFs and mutual funds, as well as private access, which is, you know, your traditional LP products with your private equity, your hedge funds, and the like. So we kind of bridge the gap between the two and help advisors figure out how to build those portfolios so that they can allocate to them, hold on to it for a full market cycle, do it in a way that complements traditional investing, and we use technology to really drive that process.
What do you think most people miss in terms of the alternative allocation, and do ETFs and some of the new kind of wrappers that these are in give people access to stuff that used to be a little bit more kind of hard to get to, or is the stuff that's hard to get to still
just
stuff
slowly
more
melting down?
Well, a little bit of both. So until 2007, you couldn't get anything that even sort of resembled hedge fund-like strategies in an ETF or a mutual fund. And since then, the regulatory environment has changed. They've relaxed some of the restrictions on the 40 Act, which has made it possible for more and more alternative type strategies.
Thank you so much for your generosity today.
Funds, ETFs,
fun hanging out.
Interval product.
Austin,
so you can even get some of
Tasty,
that illiquidity alpha
Tommy,
because of the interval product.
AC, John, Christopher, Ruthless, thank you guys. Thanks Jason, thanks Tommy.
If you are
I gotta cut out. I'm gonna do the recap video. Be like 4 o'clock, I'll come out.
There's a much larger
And
universe to
did some
choose
trades
from
today.
there, so you can build
Did some
better
data farming.
portfolios.
Did some futures.
But, you know, the thing
Won't
is
go over
that
those
most
trades.
advisors, most
What I
people,
like,
when they look at
I
alternatives,
like
they
Kala
performance
actually. I think
chase.
Kala looks nice coming
And they typically
into
only choose one.
the rest of this week.
Something that's done
maybe
well.
tomorrow.
Yeah, that's done well, and then it
Ops,
doesn't work,
I'm a little less
and then
sure
it's
of.
complicated, so it's hard to explain, and it's just not worth
But
the
yeah, if it
trouble.
kind
And
of
we
keeps
spend
holding up here, I
lot
think
of
it's a
time teaching
little soon on
advisors
that.
and investors
Anyways, we'll go
how
over
to
those.
build
Thanks guys,
equity
thanks for the
portfolios
hanging
and
out.
fixed income
Listening to
portfolios,
Pal.
but not
Another fun one.
alternative portfolios. And I could
Thanks,
go
Jason.
down the
Thanks,
rabbit
Christopher.
hole and get into the weeds here and tell
Thanks,
you all
Austin.
the reasons
We'll
why
do it again
we're
tomorrow.
doing it wrong. But at the core, it's that
Thanks,
we
guys.
think
Thanks,
that
Trader. Thanks, big
anything that's
hugs.
alternative
Good
belongs
night.
in a diversified
And if you don't see you
bucket.
again,
And I would
good
argue
afternoon, good
that's
evening,
not
and
the
good night.
case. Private